What's up, guys? How's it going? It is going to be one heck of a day today. It is the final day of Q1 2021. Super excited. Markets are looking up. Let's make this happen. I do have to jump into a meeting right now as we start here at 8:30, but I'll turn on, I'll leave CNBC on. You guys can listen to the markets open. I'll be back in a little while.
Spend more on mirror. I think these will all disappear. Look, when it's down 9, that means the seller's going to come in. And what happens is brokers get orders, they send it down 9, then in the middle of the day, they send it down 12, and then they let it bounce to be down 8, so they look like they got a better average at the end of the day. But this was a good quarter. And people have to understand that Lulu is going to spend on mirror because they think that mirror could be Peloton. And who can blame them with Peloton's valuation? So I think stop sweating the program, Lulu. No real downgrades here. Lulu, by the way, has a history of being conservative with guidance. So don't take the bait. It's a good quarter, and they're just being very commonsensical about what's going to happen. This is a post-pandemic winner, not a post-pandemic loser. People are going to wear Lululemon. And by the way, look, the only place where it may be a loser is with Charlie Schwab from Wells. He probably makes you put a tie on.
Yeah, BTIG this morning, Jim says the guidance there is probably conservative.
Yeah.
Although physical comps down 28. I want to talk to you in a bit about the mall. I know you spoke to Macy's last night, but in the meantime, there is the opening bell on this Wednesday morning. Interesting day at the big board. It's online education provider Coursera celebrating an IPO. We're going to talk to the CEO later this morning on Squawk Alley at the NASDAQ. It's Hollaback, a grassroots initiative to end harassment. So what about the mall at this point, Jim, having spoken to Gannett last night?
Boy, I'm really torn. I mean, Jeff Gannett told a pretty good story at Macy's. Now, he took pains to distinguish between the A and B malls and the other malls. That is something that David Simon has explained to me over and over again, which is that there are malls that people go to and there are malls that people don't. And Macy's, I think, is emblematic of the customer that is middle range, that is going back. The Bloomies business is fantastic, by the way. I'm always after them to do more Bloomies because people like them. They put some backstages within Macy's, but they've closed almost all the stores that they need to close. And they're saying that if you have a Macy's, they do 2 to 3 times the digital in that area than if they don't. Everyone's saying they're leading with digital, Carl, and you get PVH leading with digital. You have to say leading with digital because you look at Target stock where they actually led with digital, and you're just kind of saying, I want to be Target. A lot of companies want to be Brian Cornell, but there is only one Brian Cornell who was smart enough to buy Shipt, S-H-I-P-T, which those of us who use it are kind of blown away by how good it is. But PVH, it's no longer Manny Chirico. They did a good job. We look at that Target. I mean, Brian Cornell's a visionary. And I think that when people use their .com, so to speak, their e-com, they are kind of amazed at the ease of it. But I think Macy's is no longer in the fight for its life. They had a decent quarter. They got good cash flow. They're taking the cost down. So that is no longer on the critical list. Nor is Kohl's, obviously, right. Nor is Nordstrom. But look at these. Look at Target. Now, Walmart, by the way, which my Chapel Trust owns, has been a real dog. And I think one of the reasons it's been a real dog is other people are catching up to their great e-commerce. But Macy's, I thought Gannett told a pretty good story. I know there are people who are doubters. And people who say, you know what, we're going to see the mall slink back to its the lassitude of customers who aren't interested. I don't think that's true. I think that the A and B malls are getting customers. People like to shop again. Remember, that was something we were very good at. It was shopping, and that was one. Yes. And then like steel was like number 480. We're trying to get steel back up there. You know?
No, it's for a lot of people, Jim. It's an experience, not just a necessity. I know you're probably dying to talk some Chewy. Back to 90 is going to be highest since early March. I see Webbush, I think, goes from 90 to 100, reiterates the outperform on some of this margin strength.
Look, this was one of those stories that where they put on a clinic. It was a clinic on how to move and have incredible growth, make money when people didn't think they were going to make money, have proprietary name brands that I happen to think are better than the actuals, not unlike Costco, where I like to buy the Kirkland brand. So Chewy is doing many, many things right, not a back patter. They're running these guys are run to win. And I think anyone who listened to what they had to say about the retention of customers after the reopening of America, and then the love of pets. I mean, the love of pets is extraordinary. Pets really took off, so to speak, during the pandemic, and now it's continuing. So Chewy's got that secular growth tailwind, and they also have the tailwind of being, once people are in, this new cohort, the 2020 cohort, spending more than the 2019 cohort. So congratulations to the Chewy people on doing such a remarkable job. And those of us who are customers love the personalization, which is really extraordinary.
Yeah, that's a pretty nice move there, 11% on a surprise profit. The Evidence Lab, Jim, I thought of you this morning when UBS when UBS took Apple to a buy. They go from 115 to 142. Sturdier iPhone demand, Jim, and they're talking more about optionality regarding a car, which they say could be worth at least $14. What do we make of this?
Well, look, I was listening to Tony Sagnaghi yesterday talk on Squawk, and he's basically talking against all of those. He's really talking about how, listen, there's no momentum, and there's really not much. As I get my Evidence Lab is it's a UBS SUV or SVU or something. But one of the things that I think that Tony looks at is that the actual numbers as you go up in progression 21 to 22 to 23 really isn't special. But I continue to hold that those numbers are way too low because of the service revenue, which I think is going to be explosive. This isn't even based on the service revenue. This is actually saying no super cycle, which, thank heaven, super cycle is the kiss of death. No problem, valuation, optionality, seasonality. I think all of those work, but I do remember these stocks are out of favor. There is just a kind of a sense that if you want to own something tech, you have to own something that plays into the chip shortage hand. You want to own semiconductor capital equipment, or is something that is just so exciting that is that's revolutionary. And those are very hard to find. I mean, look, I think NVIDIA is one of the greatest companies, and it has a fantastic suite of product that makes it so video games are much better. But video games are part of those are the days when you sat around. Now we're going out, and so a lot of the chip stocks are related to people who are sitting around, and then the others are in shortage, and they're related to the autos. So it's very hard to find really good tech stories that people want. People are defaulting to kind of a boring tech story. I see people buying IBM endlessly. Chuck Robbins, you mentioned him on Yahoo Finance. People are buying Cisco. They think it is very inexpensive, and Chuck is sticking by the couple of years that it's going to take, but he also sticking by the Tar Heels and the Falcons, which is, I mean, talk about three teams that are going to take a couple of years: the semiconductors, the Falcons, and the Tar Heels. They're all in long supply. There's a glut of all three of those. No, I love Chuck, but Chuck does back some really curious teams, including DRAMs.
On the flip side, from tech, Jim, I don't know if you saw this out of Kimberly-Clark a few moments ago, raising prices across the board in North America to offset what they're calling significant commodity cost inflation. That stock's back to 141. That's a high for the year, Jim. In fact, that's above the 50-day or the 200-day for the first time in several months.
I'm sure Procter can say the same thing. I was hoping that this happens because the margin squeeze is terrible. I mean, historically, Kimberly's always had this issue about pulp. Procter's not up enough. They all have to make the same statement. These stocks, when they can put through, when we can see a price increase being put through and sticking, as we have, by the way, in the chemicals because of Superstorm Uri, the numbers just go up, and then the analysts all fight to be able to say, I got it. I wonder whether Clorox can do that. I mean, Clorox is the stock that a new CEO, Linda Rendell, whom I really love, and the stock is still down 40 from its high. Only 55,000 shares trading here. It's up 40 cents, but you're looking at stocks it's down 3. I know we're not going to year over year buy as much Clorox because we no longer are stockpiling wipes. But these companies are acting as if they're never going to come back, and if they can put through price increases, then numbers have to go higher. That's what the street wants.
That's interesting. Kroger also this morning reiterating guidance for the year. with a range that sort of straddles the consensus. Jim, the other upgrade that I thought was interesting was Baird on Harley. They go to outperform, price target 45. They are talking about some better strategic execution, but mostly it's about strengthening retail demand and severe inventory shortages, to the topic we were talking about a few minutes ago.
Well, Zeit's new CEO is, I think, really coming to grips with the age issue. And trying to get that down. And by the way, Polaris, which has not done a lot of TV since Scott Wine left, is also benefiting from that. Thor benefiting. I had Vista Outdoors. I know people are going to say, Jim, that's a bullet company, but the part that is outdoors still doing well. Williams-Sonoma part that outdoors still doing well. I wonder, Carl, whether people didn't get a taste for being outdoors and recognizing the greatness of it. How much of this is just going to be people then slinking back home after they discovered and spent for a Brunswick boat? I mean, people I think there's just a sense that maybe we got to go to the great outdoors and embrace them more than just because of the pandemic. I know that it sounds silly that we tasted the outdoors and liked them, but I think we may have.
Yeah. Well, I mean, we've talked about Harley over the years facing sort of long-term demographic challenges, as perhaps millennials don't want to ride as much as they as much as their parents did, but maybe a good-sized balance sheet on the household sort of changes that dynamic. We'll have to see. Boeing, Jim, up back to 255.
Alaska.
We talked about the Southwest sale, and now Alaska buying 29 Maxes.
Okay, so here's my theory on what's happening here. I think that Southwest just got a great deal on its planes. I don't think that Boeing wants to clear that inventory out. I know Boeing can make money on the back end on service, but I think I think Gary Kelly just basically said, I'm going Airbus, and they gave him the store. So now if you're Alaska, you say, hey, I want some of the store. So I think there's going to be, it's not orchestrated. I think that they all want that Southwest deal. So I continue to believe that Boeing goes to 300. When I said that it was going to 200, people didn't believe me when it was in the 150s. I think this is an excellent opening of America's story. I think it works. Still not done.
Yeah. No, you had faith in BA when it was dark days.
Well,
and it was hard to shake you from your confidence
great American
that it was going to
company.
Eventually recover.
Well run now. I want to congratulate again Greg Smith on the bond deal that saved America, so to speak. When they were able to raise money during some dark days, it meant that real America is going to get bailed out here. And not bailed out with a check so much. It's just the capital markets were open for them, and that was a lot. Jay Powell doesn't get a lot of credit for that, but he was instrumental in doing that. Hey, by the way, Carl, you know what's moving up today? Some of these dog software companies. And I'm like, the Datadogs. Salesforce is moving up. Snowflake. I wonder who's in there buying these. It is extraordinary to see stocks that have just been down for days actually getting a little lift. I got to do some more work on that because those have been not the place to go. Snowflake being the most hideous of these, down 20% for the year. I always hail Frank Slootman. I know he's been on the show, but people have been saying, Jim, don't you understand this is owned by millennials and they think it's related to the weather? I think that that people have been waiting for these stocks to come down. My friend Curry Firestone talked about how there's a lot of stocks that are still selling at a price of sales. Snowflake is a very expensive stock. But to see someone finally take the bait when it's down 20%, I find that hopeful. Maybe that's hopeful because people have been waiting for the quarter to end and they want to get into these. But to see Snowflake up more than Pepsi is a big deal.
I do wonder, Jim, we don't talk about London names very much, but Deliveroo, ticker ROO over in London, big IPO today, down 24, it sort of has people in Europe wondering if that enthusiasm is going to get washed out a bit.
Wow. I mean, that's UK has had some really good numbers with vaccination. That's terrible. That's absolutely terrible. The IPOs have to stop. And look, some of these companies, I got to talk about this Romeo for a second. That's RMO, okay? You're going to look at that. They made some projections. In October, they're a SPAC, RMO. They projected they're going to have 140 million in revenues this year. Wow, hey, that sounds really good. Remember, you're allowed to project whatever you want if it's a SPAC. I think the government's going to have to get to the bottom of this. 140, well, it looks like it's not going to be that good. And they're lucky if it's 40. So you had 140 forecast made in October of last year for a SPAC, and now they're talking about 18 million to 40 million. So this is the Cole Porter anything goes. I know you love pop music. Anything goes with a SPAC.
I love
Carl.
Cole Porter.
Cole Porter, I like more than Rodgers and Hart. I'm not kidding.
Yeah,
right.
As Cole would have said, it takes two people to write a song. He was proud to do both. Jim, we'll watch Romeo. I do want to ask you, while we have a minute here before we get to Rick, on cannabis. The New York State Senate did approve legalization for recreational. Dispensaries could open as early as next year. They're talking tens of thousands of jobs, $4 billion in sales. It's going to actually be a bigger market, Jim, than Washington State. Not quite as big as California, but I guess the question is whether the stocks move on it.
Look, they're on an upswing. You get a Tilray is already up 182% this year. I think that a lot of these have anticipated anywhere it's on the ballot, it wins. I've been saying buy Grow Generation because they're the pick and shovel name, because they make it so that you can grow. Very expensive stuff to really grow en masse. But look, these stocks are they're not to be denied on individual days. But I think that New York is being a little too optimistic. New Jersey's not been that great. Maybe New York's going to be wide open, but a lot of things are like local areas that don't want this. So I say don't get too excited. A lot of this is already in these stocks. I like Canopy because they got a lot of cash and because they have that tastes great, no filling drink that none of us has had yet.
Right. I did see there's some stories this morning about Congress and whether or not the table is truly set on federal legalization. You got McConnell sort of out of the way as a roadblock. At least that's what some of the Dems would argue. But there's a little more skepticism that could actually get done. For now, it seems to be more of a state-by-state story.
Yeah, the only place where it's legal
that's a big deal for New York.
University of Mississippi. It's the only place that you can do it because they were grandfathered in. Oxford.
Yeah. I think we're going to get Chicago PMI here. Let's get to Rick Santelli. Hey, Rick.
Yes, very similar to yesterday's consumer confidence. Anybody with heart condition ought to sit down now. A big jump in Chicago PMI. Expecting a number barely over 60, 66.3. 66.3. That is a good number. As a matter of fact, you'd have to go pretty much all the way back to July of 2018, where it's 67.1. So that is a biggie. And how does the market react to that? Well, watch yields. They are ticking up a little bit here as I speak. Look at a week to date of 10-year note yields. What you'll notice is that we extended and we held. Now, you could argue that we're kind of flat today, but we're flat over 170. Actually, that is a very good thing considering 172 and change is the high close going back to January of 2020. And let's take a long view, shall we? Here's a 10-year of 10 years. Why is this important? Because look at that chart. What jumps out at you? What jumps out at you is the mid-130s up to 2%. Looks like the zone we're going to spend time in. And I think that is a fairly safe bet. Remember, the mid to upper 130s represented the lowest yield closes in history in 2012 and 2016 of July of both those years, until, of course, COVID hit and pushed that number down to 0.5%, 0.50. Now, if we consider the momentum that we've seen of late on the long dated and we realize today's the last day of March. And why is that important? Because whether you're looking at Canada, New Zealand, Japan, or India, this is the end of their fiscal year. And it's important. And a lot of mutual funds and other large institutional players also have their fiscal year calendar ending at the end of March. So there's going to be some rejiggering going on. We understand that. Now, finally, let's look at what's going on with the knob. Notes over bonds, 30-year yields minus 10-year yields. This is a really fascinating chart. Chicago pit traders used to love this spread. Why? It gives you a good indication of the amount of horsepower and momentum on long dated. Now that it's contracting, actually, it's the most narrow it's been, in 8 months. That would tell me be a little cautious that this 1 3/4 area that we've bucked up against in 10s might end up holding for some consolidation. Jim and Carl, back to you.
All right, Rick, thank you very much. Rick Santelli. Stocks got a little bump out of that Chicago PMI number. As Rick said, best in about 2.5 years. Dow's up 62. Got most sectors in the green. You got the VIX once again under 20. We're back in a moment. Got some breaking news out of Delta. Let's get to Phil LeBeau. Hey, Phil.
Carl, on the heels of Ken Chenault and Ken Frazier this morning, both in the New York Times and on Squawk Box, basically calling for corporate America to fight the repressive voter laws that have been passed in Georgia and are being considered in other states. These new laws that make it more restrictive in terms of the ability for people to vote. Delta CEO Ed Bastian out with an employee memo. This is it, just released a few minutes ago, essentially saying that Delta agrees that this law is too restrictive. A couple of quotes from the memo from Ed Bastian. He writes, however, I need to make it crystal clear that the final bill is unacceptable and does not match Delta's values. He goes on to write, it is evident that the bill includes provisions that will make it harder for many underrepresented voters, particularly black voters, to exercise their constitutional right to elect their representatives. That is wrong. Those are the words of Ed Bastian, Delta CEO. So we are starting to hear from some corporate executives following this call from Ken Chenault and Ken Frazier that corporate America needs to fight back against any voter laws that make it more restrictive for people to cast their ballots. And certainly Georgia is front and center. Guys, back to you.
Yeah, Phil, just quickly, Carol Tomei, CEO of United Parcel, sent me a very interesting book recently about the history of African Americans who work for UPS, and it's stirring and it's a great story. How long before she has to come out? I mean, big employer, Atlanta, and I have to believe she's going to be out there saying something soon.
Well, you know, we reached out to Delta as soon as we heard, and I watched the interview with that Andrew did this morning with Ken Chenault and Ken Frazier, and we reached out immediately to Delta and we said, look, they're calling out executives and they're calling out corporations, and Atlanta is right in the center of all of this. What does Ed Bastian have to say? And they said he's going to have something in an employee memo. And it was within 45 minutes that we received this one. And we don't think this was in response to the article in the Times or their appearance, Carl, on Squawk Box. I think that this has been, it's bubbling up. And I think that for Ed Bastian, today was the day that he had to put these words into a memo, and it's very clear Delta does not agree with the voter law that was passed in Georgia. Now, whether or not that leads to changes, separate question, but clearly they are on the record as saying it is too restrictive.
Phil, it's an important story. On another day, I might also ask you about them stopping the blocking of middle seats beginning May 1, which is now on the tape. Yeah. But we'll save that for another time. Obviously, this is the front and center today. Thanks, Phil. By the way, do not miss CNBC's Race and Opportunity special tonight, 8 p.m. Eastern Time. Amid the rise in anti-Asian violence in the U.S., we're going to look at the economic and social challenges facing the Asian American community. You know, Jim, yesterday I did a panel online for our CNBC Work Summit with Matthew McConaughey, Oscar award-winning actor, producer, philanthropist, and author, about the roles that corporate CEOs are taking on a number of social issues. Here's what he said.
Our CEO's ready to take the responsibility to say, hey, I'm going to pay my tithe. I'm going to pay back to the city that I'm in, that I moved to because I left a place that I didn't want to be, and I don't want to turn this city into why I left that one. We're dealing with that in Austin, Texas. You don't come here trying to turn this place into why you left where you came from. So CEOs are in a position of more power right now than I think they ever have been to lead where we're going to go as a people and as a country.
Points to exactly what you were just saying with Phil about the roles of companies like Delta and Home Depot and UPS.
Yeah, I mean, we mentioned Chuck Robbins in a kind of a funny way involving some schools. Let's talk about a serious way. He and Mark Benioff have done more, I think, to say, listen, we got to pay more money. We are very lucky people in America. We're very lucky people where we live, very lucky people that we're wealthy, and it's time to give back. And they favor higher taxes on themselves. And I think that that's emblematic of how great some of these CEOs are. I still believe that business is the greatest force for social change in this country.
Jim, we're gonna follow that story. In the meantime, S&P 3975 as we wrap up the month and the quarter. We're back in a moment. Jim, you've got an important guest tonight on MAD.
Yeah, two things you want to watch tonight. Secretary Raimondo, Commerce Secretary, really instrumental in putting together this infrastructure. And then you want to watch Race and Opportunity in America at 8 p.m. like I will, because we're all too ignorant, and we're going to learn tonight. And congratulate to all the people who are involved with it.
We will continue to look for comments out of companies about the issues we've been talking about socially. Jim, we didn't really talk about quarter end and whether or not you think the playbook really changes in Q2.
Well, I am surprised that there's a lot of people coming back to the old favorite tech names as if nothing happened. Or perhaps people just said, you know what? I didn't want to show these. I will show the people who are members of my fund or fund investors the days. They don't give you the last day in those holdings. So it looks like they're being drawn to them again. Rather amazing. Maybe they think that the selling's over. I wouldn't be so sure.
Right. There's a lot headed our way this afternoon if we get some granularity on infrastructure. And, of course, although we'll be closed, markets will be closed on Friday, that jobs number is going to be key. Look forward to tonight.
Thank you.
Good hour, man. Mad Money with Jim Cramer, 6 p.m. Eastern Time. Good Wednesday morning, everybody. Welcome to another hour of Squawk on the Street. I'm Carl Quintanilla with Morgan Brennan. As we said earlier, we are wrapping up the month of March and Q1. Got some good news out of Pfizer on the vaccine and a trial for younger kids. As we said earlier, the president's going to roll out the infrastructure package later on today. Getting pending homes, and for that, we'll turn to Diana Oleg. Hey, Diana.
Hey, Carl, a huge miss on pending home sales, down 10.6% in February month-to-month. Street was looking for a 3% drop, down 0.5% year over year. That according to the National Association of Realtors. This index measures signed contracts on existing homes, so people out shopping during the month of February, and the realtors are blaming it entirely on record low supply. There were just 1.03 million homes for sale at the end of February, a 29.5% drop from a year ago. That is the largest annual drop and the lowest supply on record. Regionally, pending home sales fell everywhere month to month, slightly higher in the South and West compared with a year ago. Sales are now varying dramatically by price point because supply is so low on the low end and much more plentiful on the high end. But the Realtors chief economist Lawrence Yun says we are starting to see those inventory problems in the $500 to $1 million range now as well. Morgan.
Diana Oleg, thank you. We're going to start with some of the big news out of Pfizer as well. Meg Terrell has that for us. Hi, Meg.
Hey, Morgan. So Pfizer has been testing its COVID-19 vaccine in ages down to 12. And the first results out from that cohort of 12 to 15-year-olds today show strong efficacy and a well-tolerated vaccine for kids as well. Now, in this trial of about 2,200 kids ages 12 to 15, they saw 100% efficacy. Now, that was found with 18 cases in the placebo group and 0 on vaccine. So not huge numbers, but obviously a very strong result. Now, what they were looking for here was to see how well this was tolerated among these kids who have such a strong immune response. And they said, without a lot of details, that it was well tolerated. Now, Pfizer CEO Albert Bourla saying they plan to submit these data to the FDA as a proposed amendment to their current emergency use authorization in the coming weeks and to other regulators around the world with the hope of starting to vaccinate this age group before the start of next school year. And guys, Pfizer has also started moving into lower age groups as well with trials dosing the first patients ages 5 to 11 last week and a plan to start in ages 2 to 5 next week, ultimately getting down to as low as age 6 months. Guys?
Meg, they're moving aggressively here. Another thing a little bit different, but I know you've been following this closely. We've also seen a number of studies come out around vaccinations of pregnant women and nursing mothers as well. What is the data they're showing?
Well, it's still pretty early, and of course there are controlled clinical trials going on to get these answers definitively, but so far the early data has been encouraging. The safety looks strong for pregnant women and nursing women, and there are some very early signs that there may be antibodies passed along from pregnant moms to their babies or from nursing mothers to their babies as well. And so those are all very good things. We wait for more data really to definitively say.
Meg, I don't know how you do it. The good news, bad news flow this week has been remarkable. We had the CDC study about Pfizer-BioNTech. We had the impending doom quote from Walensky. And then yesterday we had this idea that, to the CDC's best knowledge right now, those who are fully vaccinated don't spread. How much faith do we put in that right now?
Well, the data are very strong for the vaccines. We've been seeing real-world efficacy coming from Israel and now more and more coming from here in the United States, showing these are very effective vaccines against both disease and infection. Now, the NIH is running a trial in college students to really determine if people who are vaccinated can spread the virus to others, and they hope to have those data in 5 months, so it's not completely imminent. But at the same time that we're vaccinating so many people, public health officials are also very concerned about the next 4 to 6 weeks and the spread we might be seeing in some areas of the country. And so they're just warning us, be careful, for a while longer as we get closer to perhaps June as a time when much of the population will be vaccinated.
Right. Hopefully this is one of the last quarters, if not the last quarter, where we have to be super, super careful. But we'll have to wait and see, as you say, Meg. A lot of news headed our way still. Meg Terrell on the Pfizer News. Thanks. The best performing stock in the Dow for Q1 is Walgreens. Bertha Coombs has that for us. Hey, Bertha.
Yeah, it's been a juggernaut, and it's up today as well on earnings. Just 2 weeks on the job, Walgreens CEO Roz Brewer sounding a very confident note. She says she intends to move swiftly and decisively on moving the company forward. Now, for the quarter, which ended before she became CEO, the company's earnings are a little bit complicated because of the sale of their Alliance Healthcare unit. Taking that out, adjusted earnings of $1.26 per share were well above analyst expectations, especially after we saw that pre-announcement from Rite Aid that was pretty awful. And sales came in at $32.8 billion. Now, overall comp sales were up about 2%, driven by 78% increase in digitally initiated sales, one of those things that Roz Brewer really concentrates on. Front of store retail was down about 3.5% due to soft cold and flu season, but pharmacy was up 4.5%. Part of that driven by the vaccine rollout. And the company is boosting its outlook, in part expecting a rebound now in Europe, but also a tailwind from the acceleration of vaccinations in the U.S. They expect to do between 26 to 30 million vaccines over the next 6 months, vaccinations, and each of those vaccinations will come in at $40. Brewer says she sees the company's performance under COVID as a great template for where they can move on a digital and in-person model.
The work that we're doing with VillageMD to diversify who we are as not only a retail company or a pharmacy company, but to look at healthcare overall. This is a complex marketplace. I think we're all clear about that. But defining our key differentiator is the work that we have ahead of us. But these early innings that we're in right now, I'm highly encouraged by.
Brewer says she is undertaking a strategic review of the company's initiatives, will get out and meet with shareholders. Overall on the call, though, Carl, she did sound a note of confidence and optimism, and investors seem to be responding. The shares near their all-time high.
Yeah, definitely one of the leaders we're watching closely in this new role. Thanks, Bertha. Bertha Coombs on Walgreens, which, as we said, is the best Dow stock year to date. The biggest laggard is Apple. Joining us this morning to talk about it is Tom Forte, D.A. Davidson's senior research analyst. Tom, it's always good to check in with you. Good morning.
Thank you, Carl, for having me on.
I wonder, before we talk about the degree to which it's an opportunity at these prices, what do you think has been the drag? Is it about component shortages or skepticism about the phone cycle, or what?
All right, so when I think about technology stocks in general, which have been under pressure, Amazon being another great example, you've seen the shift into more economically sensitive names, energy, financials. Additionally, you've seen pressure on higher valuation technology stocks. Tesla is probably the best example with rising interest rates. Now, what I think is most interesting for Apple, which is something we talked about during the election, is that you're seeing the risk to Apple of a Biden presidency. What's that risk? Well, he indicated that he wants to pay his $3 trillion infrastructure bill by raising corporate taxes. And when you think about corporate taxes, Apple's probably one of the biggest taxpayers in the U.S. So those are the things I think that are weighing on Apple shares year to date and why it's underperformed NASDAQ.
So how much should investors look past it and consider this an opportunity?
So the real opportunity is 5G. And if you think about the 5G experience for Apple, in 2020, it was about getting a faster processor mobile device into consumers' hands and letting them leverage their home Wi-Fi. So the good news is, as the vaccines take hold and as you have greater mobility and a greater build out of the 5G network, I think this is going to result to a different experience for the consumer and a positive one, meaning having a smarter processor on a faster wireless network. And the good news for Apple is there's still a lot of discretionary spend to go for Apple's products when you think about either elevated savings rates or the fact that consumers are still spending less money on travel or food away from home versus 2019. So I think the setup here on 5G is still excellent for Apple.
Tom, we could talk about 5G, and certainly that's such a big transformational, connectivity push, not only now but in the years to come. But the other piece for Apple, specifically the services piece, how big of a deal is it to see these fights, these legal fights right now over the App Store and antitrust scrutiny?
So it is important, and antitrust scrutiny for Apple, Amazon, Facebook, and Google is something we're monitoring closely. So if you think about Apple's advancement in services, and you think about essentially the revenue share for Apple with app developers or content providers, that could have a material negative impact on Apple's revenue growth in the future. I think, again, the good news, though, in 2021 and 2022, and likely 2023, is you have a multi-year cycle with positive unit growth for its most important product, the iPhone, from a revenue and profitability standpoint. So even if it has to give less or share less revenue with the content and app developers, selling more hardware may more than offset that.
Apple Car, is it going to happen? Is it a good thing long term?
I'm a believer that it will happen eventually, and I do think it is a good thing. When you think often Apple isn't the first to enter a market, but they find an opportunity to enter the market and make a premium product that's easier to use, things of that nature. So I do think long-term there's room for an Apple Car, yes.
Yeah, definitely a longer-term story, though, Tom, as we try to ferret out any kind of early details. Great seeing you. Thanks again, Tom Forte.
Thank you, Carl. Thank you, Morgan.
All right, well, we're going to stay with the tech stocks. Our next guest is laying out the best names in the sector to invest in through this volatile recovery. Let's bring in Morgan Stanley's analyst, Brian Nowak. Brian, thanks for being with us today.
Of course, good morning. Thanks for having me.
I see you put out this report. It's a two-part series, the quote-unquote recoveries and the not just shelter ends. Break it down for us, I guess, starting with the recoveries. What do you like in terms of being able to play the recovery from a tech standpoint?
Yeah, I think, in the recovery names, when you think about travel, ride share, and essentially experiences that people are going to have as they reopen, we think a lot of these names have already priced in pretty large 2022 recovery scenarios, bookings in travel, et cetera. So the way I like to play it is the dark horse play around Alphabet, Google, because 10 to 15% of search is actually associated with travel. And so the extent to which the online travel agencies like Booking, Expedia, and the hotels want to get people on their sites, they're going to be spending money on paid search now. So I like Alphabet as a dark horse travel recovery. And then Uber, about over 55% of Uber's rideshare business is associated with going out, restaurants, bars, traveling, going to airports, et cetera. And so as the world reopens, we think Uber's rideshare business is also going to really reopen. So from a recovery perspective, I'm selective, essentially liking Alphabet and Uber the most.
Why Uber and not Lyft? And I ask that because I realize Lyft is more of a North American story, Uber's more global, but you are seeing some of these employee or I guess contract worker regulations take shape in other key markets like the UK, for example, where Uber specifically is concerned.
Yeah, and the headlines and the debate around global regulation of the shared economy are not going to go away, and I wouldn't even say long term they necessarily be gone from the United States. So I wouldn't say Lyft is immune from those discussions over the next 2-3 years. Now the reason I like Uber more is because big picture, I like the platforms that have multiple products, so rides, eats, grocery delivery, alcohol delivery, pharmacy delivery, to drive more user frequency and more engagement. And I also really like Uber's focus on building out a subscription business, because the more Uber Pass subscribers you have in the ecosystem, the more likely you are to build a really sticky user base that, in my opinion, is just going to lead to larger overall bookings across the whole ecosystem, more free cash flow, and actually long-term potentially make it more difficult for Lyft to compete against Uber, given Lyft's single product focus.
Brian, on Amazon, I know you've talked about the market being focused on comping the comp, to use your words. I'm curious if you can talk a bit about that, and also what would it take to get to your bull case of 5K?
Yeah, good morning, Carl. Yeah, so comping the comp has been the discussion on Amazon for the last 6 months, where the investors are concerned about the slope of the deceleration in U.S. consumer expenditure on Amazon as the world reopens. And the way I think about it is, when we look at Prime subscribers, we think Amazon added a record number of Prime subscribers last year. Our analysis shows that Prime subscribers actually age incredibly well from year 1 to year 2, year 3. You spend more, you shop across more categories. And so I'm not as concerned about a steep deceleration down to single-digit growth or a decline in expenditure on Amazon. I would just look at your own credit cards, your own credit card bills the next few months, and see if your spend on Amazon actually declines year on year. I'll take the over and say it grows double digits. Now, if Amazon is able to grow U.S. consumer expenditure double digits this year, we see a lot of paths toward $100 billion plus of free cash flow in 2022. And Amazon historically trades around 21 times free cash flow. The extent to which you get $100 billion, that's $4,200 a share.
Yeah.
If expenditure is actually does not slow down as much as we think, or if they have more leverage than we expect in the model, given how big they're getting, that's how you get to the $4,500, $4,800, or $5,000 a share 12 to 18 months from now.
Yeah, of course. Amazon is also becoming a little more of a space play, too. I think there was that AWS news out, the accelerator, space accelerator news out just yesterday as well. As a side note, but you do have Amazon in your not just shelter-ins bucket. What else is in there? Especially as we talk about this reversion to the mean rotation that we've been seeing in general.
Yeah, I like the video game companies a lot. So Activision, Zynga, and a smaller company called Playtika. These video game companies, they are really viewed as just being shelter-ins, and this is the classic not just shelter-in. We in 2020, we think that we pulled forward about 4 years of new video game user adoption. 50 million new Americans came into playing video games last year, as opposed to the average of about 10 million. Some people will churn away as the world reopens. But we essentially think that the market is overestimating how many of these people are going to leave gaming and never come back. Gaming has been in structural growth, and essentially we just pulled forward that growth. And so the overall user base is a lot bigger. And the innovation at some of these companies, like Activision, around titles like Call of Duty, what we think is coming with Diablo, what we think is happening in a lot of Zynga's titles like Harry Potter, that just drives more user retention, spend per user, and just more free cash flow. So I would really look at some of these video game names that have just, the multiples have compressed by 20%. The market is saying the best is behind us. We disagree with that.
All right. Well, Brian, thanks for joining us.
Great. Thank you so much.
Still to come, the reopening trade, airline stocks rebounding big. We'll take a look at the pent-up travel demand post-pandemic. Plus, President Biden preparing to unveil his $2 trillion infrastructure plan. We've got the details ahead of that event later today. Squawk on the Street will be back right after this.
A lot of news on the airline front today. Take a look at American, JetBlue, and UAL for the year to date, as the top CEOs are expected to give an update on demand. Phil LeBeau's got his hands full and is back for more. Hey, Phil.
Hey, Carl, when you take a look at how many people are flying, it is clear that the upward trend, it's expected to continue at least through the spring, well into the summer. Take a look at passenger levels now. It may be a little hard to tell from this chart, but they have increased. In fact, in March, the passenger level, just over 1.2 million passengers per day. That's up about 40% compared to the same volume or the same time in February. So what you're noticing is there is a steady increase in the number of people who are flying. Airfares, they are moving higher because demand is moving higher, up 12% between now and June. That is the expectation according to Hopper, which tracks airfares and then also projects this is where they believe airfares are headed. By the way, they're still not at pre-pandemic levels, down 15 to 20%, depending on where you are flying compared to 2019. So the airlines, while they are charging more, they're not back to where they were back in 2019. Take a look at Southwest and Alaska. We're showing you these because these guys in the news over the last week, as Alaska yesterday finalized the commitment that it made to buy more 737 MAXs with Boeing. They made that commitment in December, finalized the order yesterday. And of course, earlier this week, we had the news from Southwest. And as you take a look at Boeing, it has now had 270 737 MAX orders or commitments since December. So clearly, they are seeing the change. The tide is turning from cancellations outweighing orders and order commitments. That is now swinging the other way. And we saw that last month, in the month of February, that you had orders outpacing cancellations for the first time. Finally, take a look at the Dow transports. We mentioned this earlier today, a record high yesterday. Let's see what happens today as the transports under a little bit of pressure, not a lot, but it was at a record high yesterday and up 17% this year, Carl. So nice move for the transports. And a lot of people were looking at this and saying, boy, what's happened since the beginning of the pandemic? Up more than 100%. So it has really been the one place to put your money, Carl.
Yeah, and to your point, Boeing outperforming the trannies year to date. Interesting, Phil. So much news on your front. Thanks once again, our Phil LeBeau. As we pay attention to the summer travel booking picture, take a look at these results from the new CNBC stock survey. We asked people which stock they would rather buy over the next 12 months. Hilton had 50%, Airbnb 31%, Live Nation nearly 20%. With more on the state of the travel industry, let's talk to Hopper co-founder and CEO Frederic Lalonde. Frederic, thanks for the time. Great to see you again.
Thanks for having me.
I wonder if you can just quickly zero in on airlines, because to Phil's point a moment ago, the booking picture has gotten so much better. The capacity picture, maybe not as much. And I just wonder when that resolves and what happens to fares in the meantime.
Yeah, we're definitely seeing a surge. As you know, the Hopper app tracks all of shopping globally and obviously in the US. And since the beginning of the year, we've seen a 58% increase in just shopping, which is basically demand for domestic travel. The airline prices, as you were previously pointing out, have recovered from their absolute low about a year ago, but they're still not back to pre-pandemic levels. The demand is predominantly domestic for obvious reasons, because the markets internationally are just not open right now. So if we look at 2019, we would have had about 60% of the 50% of the demand being domestic. This year, it's closer to 2/3, so 66%. All prices are going up. So anybody who is thinking of planning a trip right now should be looking to book as soon as possible and to load as many flexibility options on refunds as possible, because there's still a lot of chaos around the airline capacity.
Right. Are you able to decipher what is leisure and what's corporate at this point? I don't know, even maybe slicing fare structures. I just wonder, how are you reading whether or not corporate travel is catching up with the obvious strength in leisure?
The easiest way to look at that is weekend stays, because corporate is predominantly within the week. And we don't have specific numbers out on that, but corporate travel is nowhere near back to leisure rebound. For obvious reasons, companies are still wary to just having people travel on their behalf. So all of this surge in demand is coming from the leisure side. We actually saw a direct correlation when the Biden administration's stimulus checks came out. There were record booking numbers on the couple of days that followed that. And we also have seen demand tick up, for example, for the 4th of July holiday, specifically around the announcement around the vaccine. So the recovery is almost predominantly being driven by leisure right now.
Surprised to hear that regarding the correlation with stimulus. We just talked about airlines, and we talked about where you're seeing the demand come back. Those CNBC stock survey results that were just cited by Carl, are people booking in Airbnbs and home rentals? Are they booking in hotels? Are they taking out rental cars? And I ask that because I'm looking at the Avis stock. It's doubled since the start of the year.
Yeah, that's correct. If you look at Hopper as a marketplace, so we're the largest travel app in North America, so we actually have quite a bit of a footprint there. Car bookings are up 150% since the beginning of the year. So that has been surging. Obviously, shorter trips, mostly driving, a couple of hours away from where you live, was really the dominant trip pattern. Also, because homestays, including Airbnb, are safer, or they're perceived as being safer by the customer because there's no common areas, that was actually the homestays did a lot better than traditional hotel rooms. However, we have seen almost a complete recovery in hotel demand, especially for destinations like Phoenix, Miami. So basically anything that isn't directly correlated.
Oh, yeah, guys. I am back. What a first hour we had. Good Lord. First of all, I want to appreciate that I've already gotten 12 views. That's the most I've gotten on these live streams in the first hour. So crazy, crazy appreciate that. So if you are new, thanks for joining. It might seem boring, but we just get to watch TD Ameritrade and CNBC every day and every now and then I'll chime in with some sort of commentary about what the hell's going on in the world. But if you do want to, I absolutely encourage you to subscribe. It just helps my channel for nothing other than just to help other people that want to find this channel. So and want to find what we're doing here. So if you hit subscribe, you hit the like, all that does is help the algorithm push this out to a few more people, get more impressions on YouTube, which then gets more people to watch, which then gets more people to engage. I've also seen more people engaging in the chat the last couple of days, and that's encouraging for me. I really like it. So real quick rundown of what I've seen here in the first hour while I've been on this meeting over here. The NASDAQ is crushing it, up 1.5%, which is fantastic. It was due for one of these days, and I kind of felt like today may have been the day. That's of course why I've got the title and thumbnail already in there. The futures look really good. Basically, any tech stock is looking fantastic right now. Not any, but the majority of tech stocks are looking fantastic right now. We were looking at Chewy there on the top graph for a little while. Had their earnings yesterday, knocked it out of the park in their earnings. It's still knocking it out of the park going forward today. So if you bought Chewy yesterday morning during a little bit of a dip, you had a really, really awesome return. Tesla also in the bottom left-hand corner, also a huge dip yesterday, got down to like 590, and now you're seeing it at 565, got rid of 660, sorry, at one point this morning already. So a huge return for those of you that got into Tesla earlier. You're probably looking at, what would that be? 11% return just in the past 24 hours. So it's really, really awesome. So good for all of you guys that have got, oh, do I have iBuy? Talking about iBuy, that's an ETF I bought a long time ago. I can't remember if I still own any shares. I might have sold it. Yeah, I don't think I have eBiz, but I don't think I have iBuy anymore. No, I do. Sorry, I have 6 shares in iBuy. Yeah, I mean, I'm up 34% on iBuy. I think it's a decent one. eBiz and iBuy, both of those are ETFs related to e-commerce. Can't go wrong with e-commerce ETF. So I bought a few shares of each, not much, but just a few. And then I don't even know all the stocks that are in it, but if it has things like Amazon and Chewy and a handful of others in their ETF group, then it's a pretty good position to be in. Not just now, not just in the pandemic and recovery, but also into the future. I think that's a good investment. I also have there in the title what's going on with OMI. OMI, economy, whatever you want to call it. I can't even tell you everything that's going on. So if you're in the comments and you want to leave a comment on what the hell is going on, you're probably going to have a better way to describe it than I am. I know nothing more than a little bit of research I did regarding the, what is this? A little bit of research just of the buzz that I've been hearing about it. I guess something along the lines of Logan Paul. I don't know if he's part of it or investing in it or something, or he just is going around promoting this new cryptocurrency and crypto platform. It's not really, I don't even know how to say it. It's not a platform, but it's like an NFT exchange type of thing. And again, I'm describing it completely wrong. I totally understand that. But so there's a expectation because I think right now, probably more than anybody, Logan Paul is probably the cryptocurrency influencer of choice right now, right? For better or for worse, if he decides to get online and pump a certain type of cryptocurrency or really almost anything, he's probably the guy. Outside of him, I suppose it would be Elon Musk. Now, I'm not saying that Logan Paul has any more credibility than Elon Musk, which he doesn't, but I think Logan Paul has more millennial and young followers than Elon Musk. And so when it comes to Bitcoin and other highly speculative things, Logan Paul might actually be able, I shouldn't say Bitcoin, I should say cryptocurrencies and highly speculative other cryptos and stocks. He might have a huge, huge amount of influence, possibly even more than Elon Musk, which is bananas, but definitely more than someone like Warren Buffett, which is even more nuts. But I mean, it is what it is. We're seeing he is probably single-handedly reviving the Pokemon collection craze throughout the world here just in the last 12 months. So he's as much as I don't necessarily like him as an influencer or creator. Just he's just not my style. I don't have anything personally against the guy. Um, he's he's pretty damn good at figuring out how to make money and promote money, and he's done an amazing job at that the past year, especially during this pandemic. So anyway, that's just my quick rundown of the morning. The Nasdaq's still up 1.5%. Everything on my portfolio, just about everything on my portfolio, up. Finally glad to see Zoom going up. It's only up 2.5%. Gee, it's just gotten slaughtered over the past, what, ever since turning crypto, so 3 or 4 weeks. I'm super, super glad to see that going. Squares up 7 to 8%. So a lot of these that I bought like 3 weeks ago, right at the peak, are finally coming back around. That's why I put in minutes of W shape recovery in the comments. I'm really hoping we're on the backside of a W shape recovery, which means that, because it's been highly volatile W shape over the past month. So we'll see if today can be a 2% day. That'll be an incredible day. I don't expect it to be a 6% day, but if it can be a 2% day, that's good. And then follow up with, going into April, a good month in April overall. If we can do March and April the same way that October and November were last year, I'm totally like I would be totally cool with that. Like last year October sucked, this year March sucked. If next year or last year November was banging, then let's make April this year banging, and then we'll all make tons and tons of money. So that's what I'm hoping for. If we take a quick look here at the meme stocks that I've got on there, of course we love tracking those. AMC on the big board, still not doing anything here. It's only down 1.8%. But AMC is acting like a normal stock over the past 2 months or 2 weeks, not seeing any volatility. Uh, Decent amount still in GameStop, but it's down a little bit. Cost down 4. And Express is up 1.2. Come on, Express. Express had a huge bump right there. That's crazy. Was that yesterday afternoon? I didn't even notice that big bump yesterday afternoon. But, oh, I remember. Yes, I did. The chart looks weird. I remember it now. Yeah. I remember talking about it at the time. But man, if Express can come back around, get this, let's zoom into this chart. So we're actually looking at just today's charts on all these, because on these things we forget about yesterday, we only focus on the now. So yes, I need Express to run. Run Express. He still get up to 8. We need to get Express up to 8. And then we can all add our tickets. All right. Oh God, more mask mandates getting thrown out. Let's see what they have to say about that.
Health Organization says that it remains comfortable with the AstraZeneca vaccine, even as Germany pauses giving it to people under 60 due to blood clot fears.
The benefit risk assessment for the AstraZeneca vaccine, given the range of evidence on both efficacy, effectiveness, safety, and quality manufacturing, that it still weighs very heavily in favor of the use of the vaccine. It is a safe vaccine.
And take a look. This is apparently what an illegal rave looks like through the lens of thermal and infrared cameras used by police in the UK. They broke up a party being held in violation of COVID rules under a highway bridge. This happened last weekend near Birmingham. 22 people were fined. Okay, you're now up to date. More Squawk on the Street continues after this.
This afternoon, we do expect to hear from the president outlining his infrastructure plan later on today. Roger Altman joins us this morning. Evercore senior chairman and founder joins us to talk about what we might hear and what might drive the policy from this point on. Roger, it's great to see you. Welcome.
How are you, Colin? Nice to see you, too.
I'm good. This is getting interesting now because we're actually talking about components, the heavy stuff like roads and bridges, the lighter stuff like some of the digital infrastructure, and some of the pushback, Roger, from the U.S. Chamber, from the Business Roundtable about how they really don't want to see corporate taxes go back up. What's your overall roadmap of how this is going to work?
Well, first of all, let's focus on the spending side. Almost every American thinks that the nation's physical infrastructure needs to be fixed. I just don't run into anybody, whether it's going to get a cup of coffee or getting on the subway and listening, who doesn't think that the country's infrastructure is run down. And we're way overdue, I think. And I think most Americans think, in having an initiative which focuses on rebuilding that, which focuses on science and R&D, which focuses on American competitiveness, rebuilding our supply lines, refocusing on domestic production, And if we ever needed a signal on that last point, it's the current chip shortage and the geopolitical vulnerability of Taiwan. I mean, that is a tremendous risk. So I think the idea of this, Carl, the idea of a really large infrastructure and competitiveness initiative focusing on certain future things like vehicle electrification, climate mitigation, and so forth, I think this is the right time for this idea. Now, on your question, it's not surprising at all that the Business Roundtable and the Chamber don't think that raising taxes on the corporate sector is sound. I mean, that's not exactly surprising. And there'll be quite a debate over the various components of the Biden tax plan, which are just now coming out. But 5 years ago, at the end of the Obama administration, the business community was pretty well agreed on cutting the corporate rate from 35 to 28. I don't mean to say everybody thought that was perfect, but there was a widespread agreement, as I remember it. So coming back and saying, oh my gosh, 28% is a terrible idea, I think is a little questionable. A big part of this plan obviously involves foreign taxes, foreign tax liabilities, broadening the base on foreign tax liabilities and so forth. And there'll be a huge debate about that. And by the way, I think you saw that the administration signaled flexibility on how to pay for this, because Press Secretary Jen Psaki said something to the effect that there's a lot of ideas out there and we're open to hearing them. But
I wonder, Roger,
as to the, go ahead.
No, I was going to say on the tax issue, I'm reading a report this morning from DataTrek, one of the boutique firms we follow, and they say we've always been of the belief that markets never believed the Trump tax cuts were going to be permanent, and as a result, it doesn't change what they say is their own bullish outlook. Do you think that's true? Did we always have this notion that those tax cuts were going to be sort of or that tax level was going to be more cyclical than structural?
I'm not sure about that, but I would say that markets seem, to me at least, to be anticipating the corporate rate increase that the president is going to propose in a few hours. And I'd be quite surprised if that alone was seen as a big surprise or destabilizing from an equity market point of view. Whether 5 years ago, 4 years ago,
let's go, NASDAQ up 175. Please, let's make this happen.
Interim, I'm not sure, but I don't think the Biden proposal
Portfolio is looking
is a surprise and
like a
will be
rock
destabilizing.
So, Roger, when you take this
We're
first part of the
4,000
Build Back
points off
Better
of where I
plan
wanted to be.
around infrastructure, surface transportation,
Ooh,
etc.,
I'm
and then
hoping
especially if you factor in
some of you
what's
guys
expected to be a
bought these
second part of
dips.
the plan
I'm
around
hoping
so-called social
because
infrastructure, real
I,
talk here, how much of this is going to end
I
up in
don't think that we're
reconciliation?
going to have the year in
Well, I think,
technology that we
I
had
think
in 2020.
there's going to be a
We
considerable
might,
effort because it's infrastructure and because
but I don't think it's going
historically
down either.
there's
I
been
still
some
think we're in
bipartisan approach to infrastructure.
I
I
still
think
think
there's going
we're
to be
in
a
a
big effort
place
to
where we're
see
just at the cusp
if they
of
can
the
pass
future of the
this
next
second
version of
component of the
technology.
Biden plan beyond the COVID relief
Everything.
bill
So
on a
we call that Web 2.0
bipartisan basis
or
without resorting
planning
to
correctly.
reconciliation.
I don't care what you
However,
call it.
that
But
may be
technology
a
stuff,
stretch.
I don't care
We'll
what.
see.
As long as
And
it's
if
a
it is a
good,
stretch,
sustainable
I
company,
think they have the votes
I
to
feel
do
like I
most
don't
of
care
this
what I buy.
on reconciliation
Eventually,
and a
it will
51
be a
vote
great
basis.
investment.
So I think
I
most of this
honestly
plan
feel that about
that the president's
any
unveiling today,
good,
and
sustainable
there'll be changes, there'll be
technology
negotiations,
stock right now. I'm
but the
not talking about
core of it,
speculative
I
stuff
think, is going to
or
come into
heavily
reality,
leveraged
whether it's done
IPOs or
on a bipartisan basis or
I'm not
perhaps
talking
more
about those kind
likely
of things.
on the
I'm
basis
talking
of
about like
reconciliation. I think it's going
good,
to happen.
standing, profitable.
Finally, Roger, we only got a couple seconds, but we've kicked
where
around
they
the
have
notion of inflation pretty well over the past couple of months. I
it's
wonder,
everything.
to what degree are you looking at yields
I don't care
with
if
raised
like
eyebrows,
Square, for example.
and what's
I
your
bought
sense
Square.
about whether Powell's
It
going to be proven correct that
immediately
some of these spikes,
2
and
weeks
Kimberly Clark raising prices today as an
I do not
example,
care.
is going to be
I do not
transitory?
care. If
I
I
think the
wasn't in
chances
margin,
are,
I'd
Carl,
buy
that
a little more on the dip.
Jay Powell will be correct.
And
As you well
dollar
know,
cost average
and
that
you've
down
covered
because
this
I
very
know
well,
it's going to continue to go.
his
Same
position
with
is we
Redfin.
may see
Exact same thing.
some
Same with
uptick
Zillow.
in inflation over the next year or two,
What Zillow
but
and
he
Redfin
thinks
are
it will
doing.
be
I don't think
transitory,
Zillow and Redfin
and
is
monetary policy
are
needs to
actually the
incorporate
future of
that
real estate. I
transitory
don't know what the
aspect.
future of real estate
I think
really
that's
is.
likely to be the case.
but I think they are
Of course,
a precursor
none of
for
us
what the future of
can know
real
for
estate
sure,
is. They're positioning
but the
themselves to be
10
the
year
future
at
of real estate, where
172, I believe it
buyers
is now,
will be the future of real
and
estate.
the
And so
futures
I think
suggesting
those are two
that the inflation risk is relatively moderate, as
opportunities.
you well
Having
know.
said that,
So
I'm down.
you have to be
I'm down
vigilant about it, but I
23%
think
on
Powell
there.
is more
Even
likely
though
to
it's
be
up
right than
3%
not
today, I'm
about
still down
it's being
23% on my
transitory,
position. But I do
and that
not care. I
monetary
still think it's
policy
a
needs to
fantastic
be
investment. Let's see
needs
what
to
else we're
be
seeing.
careful in terms of
Peloton's up
overreacting.
5.2% today. Okta is up 5.36%.
Markets sure got a rich diet of debate in the quarters ahead, Roger. It's great seeing you. Thanks again. Good to see you.
Very strong. We had bought and sold Okta on lock last year.
Well, take a look at
And my current
Shopify.
hold
That's up about
it's up.
5, almost 6%
It looks
right now.
fantastic.
Stifel initiating
Ooh,
coverage
look
and
at
stock with a
Shopify.
buy rating and a
You know what
price
I
target
don't
of
have is Shopify. I'm
1,200,
not opposed.
saying the e-commerce platform
I
is
think
positioned
that's
for
up there with
sustainable growth supported by
Airbnb as far as like
international
a
expansion
platform
and the
that
development of
can
additional
be
products and
can still have a
services.
fantastic
It's Buck
future,
on the Street. We'll be
fantastic
right back.
upside. More so than just a company. Chewy is a company. Shopify is a platform. But I don't know if it is, but like Chewy could be built on a Shopify page. Like that's where I think that there's this great ability for Chewy to be, or for Shopify to be, an awesome investment. Similar to like WordPress. I've said this before, that if the people who founded WordPress really planned for it to be a world domination of service and platform like it is, I mean, good Lord, they'd be the richest people in the world. If WordPress, I don't know if it was founded as a nonprofit or as a open source thing. I mean, they make money now, but I might have been open source from the get go, and so their position was never really to make it this highly profitable technology. It was really just for the better of the people and the better of the internet, which is fantastic. We love that mission. However, if they had chosen for it to be a highly profitable company from the get go, and I'm going to start charging for it from the get go, holy crap, they would. I can't imagine them not being the richest people in the world and one of the most valuable companies in the world, because of how much they use, how much use there is, and not just how much use there is, but also, I don't know what that was, but also if they could find other ways to monetize their infrastructure. I think that's one of the things that Shopify does really well, is you can buy and sell products on their platform, which they're going to charge between 30 and $100 a month for each store, but they're really making money.
A top tech investor says the group has fallen out
Other
of
types
favor, but he has a plan B.
way more
Those
than just
details on
$30
tradingnation.cnbc.com. We're squawking the
And if
street
WordPress
straight
did the
ahead.
same thing, if WordPress started or owned or something like that, Square, or competitor to Square, then boom, they would just knock it out of the park, because they have the user base, they have the infrastructure, they have a platform. Now they just have to monetize that platform. I mean, WordPress would crush the rest of the world like a cockroach if they were a highly ambitious, scalable, for-profit company. So some BS commercial break. Holy cow! Like, this is why I hate watching CNBC, especially their morning coverage and their closing bell coverage. Their closing bell coverage is great, but they go to commercial every freaking second, and then they come back. They give you another cliffhanger headline, and then go to commercial again. I can't stand it. Just like they just did. So anyway, that's why most of the time during the midday, I'm over here at TD Ameritrade TV, because they don't. I mean, the commercial breaks stay, and they actually talk more about stocks and all that, without just making it a quote morning show like Kramer does. Which again, I love Kramer, not really dissing him altogether. I just think the show turns into a zoo. So that's the unfortunate part. Anyway, I'll turn it down. I'll turn me down, turn them up, and let's just continue to watch that market. I'm super excited about today. I think today's got a great day to do something fantastic.
Fed's got rates at zero and they're buying bonds, and we're going to run up the debt and deficit to do this. And then you have dollar negative as part of that story. You have, at least in theory, supposedly gold, Bitcoin positive.
And this time around, it has a little bit of a different nature, right? So maybe we see a different type of results on the market.
Well, I think one of the biggest differences is going to be that this is going to be job positive. It's not like we're just, like you said, depositing checks and sums of monies into Americans' accounts that are largely unemployed or significantly suffering as a result of the public health crisis from COVID. The infrastructure plan will likely be a large net positive for the labor market, which the Fed has continued to say is far from robust. So although we know that it's going to be funded, we don't know the details yet, but it'll be funded by an increase in corporate tax rates, probably going back to 28%, somewhere in the middle between what Trump cut it from 35 down to 21. Analysts so far from a lot of major economic institutions have said that it's probably going to reduce EPS by maybe about 9%. You have to put that in the context that growth is going to be surging this year. So I think it's largely going to be offset if things shake out the way that they're laying right now. I think one of the things you were talking about with Nick is why are we seeing this big move in some of these names that are likely to be hampered on balance from this is you have to look at the rotational flows going into the end of the quarter. Growth has underperformed value in the first quarter by 20%, 20%. That is insane. So we are certainly seeing some of the selling in value, bidding in growth today. I think we've got a great seasonal tailwind coming potentially in April. It's one of the best months for the S&P going back to 1964, up 1.7% on average. And I think the technicals are looking more constructive right now.
Yeah. Hey, speaking of the fundamental economy, I want to come back to the technicals in one sec, Mike, because I know you got a chart for us looking at tech. But Nick, just to put our economic situation into perspective, because tomorrow is a big day, given that we've got jobless claims and then that we're off on Friday, markets are closed. Today we got a nice Chicago PMI. Tomorrow we get the PMI manufacturing for the country. We've got construction spending, ISMs as well. What are you learning here over the last couple of days, Nick, as far as data and what we should be looking for in the numbers and the response to those numbers tomorrow?
Yeah, and one more to throw in a pretty big dip in pending home sales this morning. So it sounds like that's more of a supply side issue there again, right? So I think you talk infrastructure and building up communities, and there's this huge push I think for that, and so much of what's in this plan I think too, just to think long term is about climate change and inequality, right? So there's a lot of to Mike's point, I think there's a lot that's going to get paid for through kind of the engagement in the workforce here, and you're seeing that in a lot of these numbers, right? You're seeing that in the home sales. We need more homes, right? We're seeing that in some of the spending numbers, and I think that's going to increase inflation. Yes, as goods become more in demand, but again, the Fed's giving that guidance that this isn't going to get out of control, and we have the tools we need to control it. So. Jobless claims tomorrow, not looking for anything that's going to really move markets a whole ton. I've said it all week long. Be careful. Know that Friday is a holiday, right? Know that there is the unemployment number Friday morning, and futures are only open for about 45 minutes after that number comes out, and then everything shuts down for the day. So make sure you're correctly positioned and watching your risk going into that, because things do expire early on Thursday, and then you have the number on Friday morning with no real ability to trade that outside of the futures market, and then we don't reopen again until Sunday night. So just keep a close eye, because it is a shortened week.
Okay. Hey, Mike, on the chart, give me the look at the tech sector. You're looking specifically right at S&P 500 tech.
Yep. Yeah. So I think it's important to look, before we look at the S&P 500 tech sector chart, you need to take into context what has happened within the NASDAQ's longer-term breadth momentum. It has gone from a really robust level and dipped all the way back down into negative territory. That tells me that positioning has been cleared and length is largely flat. So that really sets the table for a potential bull run. It also sets the table for it to deteriorate further. But looking at the S&P 500 technology chart right here, it is shaping up to break out of the upside of that narrowing triangle, or that downward trend resistance. So we're getting a move higher out of that today. I think you really would want to see those peaks in early March taken out to really validate this breakout. But so far, intermediate momentum and near-term momentum, both of those lower panel indicators, are looking more constructive. So right now, it's looking like it's going to be a positive move out of these. The moving averages are being breached, et cetera. So we'll see if it can continue into the end of the quarter today.
Okay, so looking for potential kind of breaking of that downtrend that's been happening from the February highs for the NASDAQ. And then if we don't get through that, Mike, we still kind of have, it seems, some time for this to continue moving into that sort of wedge that you have.
Yeah, and you know what? I really think, like I've said many times before, Ralph Akinpour, legendary technician, says rotation is the lifeblood of a bull market. And yes, technology has really suffered in the first quarter. It's actually the third weakest sector behind utilities and staples. So you really wouldn't expect to see that. So it hasn't really been negatively affected. It's not negative. It hasn't dropped anything like that. It just has underperformed. So if we can get this outperformance to continue into April, into the seasonal tailwind, you might see that growth trade become reinvigorated, as I think that reopening trade has gotten a little ahead of itself.
Okay. All right. Thanks, Mike. Appreciate it for the chart. Thanks, Nick, for the thoughts here on the market and the fundamental backdrop for the economy. We've got Fast Market coming up next. Let's check back in with Alex. What are you guys trading today, Alex?
It's going to be a great show. It's been a bit of a carousel of co-hosts this week with Kevin being gone, but we got Tom White stopping by, so always great to get his perspective. Anthony Panzica is joining us as well. We're going to be unpacking Apple, Tesla, and then we're coming back to Micron, covering the earnings and looking at an example trade in Micron ahead of that report. So it's going to be a great show. Looking forward to it.
All right. Going to look at those Tesla numbers in detail after today's big bounce. Did we get some follow through? So far, so good. Pretty big rip in the Qs. Thank you, Alex. Fast Market is up next. Thank you for joining me here on Morning Trade Live. I'm Oliver Rennick. I will see you this afternoon for Market on Close.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Good morning and welcome to Fast Market. It is Wednesday, March 31st. I'm Alex Coffey. I believe I said yesterday was the final day of the quarter. Might have gotten confused with the amount of days in March, but I am certain today is the final day of the quarter. There's plenty to unpack here. Let's start with where things sit 90 minutes into today's trading session. A bit of a different tone here for equity markets. You look at the NASDAQ today, way out in front, 1.75% to the upside, 227 points in the NDX, the S&P 500 up 24, the Russell 2000 up 21, and the Dow Jones is just barely over the unchanged line, currently 8 points to the upside. That is about 0.02 of 1 percentage point, but it is green, and we will take it here as we're kind of at that halfway point for the holiday shortened week. But a couple things I want to focus in on here, guys. If we can pull up the trading platform, we may have to take a second. We'll do that in just a moment. But if we can pull up the NASDAQ 100 on a 1 day, 1 minute chart, you're going to really see that we ramped up really right at the open for the NASDAQ, and that's really where the price action began to unfold here, and you can see it on that chart if you pull it up. And so it's so incredible just the amount of strength that came to the market right at the open, and that's really driving a lot of this price action. But let's dive into it more. To help me do that, I want to welcome in, filling in here this morning for the regular co-host Kevin Hinks, is Tom White. Good morning to you, Tom, the unofficial third member of our Fast Market crew here. And then joining us on Wednesday is Anthony Panzeca, the co-host of TD Ameritrade on Twitch, as well as a senior specialist on TD Ameritrade's margin risk team. Anthony, I'll give you the first thoughts here. This is a market that reminds me a little bit more of the market of yesteryear, one where the mega cap companies, which we're going to spend plenty of the show talking about today, are outperforming and really driving this market higher.
Yeah, and you're seeing it carried through all the FANG names, right? Facebook, Google, Netflix, NVIDIA, and today we're going to talk about Apple. I feel like that Apple upgrade was a really big jolt to the market. Stock's up now I think about $3. So that's adding a lot of weight to the NASDAQ composite as well as Dow and the S&P 500. So that's been a really big driver. And yeah, we are seeing another run into a lot of those big FANG names. And we're really seeing, if you look at a year chart, this could be, we kind of hit like a few weeks ago, like back in mid-February, we hit the 52-week, really an all-time high in the NASDAQ. And we've kind of sputtered around a little bit since then. But, you know, I think that there might be hope now that we continue this bull run that we've been on for quite some time. So I think a lot of investors are hoping that this could be a return back to those mega cap names and really driving the markets higher, guys.
Yeah, I think Alex and Anthony, if you take a look at what's going on in the market, its reaction to the 10-year yield is what we've seen over the last couple weeks, a couple months here. Is we're seeing a little bit of a reprieve in those yields rising. We did hit the 1.77% on that 10-year yield, 14-month highs just yesterday. We're seeing a little bit of pullback there. You're seeing the Dow relatively flat, but you've got basically those bank names holding the Dow down a little bit, even though we've got some gains in Apple and some of the other big names within that index. But I think if you take a look at it, the market's going to continue to react to what the 10-year yield and what a rising yield environment looks like. And then towards the end of the day, we've got anticipation for President Biden to come out. He's going to Pennsylvania to give details on his infrastructure plan, around $2 trillion worth paid for by tax increases on the corporate side, moving up to 28%. And then also you're going to see that trickle down to the everyday person. And they said anybody making over $400,000 now, that's a family as opposed to an individual. So we'll get more details on how they plan to pay for that. But I was pretty surprised we're seeing some weakness in Caterpillar and Deere and some of the other 2021 winners here on that industrials and material side.
Yeah, it's a great point, Tom, and you really kind of do see almost like a buy the rumor, sell the news type of an event playing out there. Another couple interesting movers that I saw on the board. You see some dollar weakness finally after a huge move higher in the dollar over the past week or so. Finally, a little bit of a relenting of that move. You can see it over the last week, 5 days, 15-minute chart. $ DXY had been on a tear to the upside, pulling back a little bit. That is helping the gold market, which is bouncing back after it's been in a bit of a free fall action. You can see that over the last week as well. And then crude oil, again, just continues to be a whipsaw, guys, back and forth. And now we're not even waiting the full 24 hours. You're getting that on an intraday basis as well. So those are some more of these asset classes to keep your eyes on. But I want to do some trade management here, guys. We still have a few earnings names trickling in. Tom, I know that we're going to unpack Micron at the end of the show. Kevin and I always comment that Nike kind of marks the unofficial end of the earnings season. Well, it was a little early this quarter because we still had some trickling in. Let's talk some Chewy, and then we're going to look at Lululemon. This Chewy trade's looking pretty interesting here, Tom, because we have the double calendar on. We only did a one lot, but with the stock moving higher here, we had the 85 call calendar on. We put this on Monday. Well, the stock's trading 87, so things are looking pretty nice in terms of where this is shaping up to be. But we still got a day to go for expiration, and the put calendar side, of course, it isn't working out. So up about 50 cents on a one lot on this trade. Sometimes you got to set your expectations on what you may be able to make, given that it is a smaller trade, only a one lot on a calendar spread.
Yeah, and I think if you take a look at a trade like that, are you doing it for earnings or are you doing it for a long-term play? I mean, going into these type of trades when maybe you have a day left, maybe you have a week left, do you take the profit now? Well, I'll guarantee you that Chewy, after those reports, we're seeing a lot of analyst calls to the upside as far as price target hikes. Does it get an upgrade tomorrow? So I think as far as trade management on a trade like that, if you're positive on it and you did it for an earnings play, close it, because it could easily move against you. Even though you'd like it to pull back a little bit from the rally that we've seen post results, most of the time what I look at trades like that is just take my winner on that trade, the call side, and close it out if I'm positive on it and I did it for an earnings play. You can always just leave the put vertical there or put calendar there, and if it does happen to pull back in the next day and a half, then you can take some profits on that, or at least take some credits on it.
Yeah, that's a great point. What I did is I just took the whole position off, kind of take it out of the position. We can use that almost $300. We sold it for $285, potentially deploy that capital or redeploy that capital into a different example trade. We put it on for earnings. We got a move that was beneficial for the position, and oftentimes that means it's time to move on from that trade. Let's talk some Lulu as well, Anthony. We put on an iron condor in this position. We went out to next week, though, and so while we got kind of a move that was beneficial for the trading strategy, we haven't entirely seen profits necessarily on this position because there's still quite a bit of time left in it. And so although the stock is well within our short strikes, the 295 put being the one that is at greatest risk based off the current price, but it's still $8 out of the money. We're basically unchanged on this spread as volatility did not come in enough to offset the move lower.
Yeah, I mean, this is one you're going to kind of have to wait for if it comes out next week. The good thing about having options that expire next week is that you have a 3-day weekend coming up. So typically, at least when I was on the floor, we would start to discount a lot of those options before the weekend, usually like around Thursday or maybe early Friday. So with a short week, you can expect that some of these options might be discounted for the weekend, maybe later today or early tomorrow. But yeah, that's just one where you kind of have to wait and let those options decay for you guys.
Yeah, and I think that's a great lesson. You can see that the theta decay number is really picking up now as the amount of days to expiration becomes less and less, yet the value's held in there. So this is one, too, that as Lulu potentially stabilizes as the week goes on, if that happens, you could see just what Anthony is highlighting, which is, Tom, that some of that volatility is taken out ahead of the longer weekend than we typically get with Friday being a market holiday. Guys, let's talk some Apple, though, because we talked about the performance today being one that's a little bit more reminiscent of the market of 2017, the market of 2018 and 19, and really even for most of 2020, which is one where tech led the market, particularly these names like Apple, these names like Tesla, these names like Facebook out in front. And that's certainly the market of today. 2.3% to the upside, $2.80 here, Tom. Apple leading the charge here for the NASDAQ and the S&P.
I would just caution investors on Apple. You know, I think a lot of people are involved in it, whether you know it or not. It's probably in your 401k. But it seems like over the last few weeks, anytime we get above, you know, a specific point in there, which is basically about 121, 122, I think we hit over 125 about a week and a half ago, it seems to sell off. And, you know, you have to keep track of that 10-year yield that I mentioned earlier in the show. Is the higher that these interest rates go, the more pressure on a lot of these tech names there's going to be. Like I said, there's a little bit of a reprieve in that 10-year yield today. It's down just a bit, which is helping propel the NASDAQ to leading the major indices. So you have to keep that in the back of your mind. Even though if you like the stock, you always have to play these names that there's some other macro event that might negatively affect them. So if Apple is going to continue to get back to those all-time highs that we saw at 145 at the end of January, you're going to probably need at least a consolidation or a pullback in yields to get to those levels, and it might take a while. You can see right there from the chart the consolidation, the choppiness that we've seen over the last several weeks. And, you know, it seems like it's buy under 120 and maybe a sell over 125. At this point, there was some positive commentary. Anthony mentioned the UBS upgrade today. They raised their price target to 142 from 115. But you're looking at if Apple is going to, you know, increase earnings, right? Increase their multiple expansion, which is at one of the higher levels that we've seen over the last 10 years. If it's going to keep that there or, you know, at these levels, that expanding multiple, you're going to need a drop in interest rate, and you're going to need the company to start increasing expectations for longer-term growth by, you know, raising that PE ratio a little bit. So those are some concerns for Apple, but at the same time, it typically, anytime you get a little pullback in Apple or consolidation, it has become a buying opportunity for a lot of investors.
It certainly has. And the one thing, Anthony, that I oftentimes will do is just kind of, you know, revel at the fact that Apple's up 63.5% since 1/1 of 20, so the beginning of last year. When you think about the amount of market cap created for Apple to move up that much, you're talking $600-700 billion in market cap. You know, really the market cap of so many of the other companies combined in this country and the globe. It's just incredible that Apple's able to still grow at the clip that it does. Is really something to admire, and one that probably has made a lot of investors very happy. And as Tom points out, if you're passively invested in the NASDAQ or the S&P 500, as so many 401ks and retirement plans really are, you got some exposure to Apple as a result. But talk to us a little bit about trading Apple, because Tom highlights some of the recent struggles that we've had around this level, the mid 120s. But at the same time, we've kind of bounced this every time we've trended below 120.
I still like Apple. I still think they have a lot to grow. Maybe plateauing a little bit. I still think they're a good stock.
Lots of shares outstanding, somewhere between 16 and 17 billion. We're right at a $2 trillion market cap. And so you have like those two things that Tom talked about going on, right? We got the big Apple upgrade today by UBS, price target set at 142. That's probably more of a long-term price target. And then we have this interest rate environment where people are just a little unsure, and it's causing a lot of choppy trade in the NASDAQ as well as Apple. But if you look at the chart in Apple, we're just hovering around this 120 level, and it's bounced off of it every time it's got down there in, say, probably the past 60 days or so. Okay, so what we're going to look at, it's hard to pick direction on something like this. So we're going to look at as a non-directional trade with an iron condor. So Alex, whenever you're ready, we'll just start building that bad boy out.
I'm ready. Tell me what we're looking at here.
Monthly expiration, April 16th. We're going to sell the 118-116 put spread. And then we're going to simultaneously sell the 128-130, looking like right now about a 69-cent credit. Okay. So, I mean, I was kind of debating on this.
Right in line, Anthony.
Yeah.
Yeah, sorry, but really right in line with kind of the 1/3 the width of the strikes, a $2 wide spread, a little bit over 2/3 the width of the strike. So right in the wheelhouse, but continue.
Yeah, absolutely. And you know what? You can adjust this thing depending on your opinion of the stock. If you're really like, 120, I feels like a hard support, you could raise that put strike up, but like Tom was saying before, with the interest rate environment that we have right here, I wanted to give it a little more wiggle room to the downside just in case we do fall below that 120 level. So not too bad of the premiums that you're getting, only 16 days out. So we'll be looking to put on that iron condor. And really what we're hoping for is no movement. We stay between those two strikes. And so my exit strategy usually is, if I can buy any of those shorts back from now into expiration for a nickel or less, single-legged at TD Ameritrade, you don't pay a commission when you buy to close under a nickel single-leg option. So that's kind of would be my exit strategy on this. And like you said, Alex, to your point, for Apple to move $1, it's $16 billion in market capitalization. So it is a heavy stock. Doesn't mean it can't move. We're seeing it move today. But this trade kind of allows you to directional strategy where you can just use some of that theta decay from the long weekend, and then we'll see how it plays out, guys.
What I like about these type of strategies too, Tom, is that as the stock rallies, you naturally pick up short deltas. So in a way, you're selling into strength. And as Apple sells off and it pushes towards 120, if that were to happen, we naturally kind of buy the dip and pick up long deltas as those different sides of the position really are the ones that are tested. So I think it's an interesting strategy from that standpoint too, how it's dynamic and is kind of a contrarian in the sense that you buy into weakness, you sell into strength, which is oftentimes what we're looking to do. But what I'm going to do here, 70 cents is where it's trading right now. That would be the max profit for every one of these. So $70 US if it stays between 118 and 128. So that $10 window for the stock. But also that means our break even is 128.70. We add the credit to that short call and subtract it from the put. So 117.30 on the downside. The risk on the trade is the $2 wide spread on either side, net of our credit. So $1.30 or 130 US dollars. That takes place above 130 on the upside or below 116 at expiration if either of those was the outcome for Apple's stock price. What I'm going to do is I'm going to go ahead and create a duplicate order, work 3 of these at 70 cents, which is a little bit above the midpoint. We can always adjust that. But Tom, you were also looking at something as well in Apple. Walk us through how you were approaching this, because it is something that could be compatible with this trade, but maybe takes a little bit more of a longer term outlook on a stock that, at 122, it's accessible, but it's not necessarily the most affordable name to go out there and buy 100 shares of stock.
Yeah, and if you look at Apple, because of the consolidation that we've had since the start of March between like 129, 128 and down to 118, how do you take advantage of that lower implied volatility? We've seen the VIX hovering below 20, the 20 level now, and if we continue to see that volatility down, and the NASDAQ, which is the NDX, which is only up about 1.8% so far this year, with the Russell up 12%, the Dow up 8%, S&P 500 up 6%. If you think that interest rates are going to start to consolidate, maybe pull back a little bit, and you want to give yourself some time in a trade where it's bullish in nature, right? You take advantage of that lower implied volatility where you can actually buy verticals. So the example I looked at was going out to that May monthly cycle, so giving yourself basically nearly, a month and a half on this particular trade, buying an in-the-money call, which would be the 120 strike, Alex, and then against that, selling the 135 strike call. And you're paying a debit roughly around $5, maybe a little bit above that, Alex. And if you're buying a $15 wide bullish call vertical, right, and you expect it to get to 135, maybe break out of this range, this might be the way to play it because volatility is low. You don't pay as much for long vertical spreads. And if it gets above that 125 level, you start profiting. By buying the 120 strike, which is a couple bucks in the money, that break-even point is going to be just a little bit, a couple percent above where the current share price is. So if you think over the next month and a half that Apple is going to rally, break out of that range that we've had, get back up to the 135 level, this might be the way to play it because you're paying so basically $5 with a potential profit of $10 on that spread if it goes to 135 at May expiration.
And with this one, as you point out, the debit spent, you add that to the long call. So in this case, the May 120, you get your break even at 125.5 if we pay $5.50 for this. That is only about $2.50 higher than where we're trading right now. And with Apple, not the most volatile stock, but it moves $2-3 a day fairly regularly. I mean, you see it today at $3, so it's certainly not outside the realm of possibility. You're essentially a day away from that break even if you get that kind of price action again. But with this one, the first thing that I could see, guys, is that somebody would say, well, why would I root for the stock to go to 135 when my iron condor's break even was 128.70? But because that iron condor is only $2 wide, even if you were in max loss on that particular spread, you know, if this trade was to be fully profitable, it'll more than offset the losses from that iron condor. So you can still lean long and still have that iron condor to kind of benefit from time passing if we don't get this move. So I think these trades actually are very compatible together. So what I'm going to do is I'm going to work two of these at 546. That is the current midpoint for this trade. The lower the debit spent, the better. The debit spent is the risk. So in this case, 546, that would leave us with a max loss of 1092. And max profit is that $15 wide spread net of our credit. So in this case, 954, take that times 2 to 1908. And so we'll go ahead and work that there and see if we're able to get a fill. Anthony, real quick before we say goodbye, let the viewers know what's coming up later on this afternoon on Twitch and where they can find you.
Yeah, you can just download the Twitch app and search for TD Ameritrade or go to www.twitch.tv/TD Ameritrade. We're on 1 to 2 Central, 2 to 3 Eastern. We're going to have a great show, guys. We're going to be looking at some futures. We're going to be looking at Micron earnings today. So a few different things we're going to be throwing at you guys. And always, we can react to you guys in the chat. So we really appreciate when people chat in.
Yeah, it's always a great stream. So we're looking forward to that. 2 o'clock Eastern Time, 1 o'clock Central, twitch.tv/TD Ameritrade. Anthony Panzeca, it's always a pleasure. We look forward to talking to you again soon here, buddy. Thanks. All right, Tom, we're going to take our first of 2 short breaks here on the program. When we get back, we're going to continue the big tech talk. We're going to talk some Tesla. Landon Swan from Likefolio is going to stop by. Evelyn Baker is going to stop by. Stick around. We'll be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
Welcome back to Fast Market. I'm Alex Coffey alongside Tom White, filling in this morning for Kevin Hanks. Tom, you have the Dow slipping back into red territory, but not even 0.1% to the downside. The Dow is really an unchanged index today, but you do have some tech strength here. A lot of this driven by what I often refer to as kind of the big six names: Microsoft, Apple, Alphabet, Facebook, Amazon, and of course, Tesla. To help us talk some more about Tesla here, as it's the one that's going to be in focus for our cash tag segment, I want to welcome in Evelyn Baker, TD Ameritrade Network contributor to the show here. Good morning to you, Evelyn. There's countless things we can talk about with this company. It is seemingly always in the news, so I'll let you take it away.
Always, Alex, you're right. But what's going on today is that there's a lot of conjecture over Tesla's first quarter delivery numbers. Right now, the current estimates is saying that Tesla, or calls for Tesla to deliver about 174,000 cars. But a few analysts are coming out and responding to that. And which brings me to my first tweet for you guys today. I'm going to go ahead and jump into this because this tweet references the Tesla report out of one firm in particular. Twitter user says that New Street research analyst reiterated a buy rating on Tesla, but believes estimates for first quarter deliveries are too high, and the company is likely to miss consensus by 5% due to the Model S and X delays and a slower than expected Model Y ramp. So the firm also said that these deliveries would be too bullish, in particular out of their Shanghai plant as well. Tesla's facing some issues out of China, but the firm does have a $900 price target on Tesla. They did reiterate that buy rating, like the tweet mentioned, so they are still overall bullish on the EV maker. But we also heard from Loop Capital. They said a similar thing. They also expect some weakness out of this delivery number. But then on the other hand, Wedbush's Dan Ives, who is arguably the most bullish Tesla analyst on Wall Street, who has a $950 price target for the stock, he said that the company should be able to beat that delivery estimate, no problem. So there's just a lot of conjecture, a lot of conversation, both on Wall Street and on social media, about whether Tesla will be able to easily pass these numbers, or, if not. But until the actual numbers come out, we just won't know. And those are expected to come out sometime this week. But Tesla is just for sure one company that analysts and social media love to discuss. There's always something going on with this company. And another big factor right now that we have to discuss is competition. There's increased competition coming into the EV space, potentially taking away market share from Tesla, which brings me to my second tweet of the day for you guys, which I really want to focus on the first part of this tweet. This Twitter user said that it's absolutely ridiculous to think that once EV adoption hits critical mass, that every car on the road is going to be a Tesla. I think that's a very fair point. I mean, we talk so much across the shows on the network how there's not just one leader sometimes in an industry. I mean, we talked about Lulu and Nike just yesterday, and there's likely to be another EV maker that comes up to really challenge Tesla and be on that same level. Right now, we're seeing a lot of additional regulations for automakers moving toward EV adoption, and we're seeing those legacy automakers really ramping up their own electrical vehicle production. But then there's a number of newer EV producers looking to come in and really be the new Tesla, right? But then there's Apple, which I know that you guys spent some time talking on today already. But as far as Apple's Apple Car, which is been talked about a lot, there hasn't been a whole lot of news surrounding it, especially out of Apple in particular, right? They've kind of held that more close to the chest, but we shouldn't expect an Apple Car on the market for at least a few years at the earliest. But Apple did recently patent a new LiDAR system with a waveform design for the Apple Car. So they're making headway, at least as far as reports are saying. But no matter what, even if it is going to come out in a few years, the point here is that, I mean, a company like Apple coming out on the market with another electric car would definitely be a threat to Tesla. But Tom, my question to you is that's a more long-term threat, right? So right now, so many analysts are talking about the delivery numbers, but what do you see as the biggest factor for Tesla? Are these delivery numbers, is that going to be really as big of a deal as the firm, as so many Wall Street firms seem to make it out to be today?
Yeah, I think it's definitely going to be, a big deal for this company because they continue to beat estimates on the street. Whether it's, we've got price targets in Tesla from $100 to Kathy Wood at ARK Investments is over $1,000 at this point. And you mentioned Dan Ives as being pretty bullish on this stock with a $900 price target also. But I think if you look at the competition that's coming up in China, the EV adoption is growing at a quicker pace as far as a percentage number, right? But you've got NIO, you've got XPeng over there, you've got other competitors that are growing hundreds of percent growth year over year numbers, and even month over month they're starting to explode. So there is rising competition there, but at the same time it is coming from other companies. And you mentioned the time frame or duration until we get some competition on the market. Apple's at least 2-3 years away, right? But then you've got Volkswagen, you've got a lot of the European car makers that are going to start coming out with their models. You've got the Ford, that Mach-E, that Mustang. I saw one the other day. It's a great looking car and doesn't look like a Mustang at all, but competition's coming. But being the leader in this space and maybe the technological advances that Tesla has in the space makes them the most wanted name in this space. And if you look at the stock's down, $240 from its all-time highs. So, maybe it's elevated on, a valuation method if you can. If you can evaluate this company on a standard PE ratio and forward-looking earnings and stuff. But I think if you bet against this company or bet for this company, you better make sure that you're trading risk defined. I think that's the key here, just because these numbers can be, far outsized than what you'd expect, what the street expects. But if it does come in below, do they guide higher maybe for next quarter?
Come on, do we really need an Apple car? But then again, I think about it, I got the MacBook Pro, the iPad, the AirPods, the iPhone. I'm the sucker who's got all of the Apple products already, so I guess maybe I do need an Apple car. I guess we'll find out. But let's talk some more Tesla here. Evelyn, great setup here for us as always. Stock up 660% since the beginning of last year, but already down 25% from its closing high just about a month ago. So the volatility is real when you're talking Tesla. Let's welcome in Landon Swan, the co-founder of LikeFolio.com. And Landon, let's work macro to micro, because there is a lot of talk and chatter around the growing nature of the EV space. I'm sure you got some data behind that. And then, of course, specifics here on Tesla.
Oh, yeah. So, Tesla's it's one of my favorite companies to root for. I love the CEO. I love the fact that he's got it out for short sellers. It makes it tough to bet against him. And, just like you're talking about, the just overall electric vehicle market is something that they invented, basically. They created the demand for it, and it is growing significantly. And I think, obviously, that's going to benefit Tesla. It's going to benefit competitors as well. Ultimately, it's going to benefit the consumer as more companies get into this and push the envelope as to what technology can do and try to catch up, at least right now, try to catch up with Tesla. But you can see here at plus 52% year over year, the demand for electric vehicles is soaring. It had a nice little bump and a pullback, and now we are running up to all-time highs. And I think all of this has to do with the fact that Tesla is creating a fantastic product. Overall, the happiness of the company is extremely high. They've got happiness, I believe it's around 76% right now, which for a car maker is very, very high. And that's actually gone up over the last little bit. And so, they've been very steady. And, one thing you guys may remember about our data is as there's an influx of new customers, new purchase intent comes in, usually happiness declines a little bit because expectations were so high. The fact that the opposite is happening for Tesla is an extremely bullish sign for this company. And it just shows that people not only are coming into the company with very high expectations, but those expectations are being met and exceeded. So everything that we've got on Tesla is very positive. Even if you look at the purchase intent, this is actually a chart that is one of my favorites because Tesla for us has always been very, very forward looking. I can go back to, 2013 or 14, and the mentions for this company were off the charts, and that was way before people started buying them. So they create a buzz around their products before people start buying them. And people like to talk on social media about the fact that they're going to get one before they actually make the purchase. And so when you look at purchase intent of people talking about buying that buying these products, I mean, it is up significantly, up 78% year over year, 100% quarter over quarter, and just screaming to all-time highs. So this is as the stock is pulling back. This is something that, we talk about a lot on this show, divergence, stocks moving in one direction, possibly implying lower expectations from the market, while consumer demand is screaming higher. That sort of that discrepancy between two movements is a very bullish sign for us. And it's actually, we don't do this a lot on this show, but I will tell you that yesterday for our clients, we put out a bullish alert on Tesla. And so this is a company we've made a lot of money on in the past. We're betting again on them at this point. Definitely bullish Tesla long term. Now,
Landon, I just got back from a trip driving through your beautiful state of Kentucky. I was actually on I-65 for about 3.5 hours stuck. I went 4 miles in 3.5 hours because there was a road closure, but I didn't see a lot of Teslas down there. So this goes into my question. When you guys compile your data, are you getting most of this data from tweets based out of California, maybe Texas or Arizona, where you see a lot more Teslas on the road? Because I didn't see any in your state, and I saw very few down in Nashville. So does your data take that into account where geographically those positive mentions are coming from?
No, it doesn't. We're pretty much all over the U.S. I can tell you there's definitely plenty of Teslas in Louisville. Every time I'm with my kids, we've got a game where they spot one, they yell it out. They love to see them out there, probably because their Uncle Andy has a Model X, and it is just the most amazing car they've ever been in. It's incredible. But we do have them. But I can tell you, just think about this. The demand is extremely high. People love these cars, and you're not seeing them at super high saturated levels in the Midwest. So that's just more people waiting to buy. Those are going to be future customers as this product continues to develop. So, we're extremely bullish on this company. I know from a traditional valuation standpoint, it's tough because the multiples are very, very forward looking. However, this is one of those companies that is legitimately poised to change the world. I mean, they're making electric vehicles more attractive than gas powered vehicles. And 10 or 15 years ago, that was a joke. I mean, you talk about electric vehicles and it was something that could go 15 or 20 miles an hour and it couldn't go very far. It was just a complete joke. But Tesla is completely changing things. It's flipping the whole script. And, just love this company, love the CEO. But personal opinions aside, the data is very, very bullish.
Yeah, if you're wondering about the product itself, just get in one if you have the chance, and it'll answer all your questions why these are so sought after and popular, and why people get excited when they see one. But Landon, I think that the unique thing here, and this is probably why you're so excited about it, is this is one of the few times in maybe Tesla's short history as a publicly traded company that the macro environment is kind of weighing on Tesla a little bit. But behind the scenes, at least from your data standpoint, things are looking very, very strong, and you may have an opportunity to get in a name that can beat, expectations. And a lot of times you have a company that it meets the expectations, but it's a showmanship. It's Elon's ability to talk through the new products and kind of, distract you if they do miss. But if they're going to beat expectations, they're going to have strong numbers. And the only reason they're getting pulled back is because of rates and because we want to buy financials and energy stocks. I mean, this is a unique opportunity, at least for Tesla investors, potential investors going forward.
I completely agree. And so that's one of the reasons you don't want to bet against someone like Elon Musk. He's very crafty, he's smart, he's good on stage. And one of the things that, people don't really understand about this company is the way that they've done the full self-driving. It's a $10,000 upgrade. And when people add that on, they bake 50% of that as revenue. They book 50% as revenue, and they book 50% as a liability, which as they deliver more functionality and they control when they do that, they transfer that liability from debt to revenue. So they control the keys, the floodgates on this revenue. And if I'm Elon Musk, then I'm looking at my delivery numbers. I'm looking at what's important to investors. How are my sales going? And if they're weak, then I'm going to open that floodgate a little bit to help boost things on that next earnings call. So they've got the ability to sort of manipulate the numbers through this full self-driving mode. And not only that, but as they release more features and move liability into revenue, they're going to get more people signing up, booking more $10,000 or signing up for the subscription service. And I got to tell you, if you haven't been in one that has that full self-driving, it is absolutely incredible. I mean, it can really manage the road in ways I did not expect it to do. On the highway, it's a piece of cake. On back roads and sort of smaller streets, it's really impressive, and it's getting there. I mean, 5 or 10 years from now, it's going to be hands off the wheel, and I doubt my kids are ever going to learn how to drive because they're just going to hop in a car and tell it where it wants to go, and that's all thanks to this company. So again, this is sort of a rare thing for us to come on this show and say yesterday we put out a bullish opportunity alert, and this opportunity alert, it's a service over the last 3 years has averaged 70% ROI. So we're killing it with this service, and this service is pointing upwards bullish on Tesla. So I don't have anything bad to say. I think it's just a great company, and long term, we love it here. And I love the fact that it's pulled back from all-time highs. You're getting it on sale, in my opinion.
Yeah, tons of volatility, already about 17% off the closing low from this recent pullback, but still down 25%. So that really highlights that move that you've seen. But now you got me all excited, Landon. Maybe if I start saving now, I can afford a Tesla by the time I'm Tom's age, but we'll find out. Landon Swan, good stuff as always, and thanks for joining us. All right, Tom. Well, maybe these Tesla trades can help us along the way here as well. So let's talk example trades in Tesla. This is a tough one to trade because of the volatility. But with that volatility, if you use risk-defying strategies, sometimes that presents unique opportunities as well. So talk to me about how to approach trading a name.
All right, guys, let's get a little bit of an update here. See what looks like AMC is trying to make a little bit of a late morning run here. Still down 1%, but it is curling up, which is fantastic news. Again, we really need to get AMC back up to that 14-15 level that it was last week. She's kind of been hovering down in the tens now for a few days. But I've been saying this for a couple of days too. AMC has lost all of its spark in the past about 3 weeks. Really has. I mean, we go back, we change this chart back to 10, 20 days. Even going all the way back here, we don't really see tons of volatility. We see a couple of days. This day had a lot. This day had a lot. This day had a lot. This was just an overnight crash right here. And then over here, maybe we had a little bit there in those 2 days. But that's really it. Every other day has just been gradual increases like this or gradual decreases like this. Not choppy up and down like we have been seeing, not giant gains and giant crashes like we have been seeing in the past with AMC. So, really interesting to see that it's just turning into the volatility cycle of a normal stock, and I'm not sure if that means that it's getting less traction on Reddit, some of these other places. Maybe look at the social buzz right with GameStop, other Wall Street Bet stock territory, which you can screen is that whoever's over here, the top 20 trending stocks on Wall Street Bets, it's that one. So it's a sad reality that the news cycles are tracking what's on Wall Street Bets. It's pretty much all you see. And that AMC news ticker, that means people are still talking about it. There's still something going on with AMC. It's just not getting the rally behind it and the dumps and giant ups, giant down, which I guess is safe. But again, AMC's a meme stock, guys. It's not there to be safe. It's there to gamble, make a lot, lose a lot, and no one can make a lot unless other people are losing a lot, unfortunately, when it comes to these types of stocks. And by other people, it can be institutions. It doesn't have to be other private investors, but it's interesting to see it now take that turn to a more safe, resilient stock, I guess. I don't really know, versus a wild up and down swinging stock. GameStop, on the other hand, still swinging a little more wildly still. Although today only up 1%. All right, let's see what we've got here. Let me just turn it back up here.
Upside, it can be compatible. So this is one, again, more passive, neutral to bullish, gives us the ability to be incorrect on the direction of the stock. And I think that's what drives us back to this strategy so frequently, Tom, is that the stock can actually sell off $47 and at expiration, we can still be in the max profit zone.
Yeah, and that's what we kind of try to set up here, where you're going to limit your losses. That does limit your upside, just as you mentioned, but there's other strategies to do if you wanted to be a little bit more aggressive on the bullish side. Doing longer term stock replacement type strategies, call diagonals to the upside. You can do those, but with a name like this, with the interest rate environment that we're in, and on top of that, Alex, you've got the added potential volatility coming from these monthly numbers that we're supposed to get over the next few sessions. So there's a lot to unpack here before you can actually be convicted in getting long a name if there's some added volatility or events that could cause this stock to move down. If interest rates, if the 10-year yield goes up to 1.8% or 1.85% in the next week, that's probably going to put a cap on Tesla, maybe hit it a little bit and make it go back down towards 600. So you have to keep all those variables in mind when putting on example trades like this or positions that you might want to get into.
I filled 4 of them at $1.40 here, Tom, so we're in this position. And the thing, too, that I would always like to stress is, even if this stock does rally $200, we're going to be in the max profit scenario for this example trade. It's what we wanted to happen. And so set the expectations accordingly. We know our max profit. If we can ever achieve max profit in any type of a trade, if you're an investor or a trader, you're happy with that, regardless if another strategy might have worked out better or not. This is about the probabilities over time, the number of occurrences, and doing things with a strategic way. But again, just example, we're just talking through strategies. This is just for educational purposes. Tom, we're going to take our final short break of the program. When we get back, we're going to focus in on an earnings name. And, I keep saying we're at the end of earnings season. This may be the marker of the end of this quarter's earnings season. We're talking some Micron.
Why did I add futures to my trading strategy? 24/7 access to diverse global markets, like wheat. Can you say growth opportunity? We should probably harvest that.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the Income Investing course and a whole lot more.
Hello traders, I'm Rick Ducat checking in with today's market news. Pfizer and BioNTech plan to test a freeze-dried version of its COVID-19 vaccine. A freeze-dried vaccine could improve storage and handling requirements, which could help give greater access to rural areas in the United States and low-income countries. The study will include 1,100 participants and will last 2 months. Ticker PFE is up about 0.5% today, while shares of BNTX are up about 4.5%. Baird sees Harley-Davidson revving up for future growth. as analysts upgraded the motorcycle manufacturer to outperform and raised its price target to 45 from 38. The report said analysts see the potential for retail to turn positive in 2021 for the first time since 2014. They also said they liked the strategic direction.
I had no idea that Harley Davidson's ticker was HOG. That is awesome. I love it when companies use a ticker that is, I guess, a joke. I don't know if it's not like just cheesy. Like Ferrari's is race, right? You know, Harley Davidson is HOG. What's some other good ones? Slack is work. I mean, Salesforce is CRM. Like, I love that. I love when a company gets somewhat creative on what their ticker is going to be. That's boring when you have like Ford is just F, or Facebook is FB. So I love that. And, yeah, I don't know what Facebook otherwise could have been, but could have been like LIK. Oh, that would have been awesome. Why did Facebook not have a ticker be like? They even had the like feature in 2011. Maybe they didn't. That's why. I don't know. Anyway, that would be funny. I think like might be. Which, by the way, I have Spectrum Post too. They posted good quarterly returns in there, so their stock's up 10 or 11%. It's actually a stock that I got free with a Robinhood account. And I think a lot of people too, so that's why it's partially relevant. So if you have a Robinhood account, you got free stocks. One of them might have been Spectrum Pharmaceuticals, and if so, it's up 10%. So there is no ticker that is like LIK. That is awesome. Why doesn't Facebook change it? Jeez, crazy. What's that? What else is happening? What's happening with TQQQ? Let's see where we're at. It's like 5%, so it's backed up a little bit from its high. It was like, I want to say, no, maybe it wasn't. I was going to say it's up 7%, but I don't think it's like a percentage. Let me see where it is. I'm looking over here. TQQQ. It's at 91.72 right now. So yeah, it's near a high. So it has not backed up. The Nasdaq still it's plateaued, but it's still going. It's not totally like that. We're seeing the Dow start open, go into the red. It's just been bouncing back and forth over the line. S&P slowly, but it is getting back. So the S&P is heading towards another close if it keeps up right now. I mean, it's bouncing off all-time high right now. All-time high is 39.85. 26 is right now 39.85. So S&P is bouncing off the lower of all-time high. Dow is the all-time high was 2 days ago. So it really if it could continue up until it get there clearly. But of course, we're really concerned about that. Nasdaq is still on they're still 900 points over from an all-time high. And total, let me see, what is the percentage down the total? Still about 6% off all-time high coming back in February. Really hope that we get back there. We're not going to make it all in one day. Of course, we did. We won't even make that part of it. 2% increase just today in the Nasdaq, and our stock may not just be a crusher of a day right there. That would be one hell of a day quarterly. I think we can do it. I think that we have things ready to go. Fueling the rocket, ready to go to the moon today, not just AMC GameStop. I'm talking about TQQQ and all the other tech stocks and ETFs. We can make this happen. As for meme stocks we're looking at, AMC still not doing much. It's kind of just bouncing up and down, but nothing big, down 1.74. GameStop barely above water cost. I think it's one of these days where when we see really, really good days in the overall marketplace, we see a lot of nothing. Just lower volumes, less attention, less volatility, and it makes sense. A lot of the retail trading frenzy right now is going towards the tech stocks in addition to this. Tech stocks are doing great right now. They're going to take their attention off of these guys. They're going to put their day trading powers underneath these guys. So that's why we're seeing such little volatility. Look at Express's volatility; it's nearly non-existent. It's just one trade right here at 10:19 this morning. Yeah, look, that's pretty big. It's 50,000 shares, but most of these other ones, look at this. This is a peak at 13,000 shares. Most of these others are 4,000 shares in a minute. So we're just looking at net costs, kind of the same, but little more shares on some of these spikes, and the price of cost is much more expensive. So a lot more money getting traded with 30,000 on that one. What was that one again? 52,000 actually. I don't remember. But 32,000 of a $22 stock is way more than 52,000 for $4 stock. But GameStop still has much better volatility. We have $65,000 average there per minute, 20, 30, 40,000 shares in a minute, and nearly 200 bucks. But people are looking at these guys. I mean, let's see, I'm not sure what TSLA. Tesla, for comparison, is having 100 plus thousand shares traded per minute on average. I mean, it's calmed down here to 20, 30, 50, 60,000 a minute, but at a 655,000, I mean, so much money is trading with Tesla. It's insane.
The April 1st, 86, 90, 91, call vertical, and micron. Tom, it's always a pleasure whenever you join us here on Fast Market, and filling in for Kevin today has been a pleasure for me, so I appreciate it.
See if I got anything else on my watch list that's worth talking about. TAN, so TAN is the Invesco Solar ETF. I'm pretty long-term bullish on that one, and had a great day yesterday. It's up over 2% today, so that's really good. Bumble, you guys stumbled out of the market after its IPO. I did not expect it to go in the 50s, at least soon, but they weren't live at the first time. So they just kind of spiked, and then they just bombed the rest of the tech market in late February. So a little bit of bounce today, up 3.5%, but they're down overall. Churchill Capital's going back down. Wow. I mean, actually, they're not going back down. They're still positive for the day, but they peaked out this morning at 24.2, and they're down nearly 3% from that high. So, and they're trending down here into the day. So I wonder if there's something going on with Churchill, with everything else going up to the going down, or trending down, I should argue. Riot blockchain up, MicroStrategy up, ARK Index doing really well, almost 4%. Good for them. I still think it's a great ETF to hold. Let's look at the cryptos. So one of the things to note, the treasury market has gone down a little bit, not a ton, but a little bit. Housing numbers came back, and mortgage rates, mortgage applications are really weak because the interest rates are higher and the supply is still crazy low. So mortgage rates or mortgage applications are going down. I really wonder if that is going to force a lowering of interest rates and treasury rates. I really wonder if it does. It might. It would have to be something drastic to change. Right now, you're still seeing mortgage rates even getting to 2.9. It's still getting a rate, which is good. I'm glad we're seeing weeks ago it got up to the lowest you could get 3.1, 3.2, which is just so they're not completely linear, but they're somewhat correlated between mortgage rates you can get on your house and your treasury yield. So, oh man, we're just barely not seeing Bitcoin at 60,000. It's high for today, which was really like 59. So, $112, very, very close to 50,000. And then it went right back down to 57, and now it got to 59. Just man, it's crazy volatility with Bitcoin. Okay, someone made a stupid comment. It was a comment on my account yesterday. which I reported in part of the video, but about that generally people don't know how to buy the dip. And, like Mr. Michael taught me how to do that. It's better to trade than to hold. I'd like to see a scripted schema post, but I think a lot of people don't quite understand buying the dip, and especially people don't understand buying the dip to hold. It's easy to understand buying the dip to sell, but buying the dip to hold is also a very interesting one. And what I do, so some things that I would hold, like ARI, like some of those other ones that I think are long-term hold strategies. I think with those, we can, if you buy the dips on those, the compounding interest as it goes up, all the returns can be better. So like Bitcoin's a perfect example. If you're going to constantly make Bitcoin, make sure you put in limit orders. And or if you see just the market going down, throw in a little bit more space. Otherwise, if you just put in like, I've got it scheduled to just buy Bitcoin or whatever it is at 12 o'clock every Monday morning, I'll buy $50 worth. Well, you're not going to take it risk with the volatility that it has. It's either that's the difference between buying it at 59 or buying it at 57. That's a big difference. That's like a 3 to 4% loss that you just didn't have the advantage of doing. So like if Bitcoin is super high, it's now a scheduled time to buy. I would hold off a little bit, put it in limit order at 5 to 10% less than what it currently is. And there's probably a pretty good chance it's going to dip. It'll hook that dip, buy it, and then you ride up the wave over time. So I think buying the dip on a hold situation makes tons of sense. So I just thought it was a halfway informative, really goofy post that someone put in. I mean, it was a scam anyway. I don't care. I delete it. But it is interesting to read what was written because what was written, I believe a lot of people do have that thought. And buying the dip, that strategy, it's not like one gets it. You don't have to. It's better to automatically invest than not invest at all. So whatever. But playing the dips for buy and holds is still a fantastic strategy. I mean, how you do the same thing as buying a house, right? Sorry, I had a email I had to shoot off. Oh, what are they showing right there? Which ETF? Looking at the small screen here, below my screen. I love looking at these maps here, these heat maps. Sorry, I'm looking at the about screen, so that's why I didn't show it here. Oh, they're just looking at the S&P 500 altogether. I thought maybe they were looking at an ETF specifically. All right, where'd you go? Go back. There it is. But it is crazy. I love looking at those. It's just fascinating to me, like how much some of those have it there: Facebook, Apple, Microsoft, Amazon, Adobe, Salesforce. I think they took that big a chunk of the S&P. Nvidia makes sense. I get that. Nvidia is just a monster right now. Oh, the Biden infrastructure plan. I mean, I haven't read it or really learned a whole lot about it, but I do know that the United States probably does need a better infrastructure plan. It was everywhere. but the reality is it's way more than just fixing potholes, of course. But yeah, infrastructure in the United States is one of those. Well, it depends on what power grids are a mess. Roads and traffic are a mess. Pipelines are a mess. I think overall we do pretty well, but yeah, there's things that absolutely are messing with it.
I think it is the new infrastructure plan that is going to be proposed and I expect to be pretty sizable. And I think you're seeing a lot of that play out today. I think that's why you're seeing gold moving higher. There's
Yeah.
a little bit of that inflation.
I have a
I think right now markets are feeling pretty good about
one profit line. Okay.
some of the major indices, but also if you just look at our measures of volatility, right? So even the VIX is down below 20. VOLQ is down to 22.72, which is the NASDAQ measure of uncertainty. So markets are feeling pretty good about the outlook.
Got it, Sean. And also probably worth mentioning that the S&P 500 just set another new all-time high today. Dow Jones has been doing that, but Sean, we haven't seen any all-time highs for weeks in the NASDAQ or the Russell. For the NASDAQ, it's been, I think, well over a month. Do you think these sectors might, again, they're showing a little bit of strength today. Do you think they're poised for perhaps a move higher here?
Yeah, I think so. I think it's really going to be a matter of how things pan out in the economic data that we get coming up, and not the data for February, which I think is going to be discounted. But as we start to get a better feel for how things are going into March, and now as we head into April, I think that's going to be the big mover for markets, and that is, look, is February a little bit of a blip due to extreme weather? But other than that, we're seeing some pretty strong numbers and actual hard economic data that shows people are getting back out there and the economy sort of getting revved up again. That'll be, to me, what is the next big catalyst to maybe push some of these indices higher.
Well, Sean, speaking of data, let's get into probably one of the focal points here that's been anything around employment we've been watching very closely. Today we got the ADP employment report. Of course, this is private payrolls, but I'm thinking back on February when they were looking for, I think, 465, and they missed by quite a bit. I think it was 117, something like that. I think people might have been a little worried going into this number, but it looks like this time around they beat this number, right?
Yeah, so it was a pretty solid number that came in, up 517,000 was the reading that we got. It actually yielded the number as it depends, and this one usually has a pretty wide range. Some expectations for 550,000, some are for 495,000. But by and large, I think this report came in with pretty good numbers, and investors are going to like what they see, and that shows that we are getting a little bit of strength here building in the jobs data. It'll be interesting to see if this is confirmed this Friday when we get the employment situation report. But I do think it's going to be something worth keeping an eye on, because the pace of jobs and how we rebound in the jobs front.
Payrolls, 517K versus 552. Interesting. It's a little bit of an estimate. I can understand maybe lower year over year, but for the rest of it sounds interesting.
Especially in leisure and hospitality, as we get more vaccinations out there and we can ease some of these restrictions.
Got it, John. Now, again, that was for March, those the jobs, the employment report. So current data there. Let's turn to Chicago and talk about business conditions in the Chicago area. And again, for the month of March, we got the Chicago PMI Purchasing Managers Index. Now, this number
for the last 6 readings has kind of held at this 60 level. So it looks like we've had some strength there. How did it come out this time, Sean?
It came in pretty strong. It came in at 66.3, which was above the expectations of 60.7. So a pretty good report here. Production was up. New orders were higher. Backlog saw a little bit of a drop, but seeing production and new orders climbing and sort of leading the charge here is certainly a good sign that there's a little bit of a rebound going in, and there's some healthy demand going on for these the purchasing managers. At least what we're hearing from them anecdotally.
Got it, Sean. All right, well, let's wrap it up with one more data point, and that's home sales. So these are pending home sales. So again, these are existing homes. This is kind of a leading indicator. I think a lot of people look at it this way, Sean. And now it's for the month of February. So maybe expectations weren't too high. How did this number come out today, Sean?
Yeah, this number came in pretty soft. It was down 10.6% month over month. Down 0.5% year over year. So a little bit of a pullback here in February. But like I said before, I mean, a lot of this is weather related. And you should have expected this because it's very similar to what we saw in the new home sales, similar to what we saw in housing starts. Just a lot of weather related effects in the February data. So it wasn't surprising to get a pretty soft number here.
Got it, Sean. All right. All right, well, let's turn to a couple stocks that caught your attention today, some movers, if you will, in the marketplace. These are 2 pretty big names, one of them being eBay, symbol EBAY, and the other being PayPal, PYPL. Sean, what do you see with these 2 symbols?
Yeah, having a pretty good day. eBay up about 3 4/10%, and then looking at PayPal up about 3.16%. It looks like these companies that have sort of led the way in the past year or so in getting out there into the crypto space are continuing to see a little bit of a reward here as you start to see more and more institutions come into the crypto space. It looks like some of these companies may have been a little bit ahead of the game here in terms of positioning themselves to be ready for that. eBay and PayPal, certainly 2 of those names, and they've actually started to have a little bit of a correlation with some of the cryptocurrencies. As those markets ebb and flow, I think you're starting to see the companies that have moved out there also show a little bit of a correlation when they move with what's going on in the crypto markets. So I think it's just interesting to watch how these companies, Square is another company that also was sort of at the forefront of getting out there into the crypto space, but seeing eBay and PayPal move higher today, outpacing a lot of the other tech names. As well with the NASDAQ having a pretty strong day today. NASDAQ's up about 1.9%, but you're seeing these names both up over 3%. So looks like the crypto aspect of their businesses that they've gotten into over the past year is starting to pay out a little bit here.
Well, Sean, it's going to be interesting to watch how consumers adopt a payment using a cryptocurrency. It certainly seems like the payment services companies are certainly setting up to accept that. We'll see how it works going forward. But eBay up 100% over the last 52 weeks, and PayPal up 146% during that same time. So these stocks are certainly on the move, Sean. All right, well, we're going to have to wrap it up there. Thanks, Sean, again, for joining us here on Your First Trade and helping break down what's happening with the markets today in terms of data and a couple stocks that are on your radar. Thanks again, Sean. Look forward to seeing you here again on Your First Trade. Now, coming up next, I'll be joined by John McNichol. And as I mentioned, we're going to look at a stock replacement option strategy. What does that mean? And what are some of the important considerations for anyone considering a strategy like that? We'll hear it break down in just 2 minutes. So stay with us. We'll be right back.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today. Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Welcome back to Your First Trade. I'm Scott Connor. Now let's do another check of the four major indices. The S&P 500 setting an all-time record today. It's holding on to its gains, up about 0.75%, with a gain of almost 29.5 points. Now the NASDAQ up 1.92% with a gain of 247 points, or 248. Dow Jones up about 0.1% with a gain of about 31 points. And finally the Russell up about 0.9% with a gain of almost 20 points on the day. All right, well, let's turn our attention back to today's topic. And as I mentioned, we're going to be talking about replacing stock with options. Now, many stocks have had some significant gains since the lows 52 weeks ago, back in March of 2020. Now, with volatility remaining relatively high, investors might be remaining bullish on stocks, but uncertain about buying them at these current high levels, if you will. But what if a trader considered replacing a stock with an in-the-money call option to participate on potential upside, but limit the downside risk? Well, today you'll learn about a stock replacement strategy which attempts to do just that. Now, to help explain how this strategy works is Your First Trade contributor, John McNichol. John, welcome back to Your First Trade. It's a pleasure having you. And, well, we're talking about stock replacement. I'm sure a term that many options traders have heard of, but maybe not are all familiar with the essentials and the concept of the strategy itself. So maybe we'll just start off with a definition of what we mean, John, by stock replacement.
Sure, I'll be happy to, Scott. And it's great to be with you once again. So a stock replacement strategy is essentially where we take some derivatives in an attempt to pattern the performance of an underlying stock without actually owning that stock. One example of a stock replacement strategy is substituting with some options. That's going to substitute the shares of the stock with an in-the-money call option, kind of a deeper in-the-money call option. Now, remember, a call gives the owner the right.
All right, let's see what we got going on here. Let's give a quick 11:30 update, 11:30 Central Time update. NASDAQ still crushing it, up 1.83% right now. I mean, it's a day definitely needed. Absolutely. Overall portfolios looking really good. Let's see, big winners today. Zoom up 3%. We've got a pretty decent stake in Zoom, so I'm super happy about that. Of course, still bummed that it's $100 less than where it was the day after it's to go. And super upset that I did not sell at the time. TQQQ up 5.39%. Love that one. That is the stock tolerance ETF, the ETF in a bull tech market by far, even if you can stomach the triple leverage losses from time to time, it is absolutely a big gainer. In SPXL, same, but on the S&P side. That was about 1.9%. Square up 7.94%. Great gain there. Let's see what else we have. Peloton up 6.6%. Palantir 7.4%. Lots of them looking really, really good. Lemonade Red, awesome day yesterday. Up another 3.5% today. So good for Lemonade. Let's see. I've got Fastly stock. Fastly's up 4% after not having a great last couple of months. EXPI has been just a EXPI has just gotten slaughtered. I mean, I think it's a great stock, but massively volatile. Massive volatile. And let's see, where did it peak at? $90 a share. This was post split. Look at it, a 2-to-1 split. And then it peaked at $90 back in mid-February. And then is in not a lot of time, got cut in half. Went from 90 down to, I think, under 40. Looks like its low was 38, 37 in a matter of just like a week and a half, 2 weeks. I mean, just got slaughtered. Right now it's at 45, so it's up a little bit. It's up 4% today. I still think there's an opportunity. I think as the real estate market turns back around, I think EXPI is in a good place. I don't think, again, just like I mentioned about Zillow, I don't know if they're the future of real estate technology, but they have a good stake in the game. EXPI is the same way. They're both a brokerage, franchisor, and they also have a lot of technology that they're working on, right? So as a real estate sales brokerage, I can't necessarily say themselves, but they have done a great job of having, introducing a lot of technology that they actually own. A lot of intellectual property, which is fantastic, which is really good for them. Dow X, which is the WeWork SPAC, did really good yesterday. Hold on, let me go back out here. Did really good yesterday. Or actually, did really good Friday. Spiked right at the end of the market up to $12 a share. Of course, it did not sell at the time. Yesterday, I guess they didn't do well. They didn't do terrible yesterday. And then today, they've had a really good day today. So two back-to-back good days for that SPAC. And it might get back up into the 12. And I don't know, maybe I'll sell it. I bought 50 shares of it just on a whim the other day when they announced the work thing early in the morning, just to see if I could maybe 2x that 50 shares. That did not happen. But I bought them pretty cheap. I bought them at 10.27. Maybe here, let me pull them up here a little bit more. It's kind of an interesting one. TWX, which you can say is really WeWork. So it's the WeWork SPAC. So it's got a market cap of $686 million. From the merger, post-merger, I think it'll be valued higher than that. But I think I think there's a chance here that this one could be the next SPAC that could do something. I think again, it's commercial real estate related. Commercial real estate right now is pretty bad. I think if the future of what commercial real estate will be, I think, is something like a WeWork model. So if we look at it as not past of what WeWork is, over valuations of WeWork was, and what WeWork actually currently is, and if financially it's in a stable place, it just happens to have the same name and intellectual properties that old WeWork had. I think WeWork's in a great position for the future. I really do. I think that is the future of what commercial real estate will be, not just WeWork, but the other similar type of commercial real estate places like that. I think we'll see a few more pop up. That might be the next, over the next 2 to 5 years, that might be the next EV. We're seeing a whole bunch of EVs come out and go public, even without a product. We might see more commercial real estate opportunities come to the forefront, even without a real product, which is dangerously speculative, just like WeWork was the first time around. So, but I think, as we get back to where we're not going to have these giant farms of offices where we have 5,000, 6,000 people in a building for one company, what we might see like, let's say a large company like here in San Antonio area, there's USAA, has thousands and thousands of people in their USAA office. Now that they've gone 100% remote and realize it actually works, they might say, all right, well, now since you don't have to work remote, you don't have to work in the office, you don't have to work in the headquarters, you can work basically anywhere in the country. Let's just throw out this option. You work anywhere in the country, and we will give you a WeWork membership, right? So you're not tethered to the San Antonio, headquarters office, and you can work in any WeWork anywhere in the country, possibly anywhere in the world. We'll give you that membership, buy that membership. It's going to be way cheaper for them to buy, hold, and maintain real estate in that way. So, $50 per employee per month, or just kind of a desk, not talking like open desk, not going to give every random Joe an office, but way cheaper, way cheaper than for them to go buy some skyscraper downtown or go buy a building in Austin or Houston or Denver or some other place where they might want to expand facilities. It's gonna be way cheaper. Just say every new employee, $50 a month, and they'll probably, of course, negotiate with WeWork or whoever the other company is. And it's just like an allowance. It's just, they'll probably subsidize it by taking out of something else, some other benefit or something like that. So it doesn't really hit their bottom line equally, but it's going to be way cheaper. And so that's possibly a bad example because USA already has that office space. But let's say you're a young, growing company. If you're a startup, and in your startup, you might have to balloon up to 1,000 employees, and possibly very quickly. We've seen it with companies like Slack and Salesforce, where they've actually pivoted a while back to, or permanently in Slack's case, all their employees just being completely distributed. And so as they grow very quickly, it doesn't matter where they work. But I think that there's a lot of people that actually do want to work in office space. They see the benefit of the shared office space of a WeWork or that type of a shared environment. They thrive in those types of environments. Actually, do really well in a workspace, get free coffee and free water and stuff like that, and actually have a place to get up every day, do their routine, go to work, things like that. I am very optimistic about the future of commercial real estate being a distributed model. Whether you want to call that the WeWork model or not, I know they weren't the first ones to do it, but they were the first ones to become big and wide. So that's why I'm optimistic about it. Not sure about this particular stock or SPAC or whatever, this merger. I did put in that 50 shares just as a speculative bet on it going up quickly, which it sort of it's up, but it's not crazy up. But I think long term, I think that's a good way to do it, which then I think brings back the commercial real estate finance. That's why I really still like the stock for ARI. ARI is a commercial real estate finance. So commercial real estate finance isn't going to go away. Just who buys, holds, and leases the buildings is going to possibly be different. Rather than have one company lease an entire skyscraper, you're now going to have 10 companies lease individual areas of the business, have smaller individual offices and the shared workspace of the WeWork style in other areas of the business, which is actually going to increase uh, the overall gross income of those commercial properties. Because if you get one company that comes in and wants to take over a whole building, I mean, you're going to have to negotiate that to a super low price. The good news is that you have a lot of stability, kind of stability there. The chance of one of those, big company that gets a big lease, completely going under is low, but it could happen. But you're not going to have to worry about all these tenants and all their maintenance and all that problem. You got one tenant. So that's a good thing about having just one big company and one big skyscraper, one big building. But I don't think, like, if I were to go out and buy a commercial building right now, I would not go buy a very large building with one or very few tenants. I would buy buildings that I can specifically lease out to multiple small offices. I go get a 10,000 square foot building that I can parse out to 2,000 square foot offices. And I'm not talking like retail, I'm talking offices, right? So in each 2,000 square foot office, each company could have 5 to 10 employees. It wouldn't be a massive amount of employees in each office, but 5 to 10 employees in each office, that's a sustainable level where you can kind of have that base minimum of these are the people that are essential enough for me to have to be in the office every day, handling money, handling customers that walk in, whatever that business is that you're in. And but when you get up to having 500 people in one office, Well, then you could say, well, I really only need 2 people at the front desk, and I really only need 3 people in accounting to handle money, and I need like a couple of people to just manage the building. And then everyone else, I guess they don't have to actually be here in the building. That's what you run into with these large lease spaces. So then they contract or sublease out or you need to do something else with that lease, or they just let it go under. They break their lease. So again, I would say that that's the future of real estate is smaller, local, and more distributed office spaces for those people that are distributed. You might see now instead of one company having 100,000 square foot headquarters in the city, they might have 10,000 square foot offices throughout that same city. They're going to distribute themselves. Their cost isn't going to be a whole lot more. I mean, the cost of a few things would be more like utilities, but having to build out internet connections to each one, right? But that's somewhat minimal compared to the cost of actually renting and holding and maintaining real estate. So to me, that's my very long soapbox rant about commercial real estate, what the future of it looks like, in my opinion. So I think that WeWork and those other types of commercial real estate opportunities, as long as they're financially valued correctly, that was the point. WeWork, as long as they're financially, fundamentally valued correctly, I think it will be a good company in the future. And in my personal opinion, can be a good investment. Not necessarily recommending you invest in this SPAC because it's pre-merger, it's just been announced. No idea what's going to happen post-merger. And we're seeing that same thing happen with CCIB and Lucid. Once it gets announced, it's a whole new roller coaster. And then, maybe one day it's going to actually go through the actual transactions getting through. And then what's going to happen? I don't really know. I don't know if anyone completely knows what's going to happen with CCIB and Lucid once that actually gets done. So is the stock going to stay around $20? Is the stock going to go to $100? Is this stock going to be just merged with the other one and then have a completely different ticker symbol? Probably will have a different ticker symbol, different market cap, different everything, and it's going to merge the shares between the two companies. But how is that going to really look if you currently hold shares in CCIB? Is that going to be good for you? Or is it going to be bad for you? I have no idea. I honestly have zero idea. So that's the challenge I see with the whole thing with these SPACs. And so to me, SPACs are speculative. SPACs potentially are even just get out type of things. They're not, in my opinion, something I feel super comfortable holding for a while, especially if it's like a pre-merger announcement. Like if you got in with Lucid at 10, 15 bucks, CCIB 10, 15 bucks before the spike, because the spike was all speculative. Nothing was confirmed. It went from 15 up to 60 super, super quick. That's great, but it was completely on vapor, right? And then when it gets announced, it crashes down to 20 bucks a share. So it's tough until you actually, the merger happens, let the dust settle, let the market really kind of recalibrate the valuation of the stock and the market cap of the company, then figure out if it's worth investing. Right now, it is completely rolling the dice. So if you're going to invest in something like that, how I see it, my strategy, I'm not giving you advice for strategy. My strategy is I'm investing in it just for a short-term gain. And I actually kind of want to get out before the merger actually happens because I have no idea what's going to happen with the merger. I don't know if it's going to be a good thing for me or a bad thing for me. So get in there, make some money, get the heck out of there before it becomes a bigger problem. Let's go back over to CNBC and see what these fools are talking about. CNBC. Lululemon. I think Lululemon is one that beat their earnings. Another one of these beat their earnings, beat the estimates, but didn't beat it by like 300%. And so the stock goes down. I can still never completely understand how that works and why it happens. It's crazy. But of course, they're also looking at the outlook. They probably think, well, yeah, it did okay, but it didn't. It's like, why do we even have estimates? Why do we have these financial analysts putting out estimates for earnings when they all beat them, almost all of them beat them, and then they still go down after they post their earnings? What does the estimate even mean? What does the estimate mean if you're going to blow it out of the water and still um, do? I don't know. Anyway. So Lululemon, I'm sure it's still a great company. They still beat their earnings. They probably beat their earnings next quarter too. And they're still down 12% and they're down 3% today. I don't want to say if it's a buy or hold or a sell, but I just hate this market that we're in where good is not good enough. Good still tells people to fire sell your stock. So, and they're talking about Peloton. Now, Peloton to me, I still think Peloton's a long day. I think we put Peloton in the same boat as Zoom, where they were darlings of the pandemic, but they're just getting started. I mean, they've built such a fantastic platform and market leader on this platform, and I could see Peloton partnering with in-person gyms. I mean, everyone's just thinking of Peloton as something that's like, oh, well, it's only because I can't go to the gym, that's why I have the Peloton membership. I think that's totally crap. Peloton's building a massive network infrastructure platform where even if you go to the gym, like there will be a time in the future, I guarantee it, time in the future where you will physically get in your car, drive to the gym, sit in a room with other people on your stationary bike or whatever workout you're doing, and up on the screen will be a Peloton instructor. That will happen, I guarantee it. In fact, if I run the business of starting a gym, that's exactly what I do. I would not employ trainers. That's stupid. Why the hell would I employ a trainer when I can have a live workout from someone on my Peloton big screen? You guys can just follow that person. Because you're still competing with the folks in the room. You're still competing with the folks on Peloton. In fact, it makes it even better because then you can put Peloton bikes in there. Everyone in the room can compete against each other on the scoreboard and compete against people nationwide or whatever's happening there. Where now, if I go to the gym now and get on the stationary bike and group exercise, what does that mean? I mean, how do I know if I'm doing better than the person next to me? Isn't that the whole? But that's the whole point. Some people go there is to just do better than the next guy. Some people just need that push also. I believe that Peloton is just getting started. I completely agree. I'm not saying that the valuation is right or anything like that. I'm saying as a future outlook of what the company has created, they are just scratching the surface on what they are capable of doing in the future. I think they're a great company that will do some cool things in the future. Zoom, same way. I've been saying that for Zoom all along. Zoom is not just a video conferencing platform that is going to get swallowed up by 50 or 60 competitors. Zoom is creating a massive infrastructure and has become a household name of such. So they are going to, I think they're going to dominate what the future of business communications is altogether. They need to create a few more tools, which I know they will, but things that they need to supplement themselves with things like tools that Slack has and Microsoft Teams has to really, really dominate to the next level of business communication. But I think they're going to replace phone systems. They're going to do, they're going to still be on the forefront of the video communication tools. No doubt. No doubt. Zoom is also just getting started. All right, well, I got to get on to the next task over here, so I'm going to shut up for a minute. I'll turn the volume back up. They're in a commercial break, unfortunately. They'll be back in just a minute, I'm sure, and then you guys can listen to what they're saying. But thanks for sticking around, and make some comments and give me a like if you agree with anything I'm saying, or if you don't agree, just give me a like anyway. Or tell me you don't agree with me in the comments. I'd be cool with that. But either way, subscribe. Either way, subscribe. Whether you like, dislike, or comment, I don't care what you say. At least subscribe. That's the most important thing. Anyway, see ya.
All right, welcome back. Let's talk the banks now. We mentioned how well they performed, and we're wondering whether they're still going to perform in the quarter ahead. Jim, you mentioned at the top, I mean, if rates continue to move up, it's hard not to like the banks.
It's really
right?
hard. Yeah, it's very interesting that almost every bank got caught up in this fiasco. But J.P. Morgan took a hard look at that company, at the company that describes itself
Archegos, yeah.
as challenged.
Yep.
They had a challenge quarter. They used the word challenging. I mean, I'm trying to figure out what team is challenged like they are.
Jacksonville.
Jacksonville's challenged.
It was challenging.
Yes, I mean, it's a team that should break up. But I do feel that when J.P. Morgan took a hard look and said, listen, these guys are untrustworthy, versus, say, Credit Suisse. I mean, Credit Suisse, I don't even know I'm speechless about Credit Suisse. So I have to think that J.P. Morgan, you're not going to go wrong with J.P. Morgan, and you're going to go wrong with Credit Suisse.
And I mean, look, you're talking from a risk controls narrative, right?
It's emblematic of how great they are.
Yeah.
It's emblematic.
So Stephanie Link, right? We talked about the quarterly reports, briefly for Joe and John. Wells and Bank of America were among your best winners in the quarter. Yes. Wells up 29, Bank of America up 27. It's funny, we had, again, from our survey, over the next 12 months, would you rather buy J.P. Morgan, Goldman Sachs, PayPal, or Square? J.P. Morgan, 48%.
Yeah.
Goldman Sachs, 27%. PayPal's loved, obviously, 24. Zero. Yeah. Square.
Zero.
Zero.
It gets recommended every day.
Square is
zero.
A
recommendation today. I mean, Good Friday is going to be like 4 recommended.
Upgraded to outperform at KBW was Square. Price target remains at 250. It's stunning that Square gets 0 in our vote. But how about the banks?
I'm still way overweight the banks, the financials in general. I think Wells Fargo still has a ways to go. It's only trading at 1 times book value, and we haven't even really seen the results from Charlie Scharf. He's been there a year and a half. He's got a whole new executive committee. They have $8 billion in cost cuts, and they're going to get that asset cap lifted at some point, which is going to be a nice catalyst for shares. It's only up 40% in the past year. Bank of America is most sensitive to rates. So if you're looking to play a rates play, Bank of America is your one. If you're looking for a restructuring story, Wells Fargo is it.
All right, we'll take another quick break. We'll come back. We'll answer your questions. You can email us, askhalftime@cnbc.com. We're back right after this. All right, it's that time. Let's answer your questions. Jim, I'm starting with you, and it's from Henry in guess where? Philadelphia.
Kid's got horse sense.
Henry in the hometown. And by the way, Henry's a youngster. I'm a 14-year-old stock investor, and I want to get into an industrial company. What do the traders think about UNP?
Okay, listen to me, Henry. I think that Geno's is the best of the cheesesteaks, and I think that UNP is the best of the rails. And I think you are dead spot on. And I like the way you roll, Henry. You've got it. So let's stick with Union Pacific. There's a great note today, just raising guides. I got to tell you, there is nothing like a 14-year-old kid from Philly who's obviously going to be the richest person in the world right now, and buy the Sixers when those fantastic hedge fund managers are done owning it.
Yeah, all right, love it. Thank you for the question, Henry. We really appreciate that. All right, next up, Stephanie Link, Rich in Michigan. Sorry about your basketball team yesterday. I'm a long-term investor. What stocks look promising in cybersecurity? What do you think, Steph?
I own Fortinet. I like it. It's a $250 billion total addressable market for the space, so you can't go really wrong. But Fortinet's doing a good job of new products, new partnerships, and their long-term total revenue target is 17% growth with margin expansion and billings of $5 billion. So I like that one a lot.
Okay, Joey, to you from Raleigh in New York. Chewy, what do you think? What do you like to pop in the stock?
Love the pets earnings surprise, profitable surprise here. But I'm playing pause, the ETF, PAWZ. You get fresh pets at home, Zoetis, get a little bit more diversification. Chewy story's good, but that's the way I prefer to play it.
All right, Doc, we're going to take a quick break. We're going to come back, get ready for an unusual activity because I'm coming to you next for that. And as a reminder, you can always watch or listen to us live on the go on the CNBC app. We're back right after this. Dr. J, all right. Unusual activity. What do you got for us?
All right. Well, Scott, we talked a little earlier about athleisure, and this is both athletic and athleisure. It's Under Armour, of course. The stock's around $18. They were buying, Scott, the April 18 calls. Now, these expire in 2 weeks from this coming Friday. And I think this one is, I'm sorry, 3 weeks from this coming Friday. And I think this one's got great potential. They bought a lot of calls very quickly, 9,000 of those. So I'm in those. They were a 75-cent option this morning, Scott. Second one, this one expires April 9th expiration, not all the way out to April 16th, but April 9th. And this one is Snapchat. It's $21, I think, off the 52-week high. They're buying upside calls ahead of earnings. Stock's 51.56. They were buying the 53 calls. Again, April 9th expiration. I'll probably be in those a little over a week, like both of these trades, Scott. So I added to Snap and Under Armour both today.
All right, good stuff. Thanks for those trades, Dr. J. We'll take a quick break. We'll come back. We'll do final trades on the other side.
Missed the show? Don't sweat it. The Halftime Report now has a podcast. Market-moving interviews, call of the day, unusual activity, and of course, Ask Halftime. Look for us on Apple Podcast or your favorite podcasting app and subscribe to the Halftime Pod today.
Level. When the stock breaks down below that support level, then we have significantly to the downside because this is a trend reversal pattern. On PayPal right here, if we broke down below that support level, which is sitting at about $225, then the target down there would be all the way down to 146. Now, we don't know if we'll get there. Right now, this pattern has not completed, but it would be something that investors would be looking at, Scott.
Okay. All right. Well, I think it's much clearer, at least in my mind, how these patterns work. And I like your use of the graphics there to give us an idea where the stock might move based on those chart patterns that we pointed out. All right. Well, Ken, thanks again for helping us break down some of these essential chart patterns. I know there's more. So, Ken, I think we have to get together and do this again and maybe bring up a few more examples of some common chart patterns. All right. Thanks again, Ken. Look forward to seeing you again on Your First Trade. Okay, take care. Well, that's going to do it for us here today on Your First Trade. Thanks again for joining us. Don't forget, we'll be back tomorrow at noon Eastern time to wrap up the week and take a look at our CarMax example earnings trade. So we look forward to seeing you then.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
"24/7 access to diverse global markets. Right here. That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played."
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I don't want any trade minimums.
Yeah, I totally agree. They don't have any of those.
I want to know what I'm paying up front.
Yes, absolutely.
Do you just say yes to everything?
Well, I say no to kale. Yeah, they say if you blanch it, it's better, but that seems like a lot of work.
Now offering 0 commissions on online trades. We charge you less, so you have more to invest.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Afternoon. Welcome to the Watch List. I'm Nicole Petalides. It's 1 p.m. Eastern Time. We're coming to you live from New York City. Thanks for being here with us. Lots of green on the screen on this last trading day of the month of March, so let's check it out. On the Dow right now, you are seeing a gain of 0.14%. The S&P 500 up 0.8%. The NASDAQ 100 up 1.9%. And the Russell 2000 gaining 1 percentage point. Our top story, the tech sector is driving stocks higher. Tesla is back above $650 as President Biden is set to announce his plans to create a national electric vehicle charging system. Stocks are positive. The S&P 500 reaches a new intraday record. Jeff Pierce is with us, contributor for the TD Ameritrade Network, to talk all about this last trading day on this March. And watching the tech stocks rebound, right? We're seeing the NASDAQ certainly doing well. S&P at a record. What are your thoughts here as you see this action today?
Well, it's great for these tech stocks, right? They've been struggling now, especially with these yields that have been going up, but they're finally easing for the first time in the last couple of days. And the Nasdaq is reflecting that. The tech heavy sector there, it's up almost 2%, as you mentioned. We're seeing Amazon, Microsoft, they're almost up 2%. Netflix, Facebook, Apple up all more than 2%. So investors are finally able to look at these stocks and see and decide, maybe there is something to being in these growth stocks. As long as the cost of borrowing is lower for them, we can continue to see that growth.
Right. And so obviously we're talking a lot about Biden's infrastructure plan. Right, and we'll get some more details on it later today. Creating a national EV charging system is part of the chatter here. So what are some of the details that we are hearing? We mentioned that Tesla is getting a little jump. Tell me more.
Yeah, absolutely. And as you mentioned, we were watching the S&P hit intraday highs here, as well as this infrastructure proposal comes out, and we wait for the full address. But the EV side of this is very interesting, and we're watching a lot of companies react to it. The administration says that they're planning to add electric vehicle charging stations into their $2 trillion infrastructure plan, promising around 500,000 of these devices to be installed across the U.S. by 2030. The plan is expected to include about $174 billion for development, adoption of electric vehicles, as well as factory updates, and then maybe most importantly to some folks, those tax incentives for buyers and for people who are involved in the charging infrastructure. So, this is a big number, especially as we continue to try to work towards the electric vehicle market. Right now, according to the Energy Department, only about 2% of the 17 million new vehicles that were sold in 2019 were electric vehicles or hybrid electric vehicles. So there's a long way to go there. But these car makers that we're seeing making these electric vehicles right now are certainly rebounding from it. They're not typically as involved in the infrastructure part when it comes to the charging station. So we do have a lot of companies out there that are specific to that. Tesla, of course, has that in their makeup. Blink Charging, ChargePoint, these companies are all higher today on the news. And certainly that's because the government's going to have to deal with these private companies in some way when they're planning to put this infrastructure out over those years.
Right, absolutely. And, we've talked so much about names like Blink, less about ChargePoint, but you could see it's up double digits to your point. How about the private payroll data we got in? It's certainly a strong improvement from the prior month. What were your thoughts when you saw it? This is ahead of Friday's jobs report.
Sure, absolutely. I mean, I think it's a good number for investors to see ahead of that report. I mean, it didn't quite hit some of the estimates that were out there, but payrolls rose by 517,000. That's the fastest pace we've seen since September, when they rose by 821,000. So that's the most hiring we've seen in workers for the past 6 months. Now, leisure and hospitality added about 169,000 of the 470,000 in service-related jobs. That's good news for that sector. They've certainly been hit the hardest because of the COVID lockdowns. Trade and transportation, 92,000. Business services, 83,000. Education and health services, 68,000. We even saw on the manufacturing side adding 49,000, and construction added 32,000. As these non-farm payroll numbers come out on Friday, expectations are an increase of 650,000. That's up from just 379,000 in February. And so these numbers are good. They missed expectations a little bit, but that's a big leap. And I think it shows that potentially these vaccine rollouts, the relief package, and the faster opening of the economy is starting to add to that labor market.
Yeah. Tell me more. You mentioned vaccine rollouts. There was some news on Pfizer and the vaccine and its efficacy for younger people. Tell me about what the study actually shows.
Sure. Yeah. Pfizer released news that they had a trial, about 2,260 participants for 12 to 15-year-olds. 18 members of the trial got infections, or COVID-19 infections, but those were all out of the placebo group and not part of the group that actually took the vaccine. Pfizer also said they saw a robust antibody response in children that exceeded the group from the 16 to 25-year-old trial that they had. The side effects seem to be consistent, according to them, consistent with what they've seen in adults. And Pfizer says that they plan to submit the new vaccine data to the FDA as soon as possible. A former commissioner of the FDA, who's now on the Pfizer board, says that he expects it'll take them about a month to review the data. And then after that, it seems like kids could potentially be eligible for the vaccine before the new school year. So this is good news on that front.
I think when I hear 100% effective, I mean, that's like when they say, don't say always or never. 100%. I mean, why don't they say 99% and leave room for something? So it's perfectly perfect. Okay, well, that sounds like great news. Jeff Pierce, thank you. TD Ameritrade Network contributor Jeff Pierce, thanks. Turning our attention now to the broader markets. Today is the last day of trading for the month and the quarter. Jill Malandrino is with us, global markets reporter of the NASDAQ, to take a look as we close out this March and the quarter on a positive note. Certainly strength for some of the indices, not necessarily for the NASDAQ. Your thoughts, Jill?
Yeah, it's pretty interesting, Nicole, to see where we are just 1 year from the COVID-19 lows. It really is quite remarkable. And as you mentioned, stocks moving higher on the final trading day of the month and quarter, the S&P 500 hitting a record intraday high in both the S&P and Dow, on track for their best monthly return since November, while the NASDAQ turns positive on this month with today's rotation back into tech. While the market awaits details on President Joe Biden's $2.25 trillion infrastructure and jobs program, the Biden administration is rolling out on Wednesday $174 billion plan to spur the development and adoption of EVs, as your guest before was mentioning. That includes money to retool factories and boost domestic supply of materials, tax incentives for EV buyers, and grant and incentive programs for charging infrastructure, green technology stocks, solar names in particular, and some material shares like U.S. Steel have been rising into the stimulus plan. That said, Biden's plan to pay for the program with tax increases will be a major obstacle in getting any support from lawmakers. And it takes a mix of private and public partnerships that can involve local municipalities, businesses, and utility companies, as well as automakers and an emerging group of EV charging companies. It's also a question of demand. Plug-in vehicles, which include EVs and hybrid electric vehicles with traditional engines, only accounted for about 2% of the more than 17 million new vehicles sold domestically in 2019. That's according to the Energy Department. But at the end of the day, I think it's a matter of when, not if, when it comes to the EV market. So, this is just a trajectory that's only going to see growth.
Yeah, and I see a mixed bag there, but it's certainly helping names, as we were saying, NIO, Tesla, and Blink and ChargePoint. And as far as the tax rate, the corporate tax rate going up to 28% from the Trump administration's 21%, but it's still lower than the Obama administration's 35%. So we'll see if they can get some support for this. Tell me about the housing data. It continues to show supply is quite thin, right? What are your thoughts when you see the pending home sales numbers? Because I hear so many great things about houses and housing and how hot the market is. But at the same time, some of these home sales numbers have not been particularly great.
Well, anecdotally, Nicole, I can tell you I'm closing on a house next week. And when you talk about thin supply, the competition, the amount of offers that are going out on homes, I read a stat last week that for every house that was sold, 4 offers were on the home, which is quite remarkable. And we're seeing it in the data. Pending home sales fell over 10%, worse than the forecast decline of 3%. That's compared to a previous decline of 2.8%. And sales are now varying dramatically by price point, because supply is so lean on the low end and more plentiful on the higher end. But home prices continue to climb higher, however. They are up more than 11% from a year ago. That's according to S&P Case-Shiller Home Price Index. The price increases are the strongest at the lower end of the market, where supply is weakest and bidding wars are rampant. That really is where the competition is. A recent rise in mortgage rates does not appear to be affecting home buyer demand. Rates are just about at 3.5% at this point. That is, quite an increase from what we saw in February, and that does not seem to be curbing demand whatsoever. At the end of the day, even though it's at 3.5%, and we haven't seen those levels in quite some time, at the end of the day, think about what they were in the 80s, right? That our parents were paying on their mortgages. It's not even close.
Yeah, it's true. Home builders are all higher today. I see D.R. Horton, the best of the bunch, up over 1%. And you make a great point. The battle is on, multiple offers, and you have to put a lot down, right? If you only have 5% down, you might get edged out. Tell me about what's going on with PayPal and Bitcoin. More news on this, right?
Yep, just continuing to see that mass adoption. PayPal to announce it's starting to allow U.S. consumers to use their crypto holdings to pay at millions of its online merchants globally, a move that could significantly boost use of digital assets in everyday commerce. And again, we're continuing to see these announcements of mass adoption, whether it's through retail or commerce, or if you're seeing large banks or large insurance companies adding Bitcoin to their balance sheets. And the service, which PayPal revealed it was working on late last year, will be available all of its 29 million merchants in the coming months. More details will continue to roll out, but you're just seeing, Nicole, and this is a big part of your coverage, this is every day we're hearing of new companies coming online, whether it's Bitcoin or other forms of cryptocurrency. We know about the Ethereum technology, the blockchain technology that this all runs on. And again, this is an area that's growing. We're seeing it even with the next gen, with issuers versus legacy payment processors. it's again on that trajectory that legacy companies are just not seeing.
Yeah. Great to see you, Jill Malandrino. Thank you so much. Global markets reporter of the NASDAQ. Thank you, Jill. Coming up next, Andrew Graham is standing by with a few stock picks for you, including why he likes Burlington stores in the discount retail space. We'll explain that. Later this hour, the CEO of 908 Devices joins me to discuss the company's first earnings report since going public in December. Tom White will have a preview of CarMax earnings, which is expected to report tomorrow morning before the opening bell. And our panel is set and ready to talk semiconductors and have an outlook for Micron in particular, which reports its numbers after the bell today. Stay with us.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The platform demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome back. Let's take a look at the biggest movers in the market right now. Apple shares are trading higher after UBS upgraded the stock to buy from neutral, raised the price target up to $142 from $115. The analyst expects iPhone demand in fiscal 2021 and 22 to be relatively stable in line with historic demand trends. The analyst raised his fiscal 2022 earnings estimate by 7% and revenue by 4%. Walgreens jumps after reporting positive earnings for the quarter. Earnings came in at $1.26 a share. Revenue, $32.8 billion. Meanwhile, Walgreens said it has administered over 8 million COVID vaccines to date. The company raised its full-year earnings per share guidance to mid to high single-digit growth. Shares of Square rise after Keefe, Bruyette & Woods upgrading the stock to outperform from market perform, maintaining price target of $250. The analyst calls the company a long-term winner with an underserved market. And to the downside, Delta Airlines trading lower. It announced plans to resume filling that middle seat starting May 1st. Delta was the last U.S. carrier blocking the middle seats in coach sections. The airline did cite rising vaccination rates and growing demand as factors behind this decision. And Lululemon under some pressure after a slew of analysts lowered the price targets on this. Jefferies, for example, lowered it to $330 from $370. Investors are worried about the company's growth outlook after its guidance for the current quarter came in below expectations. As for the fourth quarter earnings, the retailer reported earnings of $2.58 per share on revenue of $1.7 billion last night. Okay, here's a look now at Bitcoin. We just finished talking about that along with PayPal. It's up about 0.5%, 59,975. The U.S. flash PMI for March reached the highest reading in a decade. What does this mean for inflation? Andrew Graham is watching that, CEO of Jackson Square Capital, to give us his thoughts. What are you thinking? Inflation fears or not really?
I think there's a shot that inflation, measured by core PCE in the third quarter, could come ahead of the 2% target. We don't see it being a big overshoot, but bottleneck pressures are building, like you said. Flash March U.S. PMIs well ahead of expectations. Tomorrow we get global PMI data, and we expect to see a big uptick there. We think the boom in global growth that we were expecting has arrived.
So you said maybe in the next quarter we could even see this growth above the 2%. Does it really matter? I mean, what else do you watch along with this, right? Obviously, you keep a keen eye on interest rates, which, for example, the 10-year bond yield's at a 14-month high. What's the tie-in here?
The tie-in is probably inflation break-even yields. Those are the bonds that we can follow the difference between nominal yields and inflation rates, and those are not quite at 2%, and I just think that that's probably the one risk. I don't see it as a big risk for the economy necessarily, but it probably means that nominal yields have higher to go after a brief pause in here. I think what you're seeing today with a lot of the growth stocks rallying and bond yields sort of just basing and hanging out has to do with sort of an early start to a reversal in the pension fund rebalancing trade that started 3 weeks ago. So after maybe a period of 1 or 2 weeks after that sort of plays out, we expect bond yields to get back to sort of the yield backup that we saw. Maybe nothing quite as sharp as what we saw, but I think probably 190 next quarter, maybe even, and 2% before year end. Yeah.
So the rising inflation and yields don't seem scary to you. Maybe is like if it moves quickly or more in the near term, and I get what you're saying, but it should even out is what it seems to be saying. But you have some stock picks, and I guess you're keeping inflation and these bond yields in mind as you're making these picks, right? Is it hard to pick stocks during this environment, or not necessarily, because it should all go in stride?
I think so. We take it all in stride. We got to play the cards we're dealt. We had a much easier time in the spring and summer when it was just, really, really obvious to us what to do. But really, since mid-September, since real yields looked like they were bottoming to us, we made this switch to cyclical value stocks. And what we're doing now is trying to emphasize the reopening trade a little bit in our picks. So we're out. You mentioned Burlington, before it came on, and it's a stock we like a lot. It's sort of a hybrid between a department store and an off-price retailer. The company was set to deliver 300 to 400 basis points of EBIT expansion coming into the pandemic, and coming out, they're in the exact same place, but now they've got a favorable real estate backdrop as well. So the off-price retailers like TJX and like Ross stores. Those companies are, mid-single digit, high single digit earnings compounder, earnings growers. And we see Burlington having the opportunity to exceed that. A lot of store growth, delivering on that 300 to 400 bips of EBIT expansion. CEO came from Ross stores a few years ago, so he's got the playbook to deliver what should be a best-in-class off-price retailer when we look out maybe a year to 2 years.
Right. Yeah. I'm glad you explained why you like it at this time. Burlington, you also have American Express and Brookfield Asset Management. Tell me about American Express first. We were just watching some names in the payment space. Why Amex?
Yeah. So one of the things that we didn't discuss in sort of the growth outlook, and one of the reasons why we're so convinced at any rate that the boom has started. If you look at last week's card usage data in the United States, it was up 1,800 basis points, which is a significant acceleration. And so card companies like American Express are going to be able to have strong earnings growth just on reserve releases that they took during the pandemic, on increasing buybacks, and on an increase in consumer spending that I mentioned. So if you look at December and January, card spending was up a lot. And that's without California, New York, Illinois fully reopened. So that's going to accelerate some more. They have the best credit margins in the business, and so they'll have the largest reserve releases as well, upside there.
Right. And then Brookfield Asset Management. Tell me about that one. BAM.
Yeah, BAM's like in the right place at the right time. They're alternative asset manager in real assets, so real estate and infrastructure, if that rings a bell to anybody. They're also well-timed fundraising cycle, which they're involved in right now, and I understand things are going better than planned. So they're kind of changing the way that capital is allocated. They take their own money and they used to invest it in their flagship funds. Their flagship funds have track records that stand on their own, and what they felt that was happening, they were crowding out some of that third-party capital that wanted to invest in the flagship funds. So now they're allocating more of their own assets to new funds, sort of co-investing with new third-party assets. It's a great financial in terms of timing. That's the place to be in value. I feel predominantly is financials. So I see probably 27%, maybe 30% upside to a $60 target, maybe sometime within the next 2 to 3 quarters.
Yeah, well, it's at 44, so certainly some upside potential there, Andrew. Thank you so much. Great to see you. We love having you on the show. Andrew Graham, CEO, Jackson Square Capital. Thank you.
Thanks.
Coming up next, the CEO of 908 Devices joins me to discuss the company's first earnings report since going public and details of a new contract with the U.S. Army. Don't forget, 5 p.m. Eastern Time, right here, Market Overtime. We will focus on what you need to know for your long-term portfolio. Market Overtime airs weekdays, 5 p.m., right here on the TD Ameritrade Network.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today. Technical traders, the Chartmaster is in the building. Trends, support and resistance, key patterns, and technical indicators. The Chartmaster has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Welcome back to the Watch List. I'm Nicole Petalides. Back in December, 908 Devices went public. This week, the life sciences tools company announced the first earnings report as a public company. Kevin Knopp is with us, CEO, co-founder, 908 Devices, joining me now. So tell us a little bit about what the company is doing. I know you have some exciting news and partnerships at this point, but give folks a little understanding of exactly what the company does.
Yeah, absolutely. We'd love to. Thank you, Nicole, for having me on today. 908, we're a 9-year-old company headquartered in the Boston area, and we're really working on a mission to change how you do chemical analysis. and where that gets done. And we have a disruptive platform that takes what's thought of as a gold standard technique of mass spectrometry out of a centralized lab environment and takes it to what we think of as the point of need. And to us, it's more analogous to the evolution of the computer industry, going from the supercomputers and mainframes that are out there to the desktops and laptops and now even all the way to mobile devices. So we're really democratizing the technology, and we're making simple, convenient, easy to use handheld and desktop devices and now that are much more accessible to a broader range of customers, from the likes of the FBI to the FDA. And we serve applications from forensics to biopharmaceutical applications, and really anywhere someone's looking to get actionable information at that point of need to move forward.
You talk about the FDA, the FBI, and now we're seeing obviously partnership with the U.S. Army, $25 million. What do these bureaus and parts of our U.S. nation, which I love, I'm such a patriot, what are they expecting from you?
Yeah, so we all told, we've got about 1,350 devices that are out there across 34 countries and many large government users, as you just mentioned, and the new one that we're excited about here with the partnership with the Army, but also leading academic organizations and 19 of the top 20 pharmaceutical organizations that are out there. And in all cases, they're really employing our devices to get immediate information about trace chemicals or biochemicals right there where they're doing their work. In the case of our handheld devices that we are announcing with the U.S. Army partnership, they're really employing a device that's about the size of a child's lunchbox, but brings lab-grade results into the field so they can measure very simply toxic chemicals. They can measure trace amounts of compounds, drugs, fentanyl, synthetic opioids, other things that are tremendous hazards to a first responder in a broad context. So they're looking to employ our devices to improve their senses, if you will, and have a better understanding of their operational environment and provide them a quality, rapid answer to move forward in their workflow.
And when I look at what's going on here with the quarterly numbers, worse than expected earnings per share, but what's the growth going forward?
Yeah, we're really focused on the top line revenue side. We experienced about 50% growth in 2020 to around $27 million. And then this year, we've given guidance yesterday of the range of $38 to $40 million, which is about a 45% growth in the midpoint. So we're absolutely focused on taking our innovative technology platform out into the marketplace and fielding devices that are really disruptive in nature and very impactful on the customer's workflows.
When we talk about competition, you know, we often think about aerospace and defense, right? And who gets what contracts and why. What kind of competition do you face? Because it sounds like you really have the highest level of our government, our educational institutions, pharma, they're all working closely with you. And this is obviously high-level intelligence as well. So how is it that you're getting chosen, and what challenges do you see keeping off the competition?
Yeah, Nicole, I think it really comes back to our technology platform. We're working in an area of mass spectrometry. It's well known in the life sciences space as that gold standard of chemical analysis that just provides a very sensitive and very selective answer that allows people to distinguish chemicals and biochemicals so well. And we have an approach that's very uniquely positioned to these centralized approaches. And the systems in the labs are a wonderful thing, and they do sit, as you mentioned, in the large academic organizations or pharmaceutical systems. But we have an approach that allows us to take it out into handhelds and desktops, small devices that can be employed by the non-expert in mass spec or chromatography, meaning getting it as a tool out to democratize it to end users rather than being limited or held back, if you will, or or only being applicable to those with a PhD in a centralized lab environment. So yeah, we're getting a traction by those customers and some great names. We've got good partnership and adoption from across the pharmaceutical, government, and academic area, because of the broad nature of the platform and its differentiation compared to other technologies that are out there and competing approaches.
You know, I was looking through some of the analyst reports, Leerink, for example, very positive on your company. In fact, saying that the analyst there believes it's conservative, your outlook for revenue going forward. You tell me, do you think you're being conservative? And I'll add one more question. Are you excited that someone like Cathie Wood of ARC is bullish on your company and making a case for the stock? I mean, she really is high level and highly visible.
Right. Yeah, we're certainly excited by the public offering that we did just in mid-December of 2020, and the host of investors that have been able to join us on our next phase of this journey. So we're super excited about all of those, and to be partnered together and to have all of those organizations see the future potential with us here and have now the capital to go after it. In terms of guidance, we think we're being appropriate. We really are working to do what we say we're going to do, and we're progressing with our customers and accounts as planned, and we'll keep the street updated. But we think we've given an appropriate guidance, and we think it's offering considerable growth compared to 2020.
Wow. All right. Well, we hope to have you back on the show soon. Keep giving us these updates. Kevin Knopp, great conversation. Really appreciate it. And congratulations to you on your latest, obviously, partnership now with the U.S. Army. CEO, co-founder, 908 Devices. Thanks, Kevin. Still ahead in the second half of our show, Tom White standing by with a preview of CarMax earnings. The company reports before the opening bell tomorrow. As we head to break, let's take a look at some of today's winners and losers in the S&P 500.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome back to the Watch List. I'm Nicole Petalides. Thanks for being here with us. We're coming to you live from New York City. 2.5 hours left in the trading session, all up arrows across the board. The NASDAQ certainly showing some strength today, while the Dow is gaining at this moment 0.25%. The S&P 500 up 0.88%. The NASDAQ 100 up 2 full percentage points. The Russell 2000 up 1.5%. Tom White is standing by, contributor for the TD Ameritrade Network, to take a close look at CarMax. We've seen, obviously, a lot of cars, used cars that have been for sale. People, you know, just like they're do-it-yourself and fixing up the homes, they're fixing up a lot of the older cars, too. Tell me more about CarMax.
Yeah, Nicole, I think one of the biggest concerns going into this report is going to be that shortage of the chips that go into automobiles, and that's going to affect new car sales. Now, what does that do for the used car market? Well, that actually helps the used car market as they've seen demand grow. I think one of the biggest transformations that CarMax is doing right now is their omni-channel business, where they're going head-to-head with Carvana and Cars.com, where they're going to, you know, up their presence of online buying as opposed to their big mega stores that they have in most of the major markets. So I think those are going to be two of the big concerns. EPS estimates are for $1.27 and revenues of about $5.15 billion. Now, EPS is going to be a little bit lower than year-ago levels, but at the same time, they're actually cutting some of their costs, and they're hoping that their margins improve as the cost of those used cars are starting to grow a little bit. If you look at the coronavirus-induced economic uncertainty, you know, maybe users and buyers are actually looking for that used car as opposed to a brand new car, which might cost a lot more. So I think there's some positives to look at this, but the stock's just off all-time highs here, Nicole, that we hit just yesterday, up 42 or 41.5% so far year to date. So it's had a really great run over the last 3 months.
Yeah, and what was behind the move from Seaport Global, right? Downgrading. No more buy rating on this stock from the analysts. What's Seaport Global thinking here?
Yeah, I think it's, you know, maybe a warning sign to people that have been riding this stock. Is the fundamental story done for this company because of the big strides that the stock price has made? He still likes the story. The analyst loves the story that CarMax is in, and you know, the competition that created from Carvana. They've actually expanded at a rapid pace their omni-channel business that I talked about earlier, where it's buy online, direct to consumer. But I think he looks at the record high levels in the stock. Valuations are getting to the high end of their historical range, and the strong fundamentals that the company currently possesses are basically priced in the stock, and he sees, you know, it's balanced right here. So maybe he's not really downgrading the actual company itself, but what he's saying is it's run up so far so fast, maybe it's time to take a pause here. And if you look at the Carvana earnings that came out last month, Nicole, we saw, you know, strong momentum going into that quarter. Stock was at record levels and sold off post earnings, even though it was a decent report. So expect maybe a little bit of volatility, but I think the key will be the conference call tomorrow morning from the CEO, and where they'll give us a little bit more clarity on guidance moving forward.
Yeah, and you know, I mean, they both have done so incredibly well. And I see why maybe they're saying to take a little off the table here from Seaport. We saw, as you said, a nice move, but it's up 150% for CarMax in 1 year. But Carvana is up almost 400%. I mean, pretty great moves for these companies. Tom White, thank you so much. Tom White, contributor for the TD Ameritrade Network. Let's turn our attention right to the broader market once again. Alex Shahidi is with us, managing partner, co-CIO at Invoke Advisors. We're talking about the economy, right? The reopening, vaccines. We're seeing a lot of excitement about jobs in leisure and hospitality. Is there a concern about inflation? How concerned are you?
Hi, Nicole. It's nice to see you again. A little bit concerned. It's remarkable how different Q1 of this year is versus Q1 of last year. Inflation pressures are picking up now. Growth is picking up. And just a year ago, we had deflation concerns, and growth had plummeted. And so you've had this remarkable recovery. And a lot of that is based on coming out of the pandemic, as you mentioned, but all the fiscal and monetary stimulus, the printing of money, the fiscal packages. And as we come out of this pandemic, caused downturn, inflation pressures could certainly build. And what's really interesting is we're hearing more and more talk of inflation pressures. Interest rates are starting to rise, but investors, for the most part, are significantly underweight inflation hedges. They don't typically own gold or commodities or inflation-linked bonds. So that's one thing that we're noticing across the markets.
So money printing and some rotation that's been happening. So the question is, do these trends continue? And how do your investment strategies change to this current environment?
Yeah, I think it's helpful to think within a risk parity framework, which is how we think about the world, where you own assets that do well in different economic environments. And so you go back a year ago, you had collapsing growth, collapsing inflation. So assets like TIPS, treasuries, and gold went up when equities and commodities fell. And now in Q1 of this year, it's literally the exact opposite environment, where commodities are the best asset, equities are doing fine, but TIPS, treasuries, and gold are down. And I think if you think in that framework, it's really helpful when you look ahead with the wide range of potential outcomes. Inflation could pick up, but you could even have emerging deflation pressures again if the virus resurfaces or fiscal stimulus slows. So I think what we advise our clients is to be well balanced, own assets that do well in different environments, so you don't have to keep guessing which way the markets are going to go.
Right. Tell me more about the RPAR risk parity ETF, because this is one way to get involved in exactly the investment strategy that you're describing.
It is, and it's an ETF that we launched just before the global pandemic. And I think the idea there is own all these assets in a very efficient way, in a very balanced way, so that you're indifferent to what the environment looks like. So a year ago, in Q1 of last year, the market collapsed, stocks were down 21%, the ETF was down just 4%. And it didn't predict what was going to happen, it's just well balanced all the time. Then you get this remarkable recovery. Even though the pandemic was raging on, stocks hit a low in mid-March and rose from there. And the ETF was up over 20% the final 3 quarters and finished the year up 19%. So protecting on the downside, participated on the upside, did well through the whole period. And looking forward, something like that we think makes a lot of sense because it gives you that exposure across different economic environments.
I know you're watching gold and other commodities, particularly as a hedge against inflation, right? You just talked about the action that we've been seeing in commodities this year versus last year. What commodities do you like best at this point?
We think of it again in a more balanced way. There's energy, obviously, which has bounced back. There are the miners, which could fuel this, boom in clean energy. You need a lot of that, those materials to build that clean energy infrastructure. So we're seeing a bounce there. Agriculture could rally. And so a more balanced mix across those commodities makes sense. And then on top of that, gold, which we know is down this year, which was up significantly last year, is a really good hedge against more industrial commodities. So a diversified basket of commodities we think makes a lot of sense.
I see gold today at 1714. But as you said, we're watching energy closely, which has had a great run. Alex Shahidi, thank you so much. Managing Partner, Co-CIO, Evoke Advisors. Thank you, Alex.
Thank you.
Still ahead, we're going to bring in our panel to preview Micron earnings. They come out after the bell today. And let's head to break. We're going to check in on the cannabis stocks because they are moving higher as Governor Cuomo here in New York signed legislation legalizing adult use cannabis right here in this state. New York is the 15th state to legalize recreational usage.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock. but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduced strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full options for volatility course and a whole lot more.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
I'm Maria Schrader. Here are a few stocks moving this hour. MKM Partners said Snap, the parent company of Snapchat, looks attractive for asymmetric upside. Shares have fallen about 20% in the last 2 weeks, which the firm says raises the likelihood of significant upside reaction to its upcoming earnings on April 20th. They also see data for traffic and mobile app downloads as possible near-term catalysts for Snap. Shares are up over 5% today. Chewy saw several analyst updates today after it beat earnings Tuesday after the bell. Bank of America says several signs point to Chewy's healthy growth in the long run and sees a subscription model supporting upside to shares. Morgan Stanley raised its price target to $83 from $76 and called Chewy a top-line market share-driven story. Jefferies raised its price target to $105 from $100. Chewy shares are up over 6% today. Short seller Geosaphat Research released a report accusing Amdocs of a massive financial deception and calling it uninvestable. The firm says that it found widely overstated profit margins, a shaky balance sheet, and a revolving door of auditors after reviewing registry filings from subsidiaries. Amdocs said that the report includes speculation and misleading claims. Shares are down over 8% today. This has been your TD Ameritrade Network Market Update. Now back to the watch list with Nicole Petalides.
Maria Schrader, thanks so much. Micron Technology reports its earnings today after the bell. Angelo Zeno, Senior Equity Analyst at CFRA Research, and Daniel Rubino, Executive Editor, Windows Central. Glad to have you both on today because this is a hot topic. I just was reading about Biden's plan, infrastructure plan, $50 billion now moving towards chips because we know we have a shortage, and that's one area that everybody's focusing on. So I'll start with you, Angelo. You have a hold rating on Micron in particular. I want you to explain what it is about Micron, why the hold, and what you think and expect for the earnings today.
Yeah, I mean, as far as Micron is concerned, I mean, and let me just start off by saying we love the broader, we think there are better ways to play the market today than Micron specifically. But as far as kind of what we expect here for the quarter, the company already pre-announced, so we expect them to report revenue of at least $6.2 billion. I think what's going to be more important is going to be what the guidance looks like. I think they need at least $7 billion in revenue, to excite, let's say Wall Street expectations. I think also what's going to be important to look at is the margin side of things, the gross margins. Expectations, let's call it around 32-33%. I think if there's that one potential hiccup that they can guide to in terms of the May quarter, it might be the expectation for gross margins of, let's say, about 37%. And then it'll also be interesting to kind of see what kind of outlook they provide in terms of pricing, CapEx, as we kind of progress, into the second half of the year and even into potentially 2022. But that being said, we continue to like or favor more the chip equipment players, as well as more of the automotive type of plays out there, like an NXP Semiconductors, rather than a Micron, which continues to face volatility on the pricing side of things. Definitely favorable here in the near term, but long term, definitely going to be volatility.
Yeah. Daniel, why don't you expand on this? So we have Micron after the bell. I know that the street is looking for that $7 billion revenue guidance. So if it's under that, I think there will be a certain element of disappointment. That being said, there's a clear chip shortage and some pricing power for companies like Micron and the others, right? Is Micron a name you like?
Yeah, so this business of DRAM and NAND, which is what they specialize in, it's kind of volatile, or at least it's very cyclical. And so we have supply-demand issues that have typically and historically come up here, which is exactly what we were just talking about in terms of guidance, what the next quarter is going to look like. I've been kind of surprised by how much demand has actually kept up. We're not out of this pandemic yet, but obviously we're nearing the end of it. But the sales of PC, smartphones, and IoT, and of course server demand for cloud, is still stronger than even I anticipated. And that's what everybody is kind of anticipating that we're going to see for the next few quarters. Now, we have to understand here that Micron is only one of 3 major competitors in this area, with Samsung being the other. And Samsung is very well diversified, obviously, so not as big of a player. But then you have SK Hynix, which is the other major player out of Korea. And they're also seeing pretty bullish in terms of what their expectations are for this quarter as well as next. Now, some are predicting this will go well into 2022. I find that a little overly positive, but we are seeing a lot from the PC makers, which is where my specialty is right now, in terms of new products, strong demand, and a lot of innovation. And of course, Micron is right there for that, as well as 5G phones. Now, 5G itself hasn't sold very well, but we have to remember the individual components in the phones for 5G are actually, there's more of them than typical 4G phones. So volume can be lower, but Micron could still do well here, even with those lower sales.
Right, yeah. Angelo, we talk about competition, and Micron is one of a few doing exactly what it's doing. I was reading through your note, and you talked about the different areas of Micron, 4 different areas within Micron. But we think of chips as a broad-based sort of strategy, right? Chip shortage. Okay, great. That means cars. That means gaming. That means servers. What names do you like more than others, or do you recommend the ETF? Because I know you have a hold on Micron at the moment. Are there any names in chips in particular or tech, something related, that you do have a buy or a strong buy on?
Yeah, I mean, I'd say, specifically within kind of the semi universe, I mean, we do favor NXP as well as On Semiconductor. On Semiconductor has some activist interest, within the name, and we do think there's going to be a lot of positives as the year progresses, not only on the EV side of things, but also as they approach that analyst day later this year with potential changes to the business model there. So those are 2 names we like a lot. Given the answer, I'd say. Also, in terms of more on the chip equipment side of things, we'd rather see investors focus on a name like KLA Tencor, and a big reason for that. I mean, a lot of people have had kind of what Intel's doing on their side of things in terms of building their foundry services, and just the overall kind of need for more capital spending from these chip makers out there, and our belief that you're going to see kind of less efficient, smaller type of fabs out there over time. That's going to bode very well for a number of these chip equipment names, but our favorite name within that space is KLA.
And Daniel, I'll give you the final thought as we talk about the shortage and we look at gaming and we look at autos. Where do you like quickly?
Yeah, so I mean, Intel is actually really interesting. They made some big moves this week, and I know they've been on the outs for a lot of people recently, but I like what I'm seeing from the new leadership there, and so that's very good. On Semi is also very good, and of course NVIDIA. They've been, I think, a little underwhelmed this year in terms of performance, but they're obviously still a big player in terms of gaming is still massive. Their GPUs are doing very well. We're still seeing a huge push into cloud computing, so I still think they're very well positioned. Although the value there is not quite as strong as buying into something like Micron, but I still think they're an interesting stock to watch.
Yeah, and look, the group is doing great today, all up arrows. Thank you both, Angelo and Daniel. Angelo Zeno, Senior Equity Analyst at CFRA Research. Daniel Rubino, Executive Editor, Windows Central. Thanks so much, gentlemen. I appreciate it. Good conversation. Midday Trade is next. Alex Coffey standing by. What will you be trading today?
Nicole, great show as always. Looking forward to the show coming up here on Midday Trade as well. A lot of the action today is being driven by these mega cap names. I'm going to focus on two of them. We're going to start with Alphabet, the Class C shares, the old Google, GOOG, and then I'm going to close out the show. Evelyn Baker and Ken Rose are going to stop by. We're going to unpack Facebook. So two of the biggest players in digital ads.
Yeah, I mean, I think that's great. FANG is doing well today. Overall, along with tech, Apple got a nice upgrade, and I know you're taking a look at Facebook and Google, so Alphabet, so we'll look forward to that. Alex, thank you. And thank you, friends. That's going to do it for us here on the watch list today. Don't forget, tune in every single weekday, 5 p.m. Eastern Time for Market Overtime. We'll focus on what you need to know for your long-term portfolio. I'm Nicole Petalides. Have a great, safe afternoon, and I'll see you at 5 p.m.
24/7 access to diverse global markets. Right here.
That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Good afternoon and welcome to Midday Trade. I'm Alex Coffey filling in this week for Kevin Hinks. As he would say, it's 1 o'clock here in Chicago. Let's see where things sit with a couple hours left in the trading session. Real quick, we'll take a look at the four major indices. S&P 500 right now up 33, the NASDAQ 100 up 244, the Russell 2000 up 33, and the Dow Jones up 63. We have a lot to unpack today on today's show. You're going to see there the NASDAQ is the outperformer of the session. And as I said in the preview, we're going to focus in on a couple of those big NASDAQ names. We're going to look at Alphabet here in just a moment. And then later on in the show, Evelyn Baker and Ken Rose will help me unpack Facebook, a stock that may be on the verge of a breakout this afternoon. So we'll focus on that as well. Let's take a quick look as well at what is moving beyond just equities. If you take a look within some of these risk-off assets as well, you're going to see the 10-year yield has stabilized after a little bit of pressure this morning as bonds saw a bid earlier in the session, but they're back up towards the highs of the session here, 1.73. The red and the green lines here represent yesterday's high and low. So still, all things considered, we're well off yesterday's high. As we filter through, we can look at volatility. Volatility back below 20, 1906. It's down about half a vol point and well below yesterday's low as well, represented by that red line. Flipping through here to gold. Gold making a powerful comeback today after some pretty extraordinary volatility to start this week. And as we kind of round the turn on the middle part of the week here, you're seeing gold bounce back up $25.70, basically completely undoing yesterday's weakness back towards yesterday's high, 1711.20. That's 1.5%. Oftentimes, when you do see a move higher in gold, you can kind of speculate that that may mean that there was a downwards move on the U.S. dollar, and you're seeing that again today. U.S. dollar index futures /DX on the Thinkorswim platform, 93.15. Down small. They bounced a little bit here as the day has gone on. They're down about 16 cents. Still a very, very strong product. As we zoom out over a 5-day, 15-minute period, you're going to see it's been a steady stair climb up here for the U.S. dollar, although giving back some of those gains throughout today's session. In crude oil, we've talked about this one as well. We might as well just pull it up on a 5-day, 15-minute here real quick. It's been up, down, up, down, up, down for crude oil, and a little bit of up and down today, as although crude oil has started to fall a little bit sharper as the day has gone on. 59.64, breaking below 60 a barrel once again, down 1.5%, although we have bounced a little bit off those lows, about 50 cents off the lows. All right, let's talk some Alphabet, because when you look at the FANG component of the market, when you look at the mega cap tech component of the market, we can flip over to the Market Watch tab and go to the NASDAQ 100 here on the heat map. You're going to see a lot of bright green for some of these big squares and rectangles here that make up our heat map. And those big rectangles consist primarily of these mega cap companies, as they have the biggest market cap weight. Therefore, in a market cap weighted index in terms of the calculation, like the NASDAQ 100, like the S&P 500, they're going to carry the most important weight. And when you see these names outperforming, it's oftentimes associated with the NASDAQ day that is outperforming its other index peers here in the U.S. And you see Alphabet up a healthy 1.5%, and Facebook, what we'll talk about later on in the show, up 2.9% today. So some strength here in the mega cap trade. But when we talk about Facebook and Alphabet, particularly Google, as we often refer to it, based off of its symbol and its former name, and its search product, which makes up a vast portion of its revenue, we're really talking about the digital advertising space. And so when you look at the pricing of some of these products, they're still reflecting pretty robust demand. And when you're looking at them, it's pretty incredible, some of the optimism that's still expressed here in this space. And Alphabet, however, even though some of these names have struggled a little bit over the past let's say 6 months or so, you can compare and contrast this maybe with an Apple. You're going to see a name that's kind of gone sideways for 6 months. Well, if you click up GOOG, which is the Class C shares of Alphabet, you're going to see a name that's essentially near the high end of its range. So this is a name that has outperformed its mega cap peers as of late, and it has continued to be strong, even in spite some of these growth names falling out of favor a little bit. And so Alphabet 2081, the first thing you're going to notice is a $2,000 stock. And when it's a $2,000 stock, it makes trading it, at least in terms of stock shares and such, a little bit less accessible to the average trader. Of course, if you got a massive account, some of the strategies that we talk about on lower stock price names will still be kind of in your toolbox. But for the majority of us, Alphabet is a name that if we want to participate in it and we want to get kind of exposure to this name, we have to look to risk-defined option strategies to make this one and kind of put it into a bite-sized piece that we can actually afford into the account. And we're also comfortable with the risk that it ensures as well. Because you're talking about a name today that 1.25% is a $25 move. So this is one that moves around quite substantially as well, just the nature of it being a bigger product. Compare and contrast this to the Russell 2000 as an indice or as an index. I mean, the Russell 2000 is a 2,200 point index. So it's comparable in terms of exposure if you were looking at undefined risk strategies or stock shares to an index itself. And so when we come to trading Alphabet, what we're going to look at is, first off, you're going to see weekly options. You're going to see tons of different strikes here available, basically every $2.50. So you have plenty of things to choose from, but what we're going to do is focus in on the chart itself, and we're going to look for a couple things. The first thing we're going to notice is that we have an earnings date towards the end of April in terms of an estimated time frame for when we should expect that. So unless I had some conviction that I didn't want to, I wasn't too concerned with the potential fundamental update of a company driving some volatility in one way or another, I more than likely, if I'm using an option-based strategy, I probably would want to stay ahead of that date. And so we're going to keep that in mind, and we're going to stick to the April monthlies. Well, the first thing that has stuck out to me from a price action standpoint, we'll really zoom in on this here over the past month and a half, 2 months, has been that Alphabet has been a very range-bound name in a very tight range. So if we're looking at this in terms of a company that is kind of meandering around looking for its next move, if we don't get anything that can be that catalyst over the next couple weeks, maybe that next catalyst is going to be the earnings event. And so we could potentially expect some similar price action to what we have seen over the last month and a half leading into that. And so that's kind of the logic that we're going to use to build out this example trade, which I actually already have built out. So if we flip over to the Analyze tab, what we'll look at here is an iron condor strategy in Alphabet. And so we're using, again, the Class C shares of Alphabet. And what we've done is we've gone to the April 16th monthly expiration for the options. And if we flip back to our chart, what we'll see is that the high, and this is an all-time high for Alphabet, is 2152.68. And so what I've done is I've selected a strike that gives us a little bit of wiggle room on that, but essentially uses that as the anchor as a potential resistance level to the upside. It's a level that we've fallen from on basically every attempt that we've made to break towards that. 21.25 has really been kind of a level that we've failed to get back above, and it's close to the closing all-time high as well. On the downside, we've selected the 2000 strike, and we're selling the 2000 put as the downside of our iron condor. And you're going to see that this corresponds pretty nicely to kind of those lows ever since we gapped up on the last earnings release. And so when you look at that, it looks like the low is just above that, but from a closing low basis, you're looking somewhere around 2030. So again, we're giving ourselves a little bit of cushion here, but for the most part, we're using basically this entire quarter since the last earnings release trading range to determine our iron condor. And because it's an iron condor that goes out to the April monthlies, it's only a 16-day to expiration option strategy. So it's fairly short term, and we capture quite a bit of trading activity. With this one, if I unlock the price, you're going to see it's trading for $3.60. I did a $10 wide spread. And the reason I did that is because I wanted to get somewhere around 1/3 the width of the strikes. Well, $3.60 on a $10 wide spread is just over 1/3. And to illustrate what this would look like if I did just a $5 wide spread, I'll go ahead and create a duplicate order here and adjust it just so we can compare and contrast. So give me just one moment while I get that pulled up here. And what we're going to notice is that it's essentially still close to 1/3 the width of the strikes, but in order to gain that extra risk premium, I would have to add more contracts. So if I wanted to get a similar credit, I'd have to do 2 or 3 or 4 of these option strategies. So another way to increase risk, increase credit, is simply to widen out that spread. And that's another lesson that I really wanted to hammer home today here on Midday Trade, is that we always talk about scaling in and out of positions, but there's more ways to add and subtract risk. One of those ways is to simply widen out those vertical spreads that consist of whether it's a debit spread or a credit spread, and that's a way you can increase risk as well. Typically, if I'm looking at a strategy like this, the more expensive names, maybe I widen out that spread a little bit further, and the more accessible names, maybe names that trade in the $50, $60, $70 range, maybe I tighten that up a little bit. It's all going to be personal preference. It's going to come down to the individual investor, the individual trader, and what works for them and where it fits into their individual portfolio. On a risk-reward basis, if we collect this $355 that it currently shows, that would be our max profit. We would capture that between $2,000 and $21.60 at expiration, going out a couple weeks. break even, you add 350 to the short call, so you get 2163.5. And on the downside, we would subtract that 350, 360, depending on where it's trading from that as well. And you get 1996.40 if we're filled at 360. Real quick, before we go ahead and send that one off, I want to just illustrate this as we set those slices to break even and we paste them to our chart. I'll go ahead and do that now. You're going to see these teal lines represent our break evens at the expiration date of this trade, and it does just what I said. It captures really that entire trading range since the last earnings announcement, which is what we were looking to do with this trade going out a couple weeks to the April 16th expiration. And so we'll go ahead and we'll create a duplicate order here, and we'll go ahead and send this one off. Max loss on this trade is the $10 wide width of those spreads on either side, the put and the call spread net of the credit. So if we fill this at 355, max loss would be 645 there. I'm going to do 2 of these and we'll work them at 355. We're going to take our first and only short break of midday trade. When I get back, Evelyn Baker is going to join me. Ken Rose is going to join me. We're going to talk another major digital advertising player, and that, of course, is Facebook. Stick around. I'll be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Welcome back to Midday Trade. I'm Alex Coffey filling in this week for Kevin Hinks. Tech is on the move to the upside here today, and one of the leaders of that tech move is Facebook, up 2.4%, almost $7 here to the upside. To help me break down Facebook and what's driving some of this action, I'll welcome in TD Ameritrade Network contributor Evelyn Baker. Good afternoon, and thanks for joining me, Evelyn. Facebook, another name. We talked some Tesla earlier on Fast Market. Now we're talking Facebook, another name that just can't seem to stay out of the headlines.
Hey, Alex. Well, what I found was really interesting for names like Facebook and even for Google, which you were talking about earlier, is that these two stocks, unlike the Teslas and the Chewies and the Lulus, a lot of the other names that we've talked about this week, the shares of Facebook and Google haven't really come off this year, haven't really started to come off like a lot of those other names. They did see some pretty great growth over the past year. As you know, everyone was spending so much more time online. That translated to, good things for Facebook. However, ad spending was a huge issue here, right? Ad spending fell to lows as low as $1 for Facebook specifically at the height of the pandemic. And then we saw that come back by the end of November. For Facebook specifically, that ad spending was up to like $8 per the 1,000 of impressions for how they translate that ad spending for Facebook, right? Specifically, and it has fallen off from those November highs, but the rebound in ad spending is expected to continue higher. In fact, eMarketer is the market research company, and they raised their ad revenue estimates for both Google and Facebook for the fiscal year 2021. For Facebook specifically, eMarketer has forecasted their ad revenue is going to increase 26% year over year to $42.6 billion, or $48.4 billion, pardon me, because their previous estimate for 2021 was set back in March of 2020, and that was $42.6 billion. So I think it was really interesting to see how eMarketer firm raised their estimates for both companies this year. I mean, they do expect ad spending to really kick off, and they're not alone because Wall Street expects that as well. I was looking at some notes for Google specifically that Stifel made, but it translates to Facebook as well. Earlier this week, when Stifel upgraded Google, they commented specifically on the ad spending increasing for these companies like Google and Facebook, which generate the most of their revenues from ad spending specifically, right? And Facebook also has Instagram, so they're reaching a lot of the smaller businesses too, like the Poshmark, and these smaller businesses are also going to Facebook, going to Instagram to get their products out there, and that's also expected to rise this year as more people have been spending time online. That's expected to continue to happen. They say that e-commerce isn't going anywhere. That was one of the big trends over the pandemic that people really clung to, and that even though brick and mortar retail is expected to, pick back up, e-commerce isn't going anywhere. The same can be said for digital ad spending. Even as the economy continues to fully open up, these companies are still spending more money in their advertising budgets for online advertising specifically, because that's really become the best way for these companies to get their products out there. And a lot of the sectors that have been really beaten down this year, like travel stocks, like brick and mortar retail, like the restaurant industry, they're especially trying to get their advertising out there on Facebook, on Google, in order to capitalize on that pent-up consumer demand. But yeah, Facebook's up to more than 2% today. The stock chart is looking good over the past year. And Alex?
I think your point about digital ad spending not going away is the crucial point. I mean, you look at where advertising has been and where it is now, the demand's going to be there, but the impact that this style company of Facebook and Alphabet and the effectiveness of being able to get your advertisement to a potential customer out there, it's unrivaled. It's completely changed the game. We fast forward through them if we can on the TV. We don't look at the billboard. Well, if it's right there on our phone when we're scrolling through Instagram, it's hard to miss it. So it's certainly been interesting. And of course, the data collection and their ability to get the advertisement to the right person effectively has changed the game as well. But Evelyn, great setup here for us as always. And looking forward to taking a look at the chart a little bit deeper here with Ken Rose in just a moment. Thanks for joining me. Have a great rest of your day. As we say goodbye to Evelyn, I want to welcome in from Salt Lake, Ken Rose, joining me now, TD Ameritrade Network contributor. And there's plenty to unpack and talk about here with this chart. So Ken, I want to give you as much time as you need. Take it away.
Right, Alex. We're looking at Facebook. We see a very volatile stock. It's had a lot of volatility going back to August of last year, generally bouncing between on the upside 304 and to the downside about 248. Now, recently within this rather wide range, the stock was moving in a sideways channel down at the bottom of this range. It broke out of that channel back on March 9th. It had a nice strong run up to 293. It pulled down to 276 and then it bounced and started moving to the upside. This is called a bull flag pattern. Now, the nice thing about where it's at today is it's currently breaking above the resistance level that it broke down below at 293. With this breakthrough, this resistance level, that makes 293 the current support level. The question at this point, though, is will that breakthrough hold throughout the day? It's starting to soften a little bit, but right now, we can legitimately say support is currently at 293. If this stock continues to move to the upside, the target for this bull flag pattern, would put the stock right up there at about 304, which is at about the same point where we had resistance back in August and also September. That also represents a Fibonacci 123.6 extension level. Moving to the downside, however, let's say if we broke down below that resistance level at 293, the next lower level of support would be at 276. This is where we bounced off of that flag pattern. Now, it's interesting, if you look down at the bottom of the chart, you can see that the volume oscillator is moving to the downside. That means it's not supporting this breakout. For that reason, there may be some technicians that, rather than taking a bullish trade on the breakout, they may wait for the stock to actually move above that resistance level and pull back and test it at that particular point in time. But let's say right now, if we're looking at this from the standpoint of possibly putting together a trade, say a significant support level would be down there at 76. That would be a significant one. A brand new support level would be that 293, but would feel a little bit more comfortable if we would have had volume today with regards to establishing that 293 as a support level. Alex?
So Ken, real quick then before I let you go, are we looking for either volume to pick back up, or do we just need this stock to stay above that 293 and some change prior potential support, prior resistance, potential support here to support this breakout? Or when do we know if the stock has broke out and we're expecting to move to the upside?
Well, Alex, a lot of technicians would be looking for volume to occur on the day of the breakout. If they had volume occurring on the day of the breakout, they would consider a trade related to that break. In other words, they would look at 293 as a support level. We don't have that volume today. It's still a support level, but we wouldn't have as much confidence in it because of the lack of volume. So to be a little bit more certain, some investors would go ahead and let the breakout continue, look for it to actually move up, pull back and test 293 as a support level before taking a bullish trade using 293 as current support. So you could do it today. It would just be considered to be a little bit more aggressive than someone who may wait for the breakout to continue and a pullback and a test.
Good stuff, and I'm learning. See, takes a couple of these, and then all of a sudden I'm going to be a chart expert as well myself. Ken Rose, always a pleasure. Thanks for taking the time and joining me this afternoon. All right. Let's talk trading Facebook, and we're going to be a little bit more aggressive. What we're going to do is we're going to trade this as if this breakout is going to go forward, but we're going to be aggressive enough that we'll take advantage if that's the case, but we're going to be risk defined enough that if it doesn't work out, we know our risk going in, and more importantly, we're comfortable with that risk going in as well. So with this example trading strategy, what I want to do is walk through a trade that would benefit from a breakout above this 293 support and prior resistance potential support level now, and a move towards that previous all-time high of 304. And so what we've done is we've gone out to the April 16th monthly once again, and we're buying a call debit spread. So we're buying the 295.305 call debit spread, and right now this is trading for $3.90. And so at $3.90, you would add that debit to the long call, a 298.90 break-even point, and anything above that, we make penny for penny all the way up to 305 with a max profit of 610. So this is one that's a little bit more of in the risk 1 to make 1 category, or in this case, risk 4 to make 6. Based off of the probabilities here. So it's a little bit more speculative. We need something to happen for this example trade to be profitable, or really even to break even. If the stock were just to remain here and we fast forward in time, we would be in our max loss scenarios. We're buying an out of the money spread. So keep that in mind when you're structuring these trades. With this in mind, the stock has a negative, or this trade has a negative theta decay because time is going to work against us. We do have positive deltas here, so we're looking for an upside move. If you wanted to make this a little bit more strategic, you could consider adjusting. This is going to be at the trade-off of additional risk. However, you could then adjust maybe down to the 290, or you could continue to even move down the other strike as well to the 300. The more you adjust this, the more in the money you make it, lowering the break even, but doing so at a higher debit. You're increasing your risk, lowering your break even, but also at the same time, you're increasing your probability of success because your break even is at a lower price. So what we'll do is we're just going to stick to the original trade here because we want to play this potential breakout if that is going to follow through. I know the volume wasn't there to get us super optimistic, but at the same time, it has broken out, and there is reasons to be optimistic on a fundamental basis, as Evelyn walked through on this space in general going forward. So what we'll do is we're going to work 3 of them, and we're going to work them at 385. With that, break even would be 298.85. And the max loss on 3 would be 11.55 with a max possible profit of 18.45. That would take place if the stock was above 305, which would be a new all-time high at the expiration of April 16th. So we're going to work those there, and we were filled at 385. We're coming up here on time, but before I say goodbye, I want to check in on what's coming up next here on Midday Movers. Standing by is the host of Midday Movers, Ben Lichtenstein himself. Ben, what's coming up? A day where tech has bounced back pretty strongly here.
That's where we're going to begin, Alex, with a look at the NASDAQ, the indices in general, and the bid activity that we're seeing. The Dow is kind of struggling a little bit relative to, as you mentioned, the strength we're seeing in tech and small caps as well, but we'll move on from there. Energies, we're talking treasuries, not a lot going on today. Kind of limited reaction to the EIA, the inventories report, and some of the recent movement in the dollar. But we got some stocks on our radar to take a look at. Walgreens Boots Alliance up after earnings. We got Kroger down on guidance. Kevin Street's going to join us, Alex, to take a look at the Dow Jones Industrials after, well, some of this infrastructure spending talk and the impact it's had on the broader base index. We'll take a look here at airlines today, which are, interestingly enough, on the move lower after Delta said they were going to open up those middle seats. We're going to preview CarMax, and the chart master is going to join us to take a look at Lulu. After earnings, we'll talk Square and Pinterest as well. I've got my eye on Applied Materials. That's my chart of the day. We're talking AMAT. We've got some stocks and bonds, some futures on the move here today to cover today on Midday Movers here, Alex.
Plenty to go over, and I'm looking forward to the Dow Jones conversation, because with all this infrastructure talk, you'd have thought some of these industrial names would be doing a little bit better. Maybe a little bit of a buy the rumor, sell the news kind of a trade going on. But stick around. Midday Movers is coming up next. Thanks for tuning in to Midday Trade. I'm Alex Coffey, and I'll be here tomorrow. Have a good rest of your day.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
"24/7 access to diverse global markets. Right here. That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played."
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Good afternoon, ladies and gentlemen. Welcome to Midday Movers with Lichtenstein. I hope you're ready for 30 minutes of stocks, bonds, ETFs, and futures. I hope you're ready for a double dose of energy here on the TD Ameritrade Network. I like to kick things off every single day with a look at the indices. Let's begin with the Russell right now. Just posted new highs as we speak. And while the NASDAQ, last I looked, percentage-wise was leading, you can see up to, well, 2231.50. Let's move on through. Take a look at the SPX, which are well, they're up on the day by 0.75%. Near highs coming well off lows from earlier this morning. You can see, as mentioned, the NASDAQ, they're leading the way up 1.75%. And last but not least, the Dow Jones Industrial Average struggling actually to hold on to positive territory, limited in terms of enthusiasm after posting new all-time highs this week. This afternoon, we'll get some details on the Biden administration infrastructure spending bill and, well, a few companies reporting quarterly results, not only today, this afternoon, but also tomorrow before the open. Take a look at a couple of names that, well, we're going to be discussing here this afternoon, and you should be keeping an eye on as earnings kind of taper off. Micron, Dave & Buster's, and CarMax will be focal points. And, well, a couple names we think you should be keeping an eye on. Let's take a look at energies, which are in negative territory, coming off after a small draw in inventories today. Let's begin first and foremost with the EIA. Again, I reported or mentioned a small draw in inventories. It was only 170,000. We saw a build yesterday on the close from the API, that is, of over 3 million. So kind of limited in terms of market reaction too. Now, crude oil's been stuck in a bit of a range. There you can see the small draw as mentioned. And, well, take a look. Estimates were for a small build. Nothing to really move the needle one way or the other there. But you can see a reaction to crude oil is coming off a bit and, well, lower on the day, interestingly enough, with the indices higher. I do want to point out a bit of a range that we've been in, 62 down to 57, well-defined upper and lower extremes to keep an eye on right now, and just kind of working our way through the middle of that range. This is after we came off that $68 high. I do want to point out crude still kind of trying to hold up above this 50-day moving average, something to keep an eye on. Now, today, treasuries are mostly sideways and, well, should say to slightly higher. Rates continue to hold near multi-month highs, but I wanted to dive into what happened yesterday and how, well, take a look first and foremost at the bonds, because this is the 60-minute chart, the hourly chart, and how we've come off those March highs up around the 160 handle. But notice how yesterday they did not post a new March low, but take a look as well. The 10-year did. The 5-year did. You can see, again, basically pointing out that the shorter dated is now starting to participate with what we've been seeing in the longer dated. It'll be interesting to see if that continues here now as that steepening of the yield curve has eased some. How about a look at some of the economic data, which is headed our way tomorrow in terms of numbers and, well, some of the potential market movers. You've got a lot of focus on the jobs reports here now over the next couple of days. We're talking challenger job report, jobless claims. You've got the PMI data and construction spending. We'll also be looking at the ISM manufacturing index. And then Friday, the big kahuna, we'll all be focused on here, that non-farm payrolls. Keep in mind the broader market's closed. The cash market futures will be open for an abbreviated session. All right, enough of the futures for now. Let's move on over into a couple stocks that are on the move. I've got Walgreens Boots Alliance on my radar. I think you should as well. It's ticker symbol WBA. It's up in a big way. The move comes in reaction to better than expected quarterly results. Let's begin there. EPS, earnings per share, came in at $1.40. This was on revenue of $32.78 billion. And, well, take a look at some of the numbers again across the board, better than expected. Now, I also wanted to point out that we're seeing a nice move up in reaction to, in terms of investors' reaction to these numbers. The $1.40 beat the estimate of $1.14, and, well, take a look at that revenue just missing. They were looking for $33.85 billion, but I do want to point out here, topping EPS for last quarter and well below EPS for last year of $1.52.
All right, guys, let's see where we're at. Sorry, back from lunch now, and or at least back from the break. I didn't actually get to the of course. Walgreens, I had a buy order in Walgreens. There's 1 second here. At 45, because I didn't know what was going to happen the last few days. 49 on Thursday. Bump up to 56 today. They're up over 4.5% today. So, hey, good deal on Walgreens right there. Let's see what else we got going on with the stocks here on the board. Tesla is still doing really well, up 4.5%. Remember, yesterday morning it was at what was it down here? 590 yesterday morning. So 1.5 trading days ago, it was 590, and it's up 70 points since then, so 11-12%. And I was telling you guys yesterday, hey, it's not bottomed out, I don't think, but Tesla is, I think, still a good buy at 600. So if you want to get into Tesla, 600 was a good target, in my opinion. Again, just my opinion. But it just, again, it's my opinion. Don't bet the house on that. It's not financially wise, but I think right down was a great target for people to have an opportunity to get into Tesla and just hold it. I mean, if you want to flip it and sell it for 12% profits, go for it. But you can hold that, and it'll come up, it'll go down. It might go down to 500 one day, but over time, riding the waves, it'll probably keep going up over time. I don't know if I completely see the $3,000 within the next, what did say, 4 years. That's what Mark and Bell said, something like that, between $2,000 to $3,000. Depends on the model. But I think it could get to 900 to 1,000 again pretty easily. Express up 1%, nice little surge there, good for them. Costs down 1.5. GameStop's above the break-even point, so good for them. AMC's doing the same crap every single day, every day. Dip in the morning, come back to normal, dip again, and just kind of just level all day long. Bananas. So it's down 0.72 right now. TQQQ's backed off a little from its high, but still doing really well. SPPI, Spectrum Pharmaceuticals, up again, 10.46. So Spectrum Pharmaceuticals doing really well. Into the downside. Now they're going to talk right. Kroger. I don't know anything about their stock. I just know a little bit about being a customer of their stores. So overall, that's where we're at. Overall, still a fantastic day in the overall market. My portfolio doing really well. Nasdaq up 1.87. That is, of course, really helping that. Bitcoin still going up. Still, I mean, again, dipped overnight or early morning. I guess it was super early this morning. To 57.7. Now it's 59.6. So if you got in a little bit, that's when you buy those dips. Late last night it was 59, dipped down to 57.7. Now it's back up to 56. That's buying the dip on Bitcoin. So doing really well. Ethereum again doing even better. Holy cow! It's up another 2.5% from the same dip last night. It's up. I can't even find out. Like 12.75% the same dip last night. Jeez. Ethereum now that is up. It like don't even want to show me what's up. Overall, something about like 11, 12% for the last week. It's just crushing it. Dogecoin just kind of just chilling and going on. In the last week or so, we have done hardly anything. It went down to 5 cents a couple of days back, and for the last 2 days, it's really just been leveling out between 5.3 and 5.5. Right now, it's at 5. Hasn't done hardly anything. So ever since that big spike early September, early February, it's just been super balanced, super level. I mean, it's done nothing in the past month and a half since October or since February 18th. It's the same price it was in February 18th. And it's done, and volatility is nearly nothing. The lowest was 0.47, the highest was 0.62 since that time. So the last 6 weeks or so. So yeah, it's weird about Dogecoin. I don't know if that means that it's telling it that it's going to crash. I don't know if it's telling it it's going to surge. I don't know if it's just now setting its resistance. It's never going to drop down below 5 cents. Eventually it'll slowly grow. I don't really know. I need more water. Crude's down 59 cents a barrel, so it's down below $60 again. I've been saying for crude's level. I thought the Suez Canal fiasco was going to make it pop a few bucks a barrel, and it really didn't. I guess it did from 62 for just a brief instance. So I'm glad to see it go back down. What's the treasury rate? I think it's dropping earlier today. So it's back up 1.73. Interesting to see that having a little more volatility, that it's not greatly affecting the Nasdaq anymore. But I think that's a good point. That's the knee-jerk reactions where one affects the other is just exhausting. Fucking exhausting. MicroStrategy doing great. That's 4.4%. Heck yeah. Jeez. Let's make it happen, guys. Twilio was up 7. Twilio another good long-term platform. Whoa. Just tell me what should happen to GameStop? Jeez. That ain't good. Let me pull them up on the big screen. I'll switch GameStop and AMC just to see if we can see what's happening. It's giant volume right there. How many shares is that? 71,000 shares? Jeez, what just happened? Huge 71,000 share dump of GameStop. Brings the price from 195 down to 192. Man, ouch. It looks like that slightly affected all the other ones too. Right there, here the last couple minutes, you can see that. No volume express. Man, maybe I need to just get in there and pump the stock a little bit. Go put some, just go put a bunch of buy orders or sell orders at 4-2 and then 4-3 and then 4-4 and then 5. Just pump that stuff up myself. The volume is so low. Well, I might be able to do that. That would be insane. I mean, I don't have enough shares to do that. I wish I could. I wish I could have 700 shares. If I had a few thousand, I might have something going for me. But man, that sucks with GameStop. Hopefully that's just a little glitch. I mean, they had a big drop of spike too, so hopefully it's nothing crazy. They look like they're coming back up the last couple of months. I hope you guys enjoyed the lunch break. I guess the somewhat of a lunch break. It wasn't really a lunch break because they didn't get any actual food. So, on lunch break, no food involved. But at least we're back in. It looks like that time I was out, I had one view. I'm looking at my YouTube stats now. One view during that hour I was gone. Sorry, guys. Sorry, I'm so sorry. Right now I have one current viewer that is watching now, so hello to the current viewer. I would absolutely enjoy if that current viewer left a like and a subscribe, unless you're already subscribed. That's fantastic. And leave me a comment, whatever you want to leave me. Leave me something. Let me know you're here. Leave your mark on the world. All right, well, let's just turn it up. Let's see what they're talking about. We've got an hour and 16 minutes left in the market. So we'll listen to Trader TV for a little while. Then, of course, as we normally do, we'll probably round out the day on CNBC and watch it closing bell.
A few stocks that are on your radar and think we should, I should say, have them on ours as well. Kevin Street, ladies and gentlemen, joining us. We're going to take a quick break here. When we come back, we'll be talking my chart of the day. That's Applied Materials, AMAT, to a new high. We'll discuss why. Stay right here on the TD Ameritrade Network. Midday Moves at Liechtenstein. We'll be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
What do you look for for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I don't want any trade minimums.
Yeah, I totally agree. They don't have any of those.
I want to know what I'm paying up front.
Yes, absolutely.
Do you just say yes to everything?
Well, I say no to kale.
Mm.
Yeah, they say if you blanch it, it's better, but that seems like a lot of work.
Now offering 0 commissions on online trades. We charge you less, so you have more to invest.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do.
Visit your online broker today to learn more.
Hello traders, I'm Rick Duquette checking in with today's market news. UBS upgraded Apple to buy and boosted its price target to $142 from $115. Analysts expect iPhone demand through 2022 to be stable and in line with historic demand trends. Additionally, Apple's investments into the auto industry, such as self-driving car licenses and light detecting patents, suggests optionality worth at least an incremental $14 per share. Analysts also increased fiscal year 2022 earnings estimates by 7% and revenue by 4%. AAPL shares are up more than 2% today. Mizuho upgraded Hess Corporation to buy from neutral and raised its target to $94 from $76. The report about the energy exploration and production company detailed higher cash flow yields and expected higher capacity for cash return as projects come online and balance sheets normalize. Ticker HES is slightly down on the day. And Morgan Stanley downgraded BP to underweight. The analyst said the energy giant's previous equal weight rating was based on its valuation, but its fourth quarter results were relatively disappointing. The report went on to see analysts struggle to see the same compelling free cash flow outlook they see for other major companies. BP is down almost 2% as we head into the end of the trading day. This has been your TD Ameritrade Network market update. Now back to Midday Movers with Ben Lichtenstein.
Thank you, Rick Duquette, and welcome back to Midday Moves with Lichtenstein right here on the TD Ameritrade Network. It's time for my chart of the day. Let's dive deep into Applied Materials, ticker AMAT, to new highs today. Let's dive in first and foremost to the daily time frame so you can see the move up, the net change, the gap higher. We're currently up on the day by 6 1/3%, and the weekly is equally impressive. You can see the run-up that we have seen. Again, we're talking most recently this year as we've really been, or I should say last year and into this year, as we've been adding to the move up that we've seen off pandemic lows up and through the $70 level. And today, as you can see, all the way up to $135.50. As mentioned, we're trading up on the day by 6 1/4%. This move up comes on high volume, and after Berenstein announced that they've initiated a coverage on Applied Materials with an outperform rating. They have a price target of 160, so we're talking $26 above where we're trading right now. They also had some kind words for Lam Research. We're talking LRCX. Actually, let's just take a look at where things stand in terms of that move up today. They got up to $603. They actually have a price target for Lam up at $700. Now, Berenstein said over the longer term, they think semiconductor capital equipment is likely to be extremely structurally advantaged, with growth trends in the underlying semi market likely to remain positive over the long term. And they went on to say, with a strong case to be made for semiconductor capital intensity to continue involving higher over time. Certainly something to keep an eye on. In addition to the discussions that we've had related to some of these companies, the moves ups, and well, really just continuation of those trends. Let's move on here. Let's bring in the chart master. We've got Mr. Ben Watson joining us this afternoon to take a look at a few stocks he's got his eye on and thinks we should as well. Ben, sticking with the trend, looks like you're dialed in on a few stocks, a few companies that are on the move in reaction to analyst comments. First, let's talk Lulu because, well, they received multiple price targets, but this was actually after quarterly results. I saw Jefferies, JP Morgan, UBS, RBC, Baird, and Piper, to name a few. Lowest of which I saw was Jefferies to 330 from 370. What's the chart telling you?
Well, the chart's telling us that this trend is continuing. Going back to your original theme there, Ben, you know, Lulu has been one of those performers within the pandemic space that was very strong early. Now we've seen this intermediate term downtrend and this downward 55-point-ish wide channel really since that Dees earnings. But lately, and as a matter of fact, over the last couple of weeks, and even going into this earnings announcement, we've seen the stock trade price for time as it's really run just sideways across this channel. It's run into that channel resistance. We got a little bit of a gap down rally today into this what's now becoming a spinning top type candle off of that 313 resistance. I think if this stock can find a level of support right up down here about this 300 level.
What's the next best thing to attendees? Hot pockets. That's what I mean. Pepperoni, hot pocket. Hey, heck yeah. So it's either attendees or hot pockets. Yesterday attendees, today hot pockets. Chili limon, Fritos. Heck yeah. That is what we are plugging away. That is breakfast, lunch, dinner of champions.
Yeah, spike lower in the
All right, we're back up to at least 3 concurrent viewers. So, how's it going, everybody? Welcome back.
June, we're talking June and September of 2020, but they found support around 280. It was a brief visit down below, and now I guess I like to call it a horizontal type pattern, but now it appears as if they're in, well, I guess in this case, a plank pattern. I do want to point out that in terms of Jefferies, I mentioned here some of the, well, the price target cut to 330 from 370, but they maintained a hold rating. Now, I did see that Lulu, in terms of 2021, they plan to open 40 to 50 new stores. That's encouraging. Fourth quarter earnings, sales, first quarter guidance, all beat estimates, but fiscal year 2021 outlook miss. Lulu projects revenue of $5.55 billion to $5.65 billion, and it looked like adjusted EPS of $6.30 to $6.45. Market consensus looking for about $6.75 on EPS, and revenue about $5.43 billion. Let's move on here though, because Square also on the move. They actually gapped up. Ticker symbol SQ today on the move after finding support around 200. And I saw Keith, Bruyette, Woods, they actually upgraded Square from market perform to outperform.
Yeah, and I'll tell you what, that outperform rating is, I think, starting to take hold here. Square has been an interesting stock. Long-term uptrend. It's had this intermediate sideways pattern, and realistically, a bit of what looks like a downward squeeze into this descending triangle. The 200 level sits as the floor, the support level of that descending triangle. And price has been getting squeezed down into there until we get to the last couple of days. We get the bounce up off the 200. Today we get the gap up and a rally that takes it right to that diagonal downtrend line, touches the 232 mark, comes off those highs just a little bit. But I'll tell you what, that certainly looks as if it's gaining some traction, gaining some momentum to the upside. If price can break out of that diagonal downtrend line, I think you could now start to see this become the beginnings of a bullish uptrend short term as it potentially breaks out to that 251 previous high. If not, the 200 level, I think, becomes the critical challenge here, Ben.
Okay, Keith, Bruyette, and Woods actually announced a $250 price target on this one, currently trading $228.26. Ben, I see, again, it looks like Square is trying to break out of the triangle, so to say, but can you talk to me about what's playing out here? Because it does look like RSI is trying to lead the way out.
Yeah, absolutely. And I'm glad you caught that because RSI seems to be, as you said, leading out of that triangle, breaking out of the triangle squeeze. That suggests maybe not a classic bullish divergence, but at least a little bit of a bullish lead on the part of momentum as it gains strength. Watch that diagonal trend line to see what happens here.
Yeah, it also suggests something to keep an eye on over the next couple days. Let's move on, though, because Pinterest also on your radar. Ticker symbol PINS, they're up on the day as well, higher, if I should say today. That's 5 in a row, even after a price cut from Morgan Stanley yesterday to 90, from 95 to 89. Talk to us about what you're seeing here in terms of ticker symbol PINS, because I noticed they maintained an overweight rating even though they cut the price target.
Yeah, you know, this trend in this stock is a little bit like how some people's Pinterest boards get when you start adding in different categories. You've got this long-term uptrend, you've got the rally to the high here off of the Jan earnings, and then you have it kind of coming into this level and creating this almost what looks like a skewed W reversal coming off of that support at the 62 level. Now it rallies up, pulls back, tests the 75 again. That could be the critical breakout here as we start to see momentum shift maybe a little bit to the upside, Ben.
Ben, you mentioned with Square how RSI taking off wasn't necessarily a bullish divergence. Would you categorize this one as that? Because it does appear as if PINS, that was RSI has really been on the move to the upside as well, but price hasn't just participated.
Yeah, for sure. I think this is more of a classic bullish divergence where RSI is making higher highs while price is making at least equal highs, suggesting that momentum's leading a little bit again.
All right, well, you know me, I like those divergences. Ultimately, that's where we look for opportunity to present itself for us as traders, or one of the places, I should say, in addition to Trend and some of the others. Ben Watson, appreciate you joining us here. A great look at a couple names that we should be keeping an eye on, that you have yours eye on and want us to, or bring to our attention as well. That's Ben Watson, that's the chart master. Hey, ladies and gentlemen, at the top of the show here, I was taking a look at the indices and some of the bid activity that we had been seeing. It was mostly, as I had mentioned, led by some of that move up that we had been seeing in the Russell. I wanted to point out before we go, the Russell's still in positive territory, as the NASDAQ say, still near highs as we head into the late day. The NASDAQ's trying to participate as well here.
All right, guys, that's a little afterburner.
We'll see you tomorrow morning for futures.
All right,
That's it for us
Tesla
here for Midday Movers.
up 5%.
Stick around.
Man,
Lots
look
to
at these
come here.
guys.
Oliver Rennick, Market on
Crushing
Close, is
it.
up next on the TD Ameritrade Network.
GameStop, AMC, Austin, not doing well. Express up a little bit.
Why did I add futures to my trading strategy? 24/7 access to diverse global markets, like wheat. Can you say growth opportunity? We should probably harvest that.
Feel that? It's the beat of global markets, the rhythm of the world.
We're going on about 1 hour left in the market session.
With ingenuity,
To
technologies, and markets expertise,
1.9%
we create the possible.
for the NASDAQ.
And when you do that, you don't chase the phase
Yeah.
of tomorrow. You set it.
NASDAQ now up 3.26% for this week.
NASDAQ.
And up 7% from its low back on what was that,
Before
March
diving into the
5th.
markets, prepare for the trading day with the
So,
Market Minute newsletter. Videos, market
sure
insight,
as
and
heck
more
hope we are
delivered
getting
right to your
somewhere with
inbox. Go to
these tech stocks.
TDAmeritradenetwork.com.
For the most part, they're all up. Tesla, 5. All the FANG stocks up. Amazon is actually, well, Amazon's at 1.6, but Google's 1.2. You know, Amazon and Google, it's hard to see them get more than 1 or 2% in either direction.
You might want to consider checking out our income
ARC's at
investing
4.9.
In the income investing course, you'll explore
We're
investing
getting there,
strategies
boys. We're
designed to
getting there.
generate
All right,
regular
I gotta
income
head to another meeting.
and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
afternoon. It's 2 p.m. in Chicago. That means we have 1 hour left in the trading session. Right now, stocks still very buoyant after a big start to this Wednesday. Equities continue to run. Leadership that has been concentrated in tech. We're going to test that a little bit maybe over the next hour, as we do have bonds on the low of the day. Yields are back up, so we'll see how much the NASDAQ can hold on to its strength. Right now, it's looking pretty solid. S&P is up 0.7%. Pretty good, pretty wide breadth in terms of what's working today. There's a lot of stuff that's higher. Definitely seems like a nice relief rally here after markets have been kind of stuck for a while there, at least looking at the NASDAQ in particular. That's the difference here, right? The S&P's been at highs. Dow's been sitting at highs. The pullback in the Russell, alongside some of the just sluggishness in tech, has been overall equating to basically a market. It's been within a fairly tight range. So right now we've got Russell up 1.6%, pretty good move. Small caps chugging along. Volatility coming in a little bit. We've been below VIX 20 for most of the day. And then tech, the big story here. Is this bounce for real? Does it spur a bigger rally and a more serious comeback in the companies that have been underperforming in the growth category? We got a lot to talk about here today. We got a really good show coming up. We got some really great guests. We're going to kick off the show with the CEO of PaySafe, the latest SPAC concentrated in digital payments. We're going to get the details on where they sit in a big industry that keeps getting more attention by investors. We're going to be hearing the case for why the ARK suite of funds, in particular the ARK-K flagship fund, according to Morningstar, may be losing some of its touch, and we'll get the details on it. Don't be alarmed just yet. Wait till you hear the case. All right, so here's where we are right now. The dollar's been down, and generally, once again, as we've got the dollar down, we got a lot of other stuff up. Dollar down, risk assets higher. It's generally been a pretty safe bet that the two were inverse, but still, as the dollar's been continuing to rally this year, obviously the S&P making highs. Again, you have to be very specific about what you talk about in this market, because there are companies that are at records right now blasting off, and there's companies that have been stuck in a range now well off their highs for several weeks. If you dive into the action here in the intraday, we got yields moving upwards and the dollar's firming up. Is this going to cause a problem over the next 60 minutes? This market has seen some fades toward the end of the day, but doesn't look like it's happening right now. This would be pretty good for tech bulls if we get another very clear example of tech up on a day where yields are up as well. So watch. We've got about an hour left. Rampant at the close would be huge if we continue to make new highs of the session while yield is at the highs of the session. We're still not quite above the high in the yield yesterday as well. So just keep watching here to see if we pick up momentum in bonds. Once again, the dollar and bonds continue to move generally in the same direction. As yield goes up, so does the dollar, firming up. If you look at where else we're seeing some strength today, you got gold bouncing back. Again, we're going to see what happens here into the close. Given that the dollar now is firming up, does that create problems for gold? So far, 1.5%. It's a pretty nice bounce. I look at the chart for gold right now, and I see hope for the first time in a long time. Now, what we've seen is generally the worst chart in the market has been gold. However, maybe we don't have to really pick some dramatic story for gold. Maybe gold can just channel between 1773 and 1680, roughly. These are just the lines that I drew. It doesn't have to be this exact point. But the idea here is we've gotten an attempt to bounce off this support area, and we did it right again today, just at the exact same spot. If you take it back, let's go back here to about a year ago. This is where gold spent a lot of time trading, right? Back and forth, back and forth. We spent the better part of 3 months here in the spring of last year and summer before gold then really blasted off. So perhaps we can get some kind of contained range as well. That at least would be a relief for the gold bugs who have been getting squashed for the past year. Bitcoin today is quiet, not a lot really going on. It's trying to fight through, it's trying to break highs, but we're still watching potentially a kind of rising wedge in Bitcoin to see if it's building up momentum to blast off higher or if it breaks down. If you look at the momentum shares today, MTUM ETF, you got a lot of big tech in there, but mostly this is a Tesla story. It's the #1 holding in that fund right now. It's still a very tech-heavy momentum fund. So even though there's been stocks that you would describe as momentous over the last 3 months that have been tied to reopening and recovery, the momentum factor still generally is attached to tech names. If they're using 12-month performance, generally is what you're going to see, and that means that Tesla still, after its big run, is a major part of that. So here's the bounce in Tesla. We got a nice little gap up, second day in a row of gains. Okay, not bad, right? But again, there really wasn't much of an option, because if you break down through 600 in Tesla, there's a lot of space down here, given how far it ran. So you would expect to see, hopefully, some buyers around the recent local low that we got. What becomes more impressive for Tesla if we start talking 700 and above. This is where Tesla just had really a lot of trouble getting through, mid-700s. So we watch that, and then suddenly it puts a lot else back in the target zone, potentially for Tesla. We've got deliveries where a few analysts are saying that they're going to miss, and then Dan Ives from Wedbush saying they're going to beat. Then the analysts who say that Tesla might fall short by maybe 10 or 20,000 vehicles, they're saying that it's pretty well understood they might. But I don't really get that, because then you got other analysts saying that they're still going to beat, so it can't be that obvious. Sounds like we're just going to have to wait and see what kind of numbers they put up. And Tesla's got to put up numbers. They got to put up numbers. This is an S&P 500 company. It's been profitable now. This is not Tesla from 4 years ago. I don't think they get a pass, given where the chart is right now, with a lot of tension in that chart. The reopening trade today is pretty muted for the most part, but Uber's having a nice session. Uber's up 2.5%. I think Uber's an interesting company to consider as part of a reopening theme that is not trading at all-time highs. We do have a lot of reopening themes and recovery stocks that are already back at highs. Look at Caterpillar, for example. Pull up the chart for Caterpillar, and you're going to see this thing has just been rocking, right? I mean, look at this. I've normalized this chart back to the high water mark in April 2018. Remember that comment? During that synchronized global recovery, Caterpillar CEO said they probably hit the high water mark, and the stock never recovered. And then it's just been explosive. Caterpillar's been absolutely explosive. Yeah, some of the machinery sites and building construction sites have been able to operate in a socially distanced environment over the last 8 months. But still, on the announcement of the big infrastructure plan that everybody's been talking about for months, it hasn't been a big secret that the Biden administration is going to have another big wave of spending through infrastructure and other things. They're calling it the infrastructure-centric program, because there's a lot of other stuff in there. But to see Caterpillar now today doing what? Down 0.25%? I don't know. It's not that impressive, I got to be honest. Has it been priced in? I think these are very real questions we have to be asking as the corner of the market tied to the new next themes of recovery, infrastructure, and back to normal. A lot of these stocks are already trading very, very high based on their own history. So just something to keep in mind here as we think about what stories need to come and happen next to keep the market going in some of the trades that haven't already been elevated. Crude oil down 2% today. Kind of again there, this expression of a huge amount of potential demand and activity coming from the economy around infrastructure, around recovery. But then you've got France on lockdown too right now. And even though the UAL CEO, United CEO, says that they're basically back to full domestic travel, we got crude down. It's having trouble with $60. And then if you think about some of the other recovery themes at airlines, I mean, just looking at the chart for the commodity space overall, bit different story for soybeans. We'll get to that later, though. We're going to talk about the news that came out about how much supply there is on the ag side. Let's go to Nicole. Nicole Petalides, host of the Watch List in Market Overtime. Nicole, the big story today is tech, of course. Walk us through what's leading there.
Yeah, as we're taking a look at these chip makers, right? We're waiting for Micron after the bell today. We're watching a lot of these names. I had a great conversation with Angelo Zeno of CFRA and Daniel Rubino of Windows Central, and we were talking about a lot of these chip makers. And obviously, we're all well aware of the chip shortage that we've been facing, and each of them had their own picks and likes, and I'll explain that. But we're watching AMAT in particular. This has been a name that got an outperform rating over at Bernstein with a price target of $160, which is higher than where it currently is at $134 and change. And so over the last year, this one has doubled. It's up actually more than doubled. You can see it's right now, it's 193% for 1 year. So it's an interesting name. Chips have been leading the way. They certainly have a lot of pricing power, at least for the near term. When you talk about DRAM and NAND and demand that we're seeing, the question is how long that really lasts. And that was one of the conversations I had. Daniel Rubino was saying that in the near term, there's going to be a lot of demand, some pricing power and all that, but what happens in 2022? As far as what they particularly liked, and I think it's worth sharing this, Daniel Rubino said that he liked Intel. He also liked onsemi and NVIDIA. And then for Angelo Zeno, he liked NXPI, onsemi, and KLA Tencor. Those were some of the names that they liked in this environment. Now, don't forget, chips move everything, right? Everything, servers, cars, gaming. So this is, and we know that the Biden administration now is moving forward probably with $50 billion to try and get chips produced out and faster and all that. So that's definitely front and center and a winning group overall, at least for the near term. The other thing I'm watching is the Tesla story, which you were touching on there, particularly with Kathy Wood, who has that as her lead player in ARC. It is a winner today. We're talking about deliveries, and we are seeing the stock itself up over 5%. You mentioned Dan Ives, who really has been a big, he's been touting this stock. Right now, he has a $9.50 price target with a neutral rating. Talked about delivery revenue, $8.79 billion, up from his previous $7.67 billion. He seems very optimistic on deliveries. I know that there's an array of numbers out there. Gene Munster expects Tesla to serve up a muted number with deliveries closer to 160,000 in the quarter. People are estimating 174,000. I think the takeaway, and it's a lot of numbers, and I have them all, 174,000 for this quarter. Last quarter was 180,000 plus. A year ago was 88. I'll just say it like this.
Yeah.
So this first quarter will be almost double last first quarter.
That's big.
But not as good as fourth quarter of last year.
Got it.
So that's what's coming out of this, right? So when you look through the numbers, I mean, that's the count, and that's where we stand.
It's
and
showtime
so the question
for Tesla.
is, we've seen them beat the numbers, and we know Elon Musk loves to throw out the numbers, and they came up a tiny bit short last year. So let's see what happens.
Yeah, okay. The stock's been struggling to really pick a direction. Analysts seem to be generally still, very bullish. $900 price target from the folks we were talking about this morning. You mentioned $950 from Dan Ives. One of the analysts that we talked about in the AM, I think from New Street, said that they expect some of those numbers to maybe come in shy, but they still have a very bullish price target on it. So there's clearly some buffer and some kind of margin of error being given to Tesla still. Is the stock going to give it a margin of error if they miss? We'll find out. But until then, as you mentioned this afternoon, we've got the chip makers and we got Micron. This one's going to be big, Nicole.
Just a quick thought. Kathy Wood, right? I mean, I don't have it in front of me, but I remember writing it down last week, right? 3,000 is her target in a few years, and her bull case was 4,000, right? And that was her bull case was 4,000, and her bear case was 1,500 or a little lower.
Right.
So,
worst case scenario.
I mean, yeah, that was her bear case. So I mean, just the way she talks, it sounds like she knows to Elon Musk and talks to him. I don't know if you know the answer to that, but I mean, why would she be so bullish going forward, much higher than where it is right now?
We're going to talk about that a little bit later on because we got the Morningstar analyst on who just put a neutral rating on the ARK funds, saying that he doesn't have any reason to think they're going to continue outperforming. So definitely a conflicting message than what many want to hear, given how popular it is. So we'll get to that. Appreciate it, Nicole. We'll see you for some Micron earnings in about 45 minutes. Right now, let's bring in the CEO of PaySafe, the latest SPAC merger, now trading. PSFE, Philip McHugh, joins us. Philip, thanks so much for being on the program here this afternoon. I want you to first just tell us precisely what PaySafe does within the digital transactions market that's gotten so big.
Thanks, and thanks for having me. Look, PaySafe is a really scaled payments company with over $100 billion of volume. But we're really unique. We're a payments company with assets on both the merchant side and the consumer side. We take payments digitally online, predominantly e-commerce business. We have incredibly strong digital wallets through our Skrill and NetTeller brands and a really powerful eCash solution. And we're able to bring both those pieces with really strong risk management, and we win in some really exciting industries like iGaming, that's growing really fast in the U.S. We're seeing streaming and online video gaming. We're seeing fintech services, as well as some general retail. It's a really good global digital commerce player, but unique with both the consumer and the merchant side. And that's really us in a nutshell.
So where right now, Philip, do you get the predominance of the revenue? A lot of industries there. Where do you see that you have a particular leg up on competition or that you're particularly ingrained?
Yeah, so we're best known for in the iGaming space. That's online sports betting, poker, casino, and lottery. That's about a third of our business globally. We're a true global leader and very well positioned as each state opens up in the U.S. market. So that's obviously been a core, but we do open up to lots of other e-commerce and digital commerce industries with trading and crypto trading, online and video gaming with some great clients. And we do have a swath of retail, but what we like is we like international. We like good risk management, and we like businesses that need more than just card processing, but lots of alternate payment methods, which we can bring those solutions to help consumers and merchants grow.
What do you want to do? What can you do now as a public company that you couldn't do before? You've been around for some time. Domestically, I think that investors are starting to learn about PaySafe. I know you're based in London. What do you want to do now that you have the foothold here on the U.S. exchange and that you've got money now through this big deal?
Yeah, so we've been, with Blackstone and CVC the last few years, we've really been focusing on scale, and we've invested about $250 million in platform upgrades, migration to being a cloud-native company, upgrading our products, and really creating lots more risk capabilities over the last few years. The going public and partnering with Bill Foley really brings a few things. One, we've delevered quite significantly. We have a strong share price. So now M&A becomes absolutely another leg of the stool for us to grow. So we're pretty excited about that. Working with Bill, Bill's track record in growing companies and driving operating leverage, we are driving lots of those initiatives. Bill's experience is helping us to accelerate that as well. So those are probably the two biggest aspects of what it means for us today and going forward.
There's a lot of competition in the space, Philip. There's big traditional credit card companies that are moving very digital. There are nimble players that target specific areas within digital payments. Of course, you've got the powerhouses like Square out there as well. The peer-to-peer market, too, is a big part of this. How do you compete within that? Does it mean that the expenses of spending and marketing and advertising and getting clients on board, is that going to cost money in the near term?
Yeah, no, it's absolutely. Look, the payments and fintech space, it's a great space to be in. The first thing we see is more and more money is going digital. So it's a rising tide across the board. Two, more and more markets are being created that need digital commerce and digital payment solutions. So we're in a good spot there. I think where we get excited is ease of integration. So technology does matter. Risk management, that's a deep and wide moat for us. It's not that easy to copy. And we can bring consumers into that solution as well. I can bring millions of digital wallet customers through Skrill and NetTeller, millions of eCash customers that are hard to get to. That starts to create some hooks and some differentiations, which merchants like. They see that, they grow more, they sell more because of that unique combination. We really like talking about being a specialized platform, not just generic retail, which is a great business, but we go vertical into iGaming, fintech, trading, and some travel. So there's some areas where we're really good. Our products, our management, our ease of integration create some capability. We don't see the need for big advertising and marketing. It's product development, but we think we're also in a good position to create some pretty good operating leverage as well.
This is a big multi-billion-dollar deal, one of the bigger SPACs that we've seen in a very busy year for these types of debuts into the market. Walk me through what the revenue is, what kind of revenue is making it to the bottom line. Cash flow positivity, profitability, are these things that you're starting off with? There are ones that you want to achieve. Walk me through the timeline for some of the fundamental details.
Yeah, so PaySafe's a company that's been around for 20 years. We've got deep and long-lasting relationship with many, many large corporations. We're well-known in the industry. We're well-liked. It's a very relationship-driven company. So we're starting off on a good base. We do about $100 billion of volume globally, and our blended take rate is around 150 basis points, and it's been very healthy and consistent. So that's a really good starting point. Two, we do garner, over 30% drops to the EBITDA line, so it's a good, healthy margin. We've been very consistent talking about as we consolidate platforms, we create scale, we can actually increase that margin over time. And it's not that capital intensive, so the free cash flow as a percentage of EBITDA is extremely healthy. So there's some really nice, fundamentals that we're starting out with. Look, we're ambitious. We have lots of things to do. We've got edge and aren't comfortable. We want to grow, but we do start out with some really good fundamentals, good market position in strong markets like iGaming. And the financial profiles, it's a nice one. It's definitely a nice one.
Okay, Philip, thanks for joining. Thanks for the details. Looking forward to following along in the public market. Appreciate you being here.
Thank you.
Thank you.
Thank you.
Philip McHugh, CEO at PaySafe. PSFE is the ticker. When we come back, let's talk about today's action with tech bouncing in a very big way. I've got a guest that says it's time to buy the dip on some of the beaten up momentum names of the past year. Certainly is working today.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome back to Market on Close. We've got a big bounce back day in tech and the NASDAQ leading the charge. Let's talk about whether or not it's time to get back into the trades that worked throughout the quarantine period. David Deneen joins us, CIO of Global and International Small Cap at Sprouting Rock Asset Management. David, good to have you here.
Thanks for having me.
So looking at your notes, the first thing that pops out to me is you basically want to buy the dip on all the tech stuff. That's what it sounds like to me. The beaten up type of plays over the last 3 months or so that have fallen out of favor. Why?
Well, I think we at Sprouting Rock, we like to be a bit contrarian, and contrarian means to us, you know, we don't want to just follow the market. We want to look at risk reward. So no question, many of the technology companies got overbought, or alternative energy, or some of these very exciting decarbonization plays, but many of them have retrenched by 20, 30% or more. And you've seen many value stocks rip forward quite a lot. So we look at that and say, hey, you know, value stocks, what are they doing? There's improved sentiment towards global recovery. We agree. There's improved sentiment about vaccinations. But really, that has to come at a valuation or a price. And many of these stocks have gone back to their 2019 levels pre-COVID. So we want to take a step back and say, what earnings are those implying? And we think that's probably a very attractive opportunity to maybe take some of those gains and put them back into some of those stocks that have suffered a bit in the last quarter. Because no question, we think that earnings can continue to be a bit patchy and troubling. And we want to go with maybe some of these more secular growth companies that don't need as robust recovery that other value stocks may be anticipating.
David, when we think about companies that have pulled back as having suffered, I'll nitpick on the wording. I mean, are we kind of changing our baseline in a market that's been trading at all-time high valuations? I mean, I know some of these companies are down 20, 30%, but we got a Russell 3000 that's trading at 37 times trailing, which is way above where it was in .com. What's on a discount here?
Well, that is the challenge of being a stock picker. But really what we're thinking is quality businesses, what we want to do is we want to intersect where we see strong earnings trends and attractive valuations. So no question, we think valuation is important, but we want to do it in the context of where we can find either secular growth or cyclical growth opportunity, not just buying what is cheap, because cheap could be a reflection of a broken business model, call that retail. It could be the reflection of technological change is overtaking you, called energy. Or it could be that you're at peak earnings, which could be the autos or housing-related stocks, given the success the Fed has had in stimulating the interest rate sensitives.
It seems like right now, within the context of recovery, kind of mixed in with infrastructure and specific sector plays, these secular winners, we're expecting to land some windfalls from the government and electric vehicles, maybe solar. From the small and mid-cap perspective, do you find that to be a compelling story? Is that part of the dip buying that you want to be in?
That actually fits into, call it, the corners of value that we think look attractive. Because you mentioned two really big themes in electric vehicles as well as alternative energy decarbonization. In both of those, one of the bottlenecks is along the lines of copper. From the standpoint of copper is still the best material to transmit electric current. And in the case of alternative energy, it's great if you build a wind farm or a solar project in New Mexico, but you still have to tie that into the grid so the power can actually be utilized and distributed. So copper is an area which we think looks very attractive because there's basically two ways that you can win. One is the recovery in classic production and industry because it goes into everything from housing, automobiles, washing machines. As an emerging markets play on urbanization. At the same time, you have a secular theme right behind that, which is this is the bottleneck for achieving the increased penetration of electric vehicles, components, as well as in alternative energy. So it's an area we think looks very attractive because we think it's only being looked at for its kind of classic cyclicality as opposed to the opportunity it could offer you to basically be more of a picks and shovels play at a much more reasonable valuation than the actual producer of wind turbines or the electric vehicle makers.
Now, do you like to do this through mining stocks, like a Freeport or lesser known miners? Do you do it through a commodity exposure directly?
We like to do it through the stocks because what the stocks give you is a chance to find a management that has great assets and most importantly, that can increase production. So you're not just riding the futures curve, you can also make increased earnings and have more leverage because of the production growth that's alongside of that.
Here's what I'm trying to figure out right now, David, is when it applies to specifically some of these electric vehicle plays, et cetera, is we've got this big infrastructure package coming down the pike. We know there's going to be trillions spent. In terms of the expectations versus the reality now that we've got, I mean, the reality looks pretty good to your point here, right? We're getting a lot of money spent. How do we know what has been understood, though, and what has been priced into this market for some of these companies that are up thousands of percents? I mean, it's not hard to come by. A lot of these companies up 1,200, 2,000% over the past year. We've had a president-elect, a president candidate in Biden, and now the president himself, and throughout the entire time, he's talked about this. I mean, how is this not already understood by the market and the expectations and the valuations that have been factored in?
Well, I think one of the key points is as time elapses, many of these businesses actually start to be de-risked because they reach milestones of commercializing or getting new contracts. So to the extent that what the stimulus money does is it basically increases the revenue opportunity, and hopefully what investors can see and look through is the connection of how long it's going to take to actually flow through, while at the same time the business has been de-risked. And as I said, valuation just got a lot better when these stocks have declined 30, 40%.
What type of levels do you think one should be comfortable with from an investing standpoint, whether it's price to sales? Right now, a lot of these companies between 50 to 100 price to sales. Because I think the point here that is interesting is, well, one, valuations are not typically a great timing tool in short to intermediate term. One might argue long term, possibly, in terms of expected returns. But look, we've had software companies that pre-COVID just kept getting more and more expensive, and they were leaders in the market. Do we expect a similar type of dynamic where over the next couple of years, one shouldn't shy away from an electric vehicle or a battery maker or a solar stock that's trading at 30, 40 times sales? I mean, will that be sort of like a standard? What do you expect to kind of be an area that we should be able to tolerate as investors?
At Spatter Rock, one thing we look very carefully at is cash flow. So from the standpoint of today's multiple is not problematic. It's only problematic if you can't grow into it. And more importantly, where the CapEx and cash flow needs to go. So in many of these companies, they may not be generating a lot in the way of revenues, but the revenue growth rate could be triple digits. And if they've already funded the CapEx and don't have additional capital needs, as the utilization starts to go up, you will start to see a pretty good kick as that falls through the P&L.
So we should be looking for some major revenue growth. The last point, I guess, is how do we test the thesis in a year from now? What, or maybe just end of year, as some of this starts to work its way through. What kind of top line revenue growth should we be looking for these companies? Is this doubling revenues from here, tripling?
Many of these companies will be seeing doubling of revenues over the next year or two as they start to ramp and scale. So the real question is, how fast do they get through this initial growth, and then what do the growth rates settle at? So we think that many of these opportunities, you will continue to see very strong top line growth, which will be rewarded in the market.
Okay, David, really like the conversation. Definitely exciting for folks that are ready to keep piling into the stuff that is pulled back after being winners for a while. David, really good stuff. Thanks a lot.
Thank you.
Thank you. David Deneen joins us from Spouting Rock Asset Management. When we come back, let's talk some options trades. After big China tech got blasted, we're seeing some options traders in Alibaba. Nice move today. Shares flat, but holding on as we saw a dip towards 220. Alibaba's hanging in there. We'll be right back.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do.
Visit your online broker today to learn more.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today. Technical traders, the Chartmaster is in the building. Trends, support and resistance, key patterns, and technical indicators. The Chartmaster has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Let's talk some options trades. Tom White has some movers for us. Tom, let's go to Alibaba first. I don't know if this is a good day for Baba or a bad one, because tech here is ripping and Baba's flat, but at the same time, at least it's not breaking down anymore.
Yeah, you're right, Oliver. And if you take a look at it, it's down nearly 30% from those all-time highs that we saw last year, about $319 a share. So, you know, I think this whole sector is probably going to be under pressure. You know, if you look at some of the regulatory risks, possible delisting, while that might be, you know, months or years down the road, you know, if the SEC opens this investigation that they have, where they don't let accountants go in there and audit their, you know, all their, basically all their forms, everything that they do, you know, there's going to be putting pressure on this. Will investors kind of flee away from there? And I think what we saw in the options market today, as far as unusual option activity, is the fact that maybe people are going to take off some risk or start to hedge some of the downside. So the trade that stuck out to me today was all the way out in October. So 198 days until expiration. They bought 5,800 of the October 210 strike puts for an average debit of $15.25. Now, those are out of the money to the downside, nearly 20 bucks, right? And you're paying a big option premium, $15.25. That's because you've got 198 days in this trade, so you're going to pay more option premium for that duration. Break even to the downside, 194.75 when you start making money on this. It's about 15% below the current share price of Alibaba. So somebody taking a bet that, hey, I've either got a large stock position that I'm going to hedge it with some out-of-the-money puts, which are pretty expensive at this point, or if it's a speculator to the downside, he's betting that over the next 200 days that, hey, Alibaba has downside risk, more downside risk from the current levels that it's at.
Okay. So someone's not real faithful in the bounce. I guess they are not in the same category as the big growth infrastructure driven plays here. We just heard the bull case on from David Deneen there. And Baba, I mean, they used to trade alongside pretty much our tech, but certainly something going on here that has broken it apart from that, to your point. This kind of tension from a regulatory standpoint and exchange standpoint. But right now, look, at least it hasn't broken down. But this trader's definitely betting that it's going to your point. Tom, you got on the flip side a tech play in the semiconductor space. On semi up 5%, pushing back near the highs of 42 bucks. I can't imagine this one's a bear trade.
No, not at all. When you got a tech stock up 5% on the day, we're typically going to see the call buyers come out of the woodwork on this one too. And they were out in the May series, so about 51 days till expiration on this one. May 40 strike calls, which are actually in the money, Oliver. So they're buying maybe a stock replacement type strategy where they're going to buy some slightly in the money calls. They bought 8,000 of these earlier today. Average debit of about $3.60 on those. Takes a break even to 43.60. That's not very much. That's less than $2 away from the current share price, and you're giving yourself 51 days in this trade. Call volume is about 6 times normal daily average volume, and they're seeing some real tailwinds from the auto content, which set record revenues last quarter, and also a new CEO who's going to refocus on the product line. So a lot of bullish momentum in here as they bought about 8,000 of those May 40 strike calls.
All right. Bullish and looking for a breakout. You got to get above the previous high for this thing to start paying, but we are darn close. Here's the catch, though. Can we pull up the chart on semi real quick, guys? Let's look at a chart on semi, just year to date or year. I mean, this thing just keeps getting rejected from $42, Tom. This is one of the best performing semis here during this rotationary period, but man, it just kind of stopped when it got to 40. So I do think this is a pretty interesting trade. Someone's putting on some size and betting that it finally gets through that area of resistance.
Yeah, and I think if you take a look at it, if it does break out here, right, we've seen the tech sector underperform the overall the other major indices so far this year, up only about 2% year to date, while the Russell's up, 13% year to date, and the S&P 500 is up over 6%. So if we do start seeing some traction and demand continues to where it is, and we get rid of this chip shortage, is this going to play in the favor of onsemi? And the auto sector is still on fire, Oliver, and I think that's a caveat for this particular stock.
Yeah, certainly one that kind of gets looped into some of the more cyclical aspects of the semiconductor group. Last one you got today, Tom. Stocks, some infrastructure, some industrials, and some oil demand, possibly. Schlumberger has been moving with some pretty good speed here as energy led the post-vaccine rotation in markets, but it slowed a little bit over the last week. Crude's down again today, despite all this talk about building out roads and building all this new infrastructure. So what's going on here?
Well, you got to stock up, 24%, 25% so far this year. It's pulled back about just over 2% so far this month, and that's probably because oil's slipping a little bit, right, and hovering around $60 a barrel. But if we do get that demand to pick up, I think that's what everybody's banking on, that, if we see GDP growth in 5 to 7% range by the end of 2021, oil demand will probably, get elevated here. And what we saw in there as far as unusual option activity goes was all the way out in the November series. So you're giving yourself 233 days till expiration on this trade. Trader came in about 12,000 of the November 37.5 strike calls. Paid only about a debit of $1.16 on these. Not paying a lot of option premium, but you're giving yourself 233 days. But also, Oliver, these are the 37.5 strike calls. So takes your break even on this trade to the upside, 38.66 over the next 233 days. They sold out of some of their long June 37.5 strike calls. They sold 20,000, which was basically the open interest. So they sold out of that position, gave themselves some more duration by buying the November ones. But that break even is about 40% above the current share price. And we're seeing about three times normal daily average volume on the call side. So somebody banking that we're going to see oil continue to move higher, gets over $70 a barrel, Oliver, you're probably going to see a pop in Schlumberger and a lot of these oil services names, and somebody banking that, hey, over the next, 6 months or so, we're going to see Schlumberger get back above that break-even point, which is 38.66. That's a ways to go, 40%.
Okay. All right, so we got bulls here. 2 for 1. 2 and 1 today. 2 bullish trades, 1 fading Alibaba. Tom White, thank you, sir. Our contributor here on the TD Ameritrade Network. We got 20 minutes left. If you thought the move in stocks today was impressive, then you haven't been looking at beans. That's right. Let's talk some ags, corn, beans, all the futures on the move today.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I want to know what I'm paying up front.
Yes, absolutely.
Now offering 0 commissions on online trades.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
I'm Maria Schrader. Here are a few stocks moving this hour. Dave & Buster's reports its fourth quarter earnings after the bell today. DAX estimates a loss per share of $1.33 and revenue of $101.25 million. The company has beat EPS estimates for the last 2 quarters, but reported a loss for the last 3, and has missed revenue estimates for the past 3 quarters. Dave & Buster's shares are up over 1% today. Guess also reports its fourth quarter earnings after the bell. DAX estimates earnings per share of 57 cents and revenue of $656.91 million. Guess has beaten EPS and revenue estimates for the last 2 quarters. Yesterday, B. Riley said that Guess was expected to experience product delivery delays after the Suez Canal blockage. Guess shares are up over 2% today. Loop Capital initiated coverage on Bumble with a hold rating and a $65 price target. The firm expects Bumble to turn profitable this quarter and stay in the black for the rest of the year. It adds that the difference between average revenue per user versus subscriber count for its 2 apps, Bumble and Badoo, will end up a strategic advantage for long-term growth. Bumble is up about 5% today. This has been your TD Ameritrade Network market update. Now back to Market on Close with Oliver Rennick.
Ag futures were wild in Chicago here today after a huge pop in soybeans, corn, and more following USDA estimates for planting that came in shy of the expected amount. Dan Deming is joining us. Once again, the managing director at KKM Financial. Dan, what's up? So about like a 2% miss on the surveyed forecast for corn planting, and it just ripped like 5%. Is that standard? What does it mean?
I tell you one thing that's up, Oliver. That's limit up. Some of these names today. Certainly, yeah, as you pointed out, the prospective plantings report was the catalyst today. The indication that there's not going to be as significant of plantings of activity in the fields this summer, and that's certainly having an impact when you look at corn and soybeans in particular, where they're both limit up today. And not only the front month futures, Oliver, you go even to the back month futures, you saw them all hitting their limits today. And so that means tomorrow they'll expand those limits depending on the contract. It's a little bit wider area for the market to trade. But yeah, a very explosive move here with I guess the caught traders off guard with the fact that there's just going to appears there's going to be less planting this year.
So Dan, we know that the context here has been about, of course, economic growth. We know that we're thinking about this demand. We're talking infrastructure today, just different ways to think about demand. It's the constant conversation here. How much is the economy going to pick up? Do you view this then as a sustainable impulse for these futures if there's going to still be more economic growth building from here? Or is the response by farmers so fast that, if you weren't in on the day it popped like this, then you missed the move?
I think, Oliver, it's going to be interesting, particularly when you look at corn and soybeans, because they're basically testing their highs that they set earlier this year. So if we see another significant leg higher, that means there's potential short covering. There could just be a further momentum to the upside. And over the years, I can't say that I've done a lot of trading in this area over the years, but I certainly have watched it for the last 30 years. Let's put it that way. And when you see these moves find or manifest, typically they can last for a couple of days. So I think tomorrow certainly is going to be a fascinating day when you look at, particularly, I suppose, soybeans, because you're looking at soybeans, you're looking at soybean meal. I mean, soybean oil, all of those were up limit today. So, I think there's going to be continued activity here and volatility as the markets sort out the shift in expectations.
We also know that we had this cold front here for a while that lasted. I mean, it was just it never went away. Not that that's particularly anything new here in Chicago, Dan, but this year pronounced it, maybe factored into this to some degree. Do you think as a trader that the volatility in these assets is something that is sustainable? I mean, at the end of the day, corn at 564 is a place that's been trading for much of this year. Yeah. Soybeans, kind of the same story, right? Where we've largely gone sideways. I know it's a big day, but do you want to chase this until you see a real breakout?
Well, I imagine some traders don't have that decision, that option to make that decision. That's possibly why we're seeing, this situation or this type of price action today. I think tomorrow is just going to be a very critical day because you're right, Oliver. When you look at corn, you look at soybeans, they have not effectively taken out the highs that they set earlier this year. And you're looking at a double top to some degree in both those ags. Those are areas that if we take out the highs, then I would suspect that we're going to see continued upward momentum. Wheat's a different story. Now wheat is you had a big day today, but not anywhere near its high from January and February. That's another kind of double top situation. It comes in around 690. So, I guess when you look at the velocity of the moves, some of the grains are going to continue probably to realize further or more active, or I should say more volatility than some of the other grains. And I think it's also interesting when you look at maybe even you spread that out a little bit further to like lumber and oats is another one. Now, oats isn't having quite the volatile session, but certainly lumber continuing to push up now. And that could be another area where you see, I guess it feeds into the storyline, Oliver, of inflation continuing to be kind of heavily debated here as we move through 2021.
Okay. All right. Dan, I like that conversation. Always good to think about these big macro concepts through different, lenses, right? And this time, the commodity space today. So we'll see if we get real technical breakout in these charts for beans and corn tomorrow. Dan Deming, good stuff. Versatile, as always. Managing Director at KKM Financial. Thanks, Dan. All right, we're going to come back. We're going to talk about a very interesting stock fund. Don't miss this. I dove into the details on the fund that the next guest manages, and it's pretty interesting. A lot of different companies, tech plays with a cyclical type of bent to it. A nice setup here for Micron coming this afternoon. We'll be right back.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
What do you look for when you trade?
I want free access to research,
Yep, TD Ameritrade's got that.
free access to every platform.
Yeah, that too.
I don't want any trade minimums.
Yeah, I totally agree. They don't have any of those.
I want to know what I'm paying up front.
Yes, absolutely.
Do you just say yes to everything?
Well, I say no to kale. Yeah, they say if you blanch it, it's better, but that seems like a lot of work.
Now offering 0 commissions on online trades. We charge you less, so you have more to invest.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Welcome back to Market on Close. We've got about 9 minutes until the bell, and then Micron's coming out. It's also the top stock holding in Billy Wan's portfolio. Joining us, the manager of the Parnassus Endeavor Fund at Parnassus Investments. Billy Wan, great to have you here. Appreciate you joining.
Thanks for having me, Oliver.
So let's first talk a little bit about the way you guys structure your fund. It seems very interesting to me where you have priority on companies. Is it an ESG? Is the way you describe it? Is it sustainability? Is it workplace? Walk me through the description for how you're finding these companies.
Sure. I'm the manager of the Parnassus Endeavor Fund. It's a concentrated portfolio of value-oriented large cap stocks. We look exclusively for socially responsible companies, and we completely avoid fossil fuels.
Okay, now that leads you to a pretty diverse group of companies at the top. Guess I should say, full disclosure, Charles Schwab is number 3. But you've also got Micron at number 1, Applied Materials. So you've got 2 big chip makers at the top. Does that mean you have strong views on what we should expect from Micron and what they tell us about the coming year? Or do you look at these companies strictly from a managerial and that ESG style perspective?
Yeah, we are bottom-up fundamental stock pickers, so the allocations are really a function of that.
Okay.
That said, we are very heavily overweight tech because we like the long-term secular tailwinds, as well as financials, as you mentioned. With regards to Micron, we are very bullish about semiconductors in general. That and AMAT and others comprise about 20% of our portfolio. And I think it's been mentioned on the show before, but semiconductors has been a really, really great space. There are really strong tailwinds as far as gaming, mobile. The kind of post-pandemic world we live in is really a digital world. And so the supply demand dynamics are actually very, very favorable for these stocks over the long term.
How confident does Micron need to be about the message going forward, given the leadership that this stock has taken? For a while there, it was kind of a sluggish start for Micron. It wasn't the favorite during the quarantine period as everybody piled in to these high growth areas of the chip making space. But now that they're on top over the last 6 months, they got to give us a guidance, right? They got to tell us that there's some good growth coming, I would expect.
Yeah. Well, we shall see very soon. I will say that we are long-term shareholders. So we first got involved in Micron and a lot of these other names at the end of 2018 when they were, really down in the dumps. The stocks had fallen at least 50%. And we saw that these stocks were basically undervalued given the long-term secular tailwinds that I had mentioned. So they are cyclical stocks. As I mentioned, it's really driven by supply and demand. The demand picture I alluded to, but there's so much coming out as far as data centers and the cloud. On the supply side, Micron is one of only basically 3 global players that produce DRAM. So the industry over the long period has really kind of consolidated to just a few players. And as a result, when the demand picture kind of weakens as it has over the years, supply is able to match that demand. And so prices, to us, look like they're basically on the rebound, especially for DRAM.
Bill, at the top of the show, we had a guest that was making the case for basically swooping into the market, buying all the dips in the expensive EV plays, the frothy growth stuff from the past year. It says that some of the cyclical companies that are in here and are in the cyclical category are already pricing in a lot of recovery. Do you have to have some strong view on the overall macro GDP? I mean, we've already got 6.5% getting thrown around for this year. Do you have kind of a house view that is required to be reached in terms of our GDP for these companies to perform the way you expect them to perform?
That's a good question. I mentioned we are bottom-up fundamental stock pickers, so we don't take a macro view. That said, I do think that the recovery is going to be stronger and go on longer than expected. 2021, to me, is going to be kind of the year of the consumer, just because you look at indicators like housing. The housing market, we're basically in a boom thanks to low mortgage rates. And the value that people are placing on their homes. Stocks are at all-time highs, so that in combination with housing makes consumers feel flushed, and so you're going to get higher consumer confidence. On top of that, you have stimulus, of course. So the government has embarked on this unprecedented campaign for monetary and fiscal stimulus, and then maybe even infrastructure. So it's going to be a very, very strong upcycle. And that trickles through to a lot of our stocks. We have at least 10% of the portfolio in consumer finance. We have pretty much equal weight on consumer discretionary. I think we're playing it on a second order thinking as far as the credit card companies, for example, on the banks. And then it trickles all the way down to semiconductors, as I mentioned, because when people have money, they want to buy something, some new gadget or the cell phone that's with them 24/7.
Bill, I've got one more before we let you go. We got about a minute until the bell, but Gap is a top holding. It looks like it's the biggest piece of the consumer retail side that you have in there. The stock has had a great run. It's trading back where it was way before COVID in like mid-2018. This is a company people didn't want anything to do with for 2 years. What's changed here? What's the most compelling story for Gap in 60 seconds?
Yeah, Gap is a long-term holding of ours. It's a multi-year turnaround story. So we liked the company because they had a very strong balance sheet. They had iconic brands. The stock was really misunderstood because people associate it with the Gap brand as well as Banana Republic, and those brands have really faced struggles over the years. However, Old Navy has been a star for them in terms of their portfolio, as well as some other smaller leisure brands like Athleta. Once the company had new management come in, they've really come out swinging. So CEO Sonia Singhal has transformed the business model away from kind of a retail-based, more toward omni-channel, which is going to be the winner in a post-pandemic world, as well as moved the business more toward a licensing model. So they've had some really great partnerships. And they've also not been shy about restructuring the business as far as selling off Kenny and Jack, which they bought, and their China business. So we see a lot of legs for this company going forward.
Okay. Bill, appreciate the deep dive into the fund. Really good stuff. Fascinating take. Thanks for joining us.
Thank you, Oliver. Great to be here.
Thank you. The Parnassus Endeavor Fund. Bill Huan's a portfolio manager. Since its inception in 2005, it's beat the S&P on an annualized basis by almost 3 percentage points. When we come back, let's close out this market. Let's talk the numbers from Micron. Strong day for tech. Not exactly ending at the highs. Little bit of a dip, but it caught itself. And we end where we started, essentially. Opened up this market around 13,100, and that's where we'll close it for the NASDAQ in a powerful comeback day.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
24/7 access to diverse global markets. Right here. That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played.
What do you look for when you trade?
I want free access to research,
Yep, TD Ameritrade's got that.
free access to every platform.
Yeah, that too.
I don't want any trade minimums.
Yeah, I totally agree. They don't have any of those.
I want to know what I'm paying up front.
Yes, absolutely.
Do you just say yes to everything?
Well, I say no to kale. Yeah, they say if you blanch it, it's better, but that seems like a lot of work.
Now offering 0 commissions on online trades. We charge you less, so you have more to invest.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Welcome back to Market on Close. Stocks end higher, led by the NASDAQ today. An over 200-point rally in the tech-heavy Qs. Much needed and a nice bounce. But now we got to talk some Micron earnings. Numbers good across the board. A nice day. Laggard in the Dow Jones. But a little bit of rotation in today's market back towards tech. That's the story. We'll talk some charts and we'll get into some of the more analysis later about what happened today. But right now, let's talk some Micron. Let's go to Nicole, who's in New York. Nicole Petalides. All right, so obviously this is a big one here, Nicole, as we look at what's happening. Numbers come out. Cash flow looks pretty good, beats estimates, and it looks like it's, for the most part, what analysts were looking for here.
Yeah, I mean, this is what we're seeing right now for Micron in the after hours as we're seeing it on the move. Obviously, we talked about Micron and the demand that we've seen for chips overall. Someone like CFRA has a hold rating on this one. It's not their favorite of the chips, but it has been moving and trending higher, hit a high recently of $95. So as far as the quarter here, we are seeing a beat on the top and bottom line for this name. That's some big news there right out of the gate. And then we'll look here to see what the sales are going forward. They're seeing sales in the third quarter, $7.1 billion. versus 6.79 billion. So that, I think that was key. I mean, they had to be above the 7 billion because in a discussion earlier today with Angelo Zeno, we talked about exactly that he and the others were all expecting that 7 billion revenue number going forward. So it's a good thing that they're giving plus or minus. This is the best point. Hold on. This is the best part of it. So they see sales going forward, 7.1 billion plus or minus 200 million.
All right.
So you know what that says? That means 6.9. You know what that isn't? 7 billion.
Right.
Right?
Estimate
so
6.75 billion for the forecast. So your point here is even if they hit on the low end, they're still above the forecast.
Well, that's that forecast. I'm telling you, I spoke to CFRA. He told me 7 billion. I saw the RBC number. They were saying 7 billion. I see the estimate there, 6.79 billion. I see where you're coming from with that, Oliver, and I think you're absolutely right. That may be a consensus estimate, but there are going to be some folks, if they come in with 6.9, that won't be happy.
Right. Hey, bottom line, the stock, as we just talked with our guest, it's a company that's given an outlook number one, right? There's a lot of companies that can't even do that right now. I don't know what we're going to hear from Dave & Buster's this afternoon, but my guess is it's not going to be about billions of dollars of revenue expectations that are ahead of the analysts look, or even if it's in line, right? I mean, the fact that they're churning out big money, they're able to give a clear look forward. And I think also the fact that we're talking about, real growth as we look at this economically kind of centric name, this validates to some degree a lot of what people have been expecting from the stock. And now we're up a little bit.
Doesn't this feel like the group that's the no-brainer, right? I mean, when there's a chip shortage everywhere, it's like if you need avocados, then you just got to bring the avocados. We need chips. We need them for everything. All the automakers are closing shop for weeks at a time because they don't have the chips, or they're having to pick and choose what model should we make. Let's make the pickups because the cars don't sell as much because we don't have the chips. So let's bring the ones that has the most demand, the most margin. But why do automakers have to do this in the first place? Mm-hmm. They shouldn't have to pick and choose what they're producing based on chips. So you have chips for autos, for gaming, for servers, for everything. And we talk about pricing power. So I think, and don't forget the Biden administration now really pushing, there's a lot of anticipation for infrastructure plans and $50 billion going right into chip manufacturing. So the group as a whole seems to be certainly in a safe area for now.
Major turnaround from this time last year, obviously, right? I mean, but still a big turnaround that counts, and a number that is, triple, 30% here. Not bad at all. And then thinking about the demand that comes down the road, a lot of the analysts expect the DRAM part to pick up as cloud and corporate servers continue to build out. So the story is pretty compelling. The price action in the aftermarket seems solid. And then I guess we'll see if we can get follow on through it, because at 91 bucks, it's a nice move, but it still is a place we've traded out a lot. We've been kind of stuck between $85 and $95 now for the better part of the past month and a half. How much does this do to invigorate the Micron bulls going forward? Seems like it could be enough, given the bottom line, top line beat, and to your point, even with the $200 million range, might disappoint a few analysts on the average, about in line, and maybe a little bit ahead. So I guess the question is just about follow through tomorrow, right? Who comes in and swoops it up? And do we get day two of what we got today? Because Micron will be the news that we will latch on to tomorrow to see how these...
Let's see what we got. So that meeting, of course, was longer than I expected. I was hoping to get off before the bell. Did not happen. It is now 3:09 in Central Times. Markets have now closed. Let's see what we are looking at here. Tesla up over 5%. We have losses all over. Nothing crazy, but red all over on these other four. AMC, Cost Express, GameStop down today. But you know what? I will take any day with those four stocks any day of the week if everything else stays great. So we had a little bit of a dip there right before the close in all of the markets. Of course, the NASDAQ was the one that made me hurt the most, but Still not the worst. Still finished with a 1.54% increase today. The Dow took a dump there right at the end. In the last 30 minutes of trading, from positive down to negative 0.26. So no record close today for the Dow. Let's see how did S&P end up today. So I had an intraday record high of 399,441. Closed at 397,289. Is that a record close? That might be. Let me see. Let me see if that is or was yesterday a higher close. It had to have been either yesterday or today, or maybe the day before. What did it close at yesterday? Am I looking at my numbers right? 3,958 yesterday. The day before it was 3,971. Oh, it's close. That is close. It doesn't really say to me these things. Look at you know what? This 3,974 on the 26th. Geez, I think it was not a record, intraday record, not a record close. Nearly hitting 4,000. You know what? It was crazy. I remember not long ago, post-pandemic recovery, when it got back up to 3,000, and I think we were a little surprised how quickly it got back to 3,000. It was on, so May 29th ish, or at least it got May 29th. It got up to 3,000. Before pandemic, all-time high of 3,380, got up to 3,380. August 18th. So from February, basically February 18th, August 18th, that's exactly 6 months. Was how quickly that V turned out. And now here we are, 6 months after that. Or I guess 7 months after that. And we're up 15% more than where we were, 17% over the pre-pandemic high. Of the pandemic low of 2,300-ish, we're now 72% higher. Just in the past 11 or 12 and a half months, 72%. That's bananas, people. Good God. Five years out, 91% 5 years. This is the S&P 500. 10 years, 198,000. That's crazy. The only real long-term losses from the dot-com boom on May 1st, 2000 to 2017, there was only 7 years and only at 4%. That's how bad it was with the dot-com boom. It hasn't been nearly lost 40, 50%, nearly 50%, maybe 40% of its value. And then the financial crisis boom in 08, 09, it lost 35%. Yeah, 32% to 35%. And both those took years to get back. The dot-com boom took 7 years. The financial crisis boom, if you want to call it that. Let's see if I can get my chart right here. So 5.5 years. And this one took 6 freaking, and then 72% on top of it. Absolutely. Just insane, unsustainably insane. But good for all of us that are in the market. But if you're wondering why there's people saying that there's a bubble, that's exactly why. Anyway, overall, great day. My portfolio up, I think, a little over 2%, which is great. Got that. And overall, it's been a pretty good day for most of my stocks. Let's see if I have anything that are Affirm had a nice bounce back, 6.5% up after it was not very good the last few weeks, bumped back up 5%. I didn't get into Chewy yesterday or the day before, and it actually opened, pre-market opening was up to 93, and then it spent the rest of the day going downhill, closed at 84. So it's still at a 5% gain for the day. Compared to what it was was up like probably at least 15% before pre-market. So not a great trade there for Chewy, unfortunately. EXPI up 3.5%, Lastly up 3, Lemonade up another 3.5. Great day yesterday, another good day today. Neo, another good day yesterday, another good day today, up 3.8%. So making up some serious ground over there. Well, payments here, 5.6, Peloton up nearly 5, Redfin up 3.5, Ring Central up 3.5, Roku up 4.5, Square up 6.5, which a lot of those that are rolling off right now, Roku, Ring Central, Square, Redfin, a lot of those I bought at the wrong time back in February, which I hate. Again, you can never time them. Zillow, another one of those that I bought at the wrong time, had a good day today, up 4.5%. Walgreens, who I don't know, 3.5%. Good for Walgreens. TQQQ, my favorite ETF, up 4.5%. Tesla up 5. Teladoc up 5. TAN, the solar ETF, another 2.8. What is Twilio? Twilio up 6%. Zoom up 2.5%. Overall, fantastic day, everybody. Great day in the market. Unfortunately, not a great day necessarily for these meme stocks we've been watching. However, fantastic day for a lot of growth technology stocks. All right, guys. You know what? Since I didn't switch it over to the closing bell before, because I was going to switch over now, we will talk a little bit more here on closing bell for a little while longer, probably till about 4 o'clock Central,
what was
5
part of your optimism
Eastern, and we will
stemming from the stimulus bill and
turn
the
up. So that's
factors that were included in that this time around?
Absolutely. Our industry has been waiting and waiting and waiting to get some type of relief from Washington. And I really want to take my hat off to the Independent Restaurant Coalition, as well as the National Restaurant Association, who finally got through to Congress. And Congress finally came through on behalf of an industry that is not one big monolith, and therefore probably hard for a lot of people to appreciate how many Americans are employed in this industry and how many towns and villages and cities rely on their restaurants for their economic activity, as well as really for the emotional well-being of those communities.
Danny, it's Sarah. It's good to hear you so optimistic because we've talked to you at some of the low points over the last year or so. My question is, how are you thinking about the other side? So once we do hopefully continue to fully reopen, what does a place like New York, which you have such a presence and a history in, look like? We've gone through so much in terms of the pandemic, real estate, offices, now tax increases potentially. What's the prognosis?
Tough. I think you'd have to be kind of crazy to think it's going to be easy, because it won't be. Listen, most of us have been doing business with long-term leases that were based on a reality that no longer exists. We don't have nearly the density in our city in terms of office occupancy, as you said. International travel is probably going to take a little bit longer to come back. So will business travel. So what we're really focused on right now is how can we build back our businesses in a hyper-local way. As of this moment, Sarah, our restaurants are able to serve 50% indoor capacity plus, and this is really important for a lot of reasons, plus on the sidewalks and sometimes even into the street outside of the restaurant. The reason that that's so important is that when you pass a restaurant, and as the weather gets warmer, which is another big reason for my hope, especially for a town like New York City, as you pass a restaurant and you see street activity where all you've seen for months and months and months are either snowbanks or boarded up windows, street activity is a beacon of hope that's going to encourage more people to either return to New York, return to their offices, and come visit the city.
And sorry, to follow up on that, Danny, do you think that these things will be made permanent, particularly outdoor dining in somewhere like New York City?
Well, we've been told by our current mayor that this is permanent. I've spoken to only 3 of the many, many people vying to become mayor in the election that'll be this November. But all 3 of them have said that it's fully their intention that we continue this. And why is this so important? This is a city of people who are self-selected human beings who want to be with more people. And when people see people in New York, life happens. Furthermore, the rent, as I was just saying, these long-term subscription leases, which is really what a lease is basically going to rely upon the ability for restaurants to do more revenue than they can do within the 4 walls that they've had. Whether or not we have capacity restrictions, having the opportunity to serve outdoors for 8 months a year, plus the new tricks we now have up our sleeves, which we all had to learn this past year, of takeout, delivery, and shipping across the country, we may finally be at a point when we can have a full-service restaurant industry that's economically not only viable, but can truly thrive.
Well, I did want to ask you specifically, Danny, about online ordering and how you think that is going to change post-pandemic. We've seen companies like DoorDash come public during this time skyrocket as their business has really taken off. Do you see that trend accelerating? And if so, does that hurt job prospects for bringing all those restaurant jobs that were lost back into the industry?
I don't think so. I think it's going to go from what has been a lifeline for the past year into what will hopefully be the really delicious icing on a cake. I can tell you right now, just by watching these last 3 weeks, that the amount of planning, forward-looking planning, the backlog of celebrations, of anniversaries, birthdays, Mother's Day, graduations, weddings, engagement parties that didn't happen, that couldn't happen for the last year. People are coming back. Look, we just, in the last 2 weeks of opening Union Square Cafe and Gramercy Tavern, I don't think I've ever seen more candles on more tables. And it can't be that many people's birthdays. It's just that there is so much pent-up demand to go out to eat and be with people. Now, at the same time, I think that if there's anything that this online ordering is going to pose a threat to, it could be that maybe people will go to the grocery store a little bit less frequently, but people want to eat good food and people want to be with people.
Finally, Danny, as for your SPAC, I know you've launched one during all of this, which has been sort of a hot time for that. They've cooled off a little bit lately. Where are you in terms of shopping for a target and finding the ideal one?
Well, the fun thing is we can finally shop because, as you well know, we started planning for this probably late last summer, and we couldn't talk to anybody about it. And then even in the filing period with the SEC, you're not permitted to speak to one company. So what's great is that right now we are speaking to a number of different businesses. And as I said before, our focus is on culture. We're looking for businesses that truly employ a stakeholder model where they believe that the best way to have a great outcome for their shareholders is to begin by caring deeply for the people who work for them and their customers in their communities. And you would be surprised that group of businesses is thriving. And there's a number of them that are ready to be public. And so what we're hoping to provide for those who want to be public is a different avenue for getting there. And we've got an amazing board of directors who I hope can provide some amazing strategic guidance for a company that's ready to be public.
Well, Danny Meyer, keep us posted on that. Thank you for joining us. And it's good to hear
so
again
much.
the optimism. We are just moments away from President Biden's economic plan. Up next, we will discuss what will be in it that we know so far, how higher taxes could factor in, especially for corporations, which we are expecting to hear about, and how all of that could impact your investments. Stay with us. We are awaiting President Biden's speech on his new $2 trillion infrastructure plan. As we wait, let's bring in Clete Willems, former National Security Council Deputy Director under President Trump, and Austin Goolsbee, former Council of Economic Advisors Chairman under President Obama. Gentlemen, good to have you here as we wait for the president. Clete, I'll start with you just for the Republican perspective. You know, President Trump also wanted an infrastructure bill. What's in here that you like and you think might have a real shot at getting bipartisan support?
Well, as you mentioned, there are definitely things in here to like. And Republicans and Democrats have both wanted to spend more to repair roads and bridges. They've wanted to spend more on broadband. And there's components in here on China, including on strengthening our semiconductor supply chains. And so that's stuff we definitely like. I think the problem is that this goes so far beyond what we traditionally think about in infrastructure. I was just looking through the summary of the bill, and just the summary is 25 pages, and we're talking about housing and schools and childcare and Medicaid, and the list goes on and on and on. And I think that is one of the big problems here. And of course, you're also going to raise the problem here with how do we pay for it? And I think in the Trump administration, we were open to things like user fees. We're looking at private-public partnerships because a whole lot of this infrastructure spending actually has never come from the federal government. We're looking at toll roads and things like that. And here you have huge tax hikes, which are really going to hurt our competitiveness vis-a-vis countries like China. And so those are some of the problems I see from the Republican side. And I can tell you it's frustrating that there just don't appear to be real attempts here to make this bipartisan. I like Joe Biden talking about bipartisanship, but I'd actually like to see it with some of his policy proposals.
Austin, the tax increases are emerging as one of the more controversial elements here when it comes to the pay-fors. 21 to 28% on the corporate rate, higher taxes on individuals. Is that going to risk the recovery that we're just starting to see come to fruition from the pandemic and all that stimulus that the Biden administration just passed?
No, I think definitely not. I mean, the president ran on a campaign that he was going to do exactly this, that he was going to propose a broad-based infrastructure, not just transportation infrastructure, but energy, telecom, healthcare, education. All of those are critical infrastructure for the country. That he would do that program and that he would raise taxes back to historic levels on corporations and high-income people. And he won by 7 million votes on that platform. So I don't think there's any surprise. And the peoples whose taxes would go up, they haven't had a recession. The employment level for those high-income people is higher than it was before COVID ever struck. And that would put our corporate tax rate at something like the middle for the large economies in the around the world. And that's why I think you've seen the market did not react badly. It reacted actually fairly positively to the announcement.
Austin, you worried that this is going to spark a lot of inflation, or are you relatively relaxed about that?
I guess I have been relatively relaxed, if you called it that. There's a bit of a contradiction to in terms in criticizing this proposal of the president's on inflation grounds, at the same time as saying you don't want them to let the taxes go back up for high-income people and large corporations. That makes this infrastructure proposal, which is a multi-year, multi-decade proposal, not inflationary because you would be taking taxes out on the other side.
Clete, what's realistic as far as what could pass under reconciliation, where it wouldn't matter what the Republicans think?
Well, you need to have Joe Manchin on here to ask that question. I think what you're going to see in the weeks ahead is that a lot of Republicans are going to be making the points that I'm making, which are that raising taxes in the middle of a pandemic, when we're in the middle of an existential competition with China, is exactly the wrong way to both grow our economy and to win that competition for the future. And I think that there's going to be a lot of pressure on Democrats, and then they're going to have to decide: are they willing to take that risk for legislation that I think, look, in some areas it's critical on roads and bridges. I agree on broadband, but do they really want to take that risk for a whole bunch of other social spending that I don't think the American people see as critical? And I will just say, I do want to respond to 2 points that Austin made. In terms of sort of why Biden won the election, I do think we have to remember that COVID hit, in the middle of the campaign year. And if the economy would have been where it was pre-COVID, on the heels of the tax cuts that were enacted during the Trump administration, where we had historically low unemployment across all demographic groups, I think you might have seen a different situation. And I'm nervous to even make this point. He's CEA, I'm the lowly National Economic Council, but I do think the inflation concerns here are real. And I get that Austin is right. Sometimes that can be an excuse that people use to argue against things that they don't like. And of course, Republicans don't make that point as much when it comes to tax cuts. But the point is, we've never spent this kind of money before. If you add up this package with what was done, just in the new year on the COVID relief, you look at the fact that they're going to have another $2 trillion package coming on the heels of this. We're talking $6 trillion in 6 months. I mean, that is almost 10 times what was done under the first couple months of the Obama administration. So it's easy to say, look, those concerns are overblown, but we're in a historic situation with the level of spending here, and I think that has to have everyone concerned.
Let's, guys, stick around if you may. Let's bring in Elon Moy as well to give us a bit of a preview of what we might be due to hear from the president. We have just been given a 2-minute warning, so we're expecting him any moment now. Elon, what are the key points that we should be listening out for?
Yeah, the White House is really framing this as a once-in-a-century investment in America. I think the key here is that they are basically acknowledging that they are not going to get Republican support here because of the tax increases that are linked to this. They felt it was important to pay for this entire package. The question will be, can they unify Democrats around this proposal? And I think that's really the message that Biden is going to try to lay out, ensuring that he has his party behind him as he rolls out what is undoubtedly a very ambitious and bold proposal. Can he make sure that Democrats will fall in line behind him?
Clete, just wanted to come to the point on the tax increases. If this spending is to be approved, is it better to see it funded than not?
Well, I think that's correct. I agree. I think both parties have had a problem with deficits for a long time. So I'm not being partisan on this point at all. We're both guilty. We have not done a good job of managing the deficit in this country. But I think there are better ways to do it. And as I pointed out when we were looking at this in the Trump administration, having user fees that are more closely connected to the products and services you're actually producing, I think is a much more economically efficient way to do it. It doesn't have the broad-based international competitiveness concerns that raising the corporate tax would do, or that raising the minimum tax would do.
Let's see what our boy Biden's going to say here. Talking about the infrastructure plan, I think it's $2 trillion infrastructure plan that they're working on. I'm not going to say anything that's like, politically thinking this is a good thing or not. I haven't really completely dug into what the plan is. I unfortunately think that nobody has. I don't even remember hearing about this plan until 2 days ago. So the chances that any normal taxpayer has actually read anything going on with this plan that's going to cost us as the taxpayers $2 trillion is just absolutely mind-boggling that we don't have that much time. Having said that, I doubt that too many congressmen and senators have read the plan. I think we granted it out with the various stimulus plans over the past year, both the ones put in place by the Trump administration and the ones put in place here by the Biden administration this year. So I think that it's again, I'm not saying it's good, bad. I haven't read it. I'm not, honestly not going to read it. I wish there were some of these more digestible changes in legislation, not a $2 trillion crazy thing that, of course, is going to, like he's saying, raise the taxes in some way or another. It's either going to raise it on an individual level or it's going to raise it on a corporate level, which sounds great, except for the fact that it's going to trickle down and affect all of the employees, which is just your normal checkers. So I can't convince you that any it's a good thing or a bad thing associated with it. But let's watch this as well. Let's finish the live stream watching the rest of this news conference. I doubt it's going to be an hour news conference. If it is, then I guess we'll be here for an hour. Normally I'd want to sign out around the top of the hour, but we'll see how long Biden talks. Might be for a while, might just be for a few minutes. What they say that he was cleaning the podium. I can't really tell what that looks like. He's saying something. I don't know who that is. I got a small screen and then it's in a smaller screen on the small screen. I have like a 1 inch by 1 inch screen of Biden and the flags. I can't even tell you if that's really Joe Biden. That's how small the screen this is. So I have no idea who the guy is at the podium right now. Looks like he's saying something. But then they've got the guy in the half-inch screen sitting in his home office with a terrible echo, probably like I have right now too. But then again, I'm not on TV with hundreds of thousands of people watching me like he is on CNBC. I cannot believe if you PSA for anyone watching, if you are a professional reporter or at least someone who's somewhat regularly on TV as a guest, for the love of Jesus, get a decent camera, microphone, and lighting. What the hell? You can get a good camera, good microphone, at least get a good microphone and good lighting. Microphone and lighting, crazy cheap. You can get both less than $100, and you can get a better add-on webcam if you're going to do it from a webcam, not an external DSLR. Something like that. You get a really good HD webcam to adapt to your new lighting and stuff for like I don't know, $100, $150. So if you are a correspondent for CNBC, I can't imagine CNBC not saying, "Hey, we'll spot you the $250. Go buy this stuff," or "I'm just going to package up and send it to your house. Turn it on and use it. I'll even give you instructions." I have no idea why that does not happen more often. It is insane. Wait, hold on. Biden looked like he was slow. Oh, now they've got to wipe everything up. So they bring this other dude over to the podium now to wipe everything down. It'd be funny if Biden like shakes his hand. Oh, there's another dude. All right, come on, get away from the podium. All right, I'll shut up.
I really waited until the last possible moment to be sure. The President of the United States.
And say to Bobby, my good friend, he asked me back there, he said, "Do you ever get nervous?" And he said, "Because I got up this morning, made breakfast for my kids, so I got to introduce the president." And what I say to you, Mike, you did a heck of a job, but I'd get nervous if I had to get up in the middle of the night, climb up a telephone pole, replace in the middle of a storm a connection that knocked out everybody's electricity, put a transformer in. That's what would make me nervous. So what you did was really good. I couldn't do what you do, pal. I couldn't do what you do. And I want to, and it's true, Mike, you're a union guy. Me too. I got in trouble, but I don't make any apologies for it. I'm a union guy. I support unions. Unions built the middle class. It's about time they start to get a piece of the action. To all my colleagues, from the county executive to the mayor, to everyone that's here, I want to say thank you. Thank you, Congressman, for the passport in your district, and I appreciate being here. I'm honored to be with you. 2 years ago, I began my campaign here in Pittsburgh, saying I was running to rebuild the backbone of America. And today, I return as your president to lay out the vision of how I believe we do that, rebuild the backbone of America. It's a vision not seen through the eyes of Wall Street or Washington, but through the eyes of hardworking people, like the people I grew up with, people like Mike and his union family, union workers from this Carpenters Training Center, people like the folks I grew up with in Scranton and Claymont, Delaware, people who get up every day, work hard, raise their family, pay their taxes, serve their country, and volunteer for their communities, and just looking for a little bit of breathing room, just a little bit of light. Ordinary Americans doing extraordinary things. People who break their necks every day for their families and the country they love. A country that, in fact, which on the day I was elected was in extreme distress, with the virus on a deadly rampage that has now killed over 500, I carry it in my pocket every day. I have the list of exactly how many have died. 547,296 Americans dead from the virus. More than all the people killed in World War I, World War II, the Vietnam War, 9/11. 547,296 Americans. And an economy that left millions out of work and created so much anxiety. That's why I moved so quickly to pass the American Rescue Plan with the help of my friends here in the Congress. I really mean that. It didn't pass by a whole lot, but with the leadership of Connor and Bobby and the Mayor, just, you got it done. Because it was an emergency. We needed to act to save jobs, to save businesses, to save lives. And that's what we did. We're beginning to see the results. We're on our way to having given 200 million vaccination shots in the first 100 days of my presidency. When I said I'd get 100 million done, people thought it was a significant exaggeration. We're going to get 200 million done, twice the original goal, because of all the help of all of you. Leading economists are now predicting our economy will grow 6% this year. That's a rate we haven't seen in years and years. We can cut child poverty in half this year. With the American Rescue Plan, we're meeting immediate emergencies. Now it's time to rebuild. Even before the crisis we're now facing, those at the very top in America were doing very well, which is fine. They were doing great. But everyone else was falling behind. The pandemic only made the division so much worse and more obvious. Millions of Americans lost their jobs last year, while the wealthiest 1% of Americans saw their net worth increase by $4 trillion. Just goes to show you how distorted and unfair our economy has become. Wasn't always this way. Well, it's time to change that. I note parenthetically that I got criticized for giving tax breaks to middle class and poor folks this last time. I didn't hear that cry, you and cry, when we were doing the same thing. When Trump's tax bill passed, 83% of the money went to the top 1%. You know, this is not to target those who've made it, not to seek retribution. This is about opening opportunities for everybody else. And here's the truth. We all will do better when we all do well. It's time to build our economy from the bottom up and from the middle out, not the top down. That hadn't worked very well. For the economy overall, it hadn't worked. Because Wall Street didn't build this country. You, great middle class, built this country. And unions built the middle class. And it's time, and this time, when we rebuild the middle class, we're going to bring everybody along. Regardless of your background, your color, your religion, no matter, everybody gets to come along. So today, I'm proposing a plan for the nation that rewards work, not just rewards wealth. It builds a fair economy that gives everybody a chance to succeed. And it's going to create the strongest, most resilient, innovative economy in the world. It's not a plan that tinkers around the edges. It's a once-in-a-generation investment in America, unlike anything we've seen or done since we built the interstate highway system and the space race decades ago. In fact, it's the largest American jobs investment since World War II. It will create millions of jobs, good-paying jobs. It will grow the economy, make us more competitive around the world, promote our national security interests, and put us in a position to win the global competition with China in the upcoming years. It's big, yes. It's bold, yes. And we can get it done. It has two parts: the American Jobs Plan and the American Families Plan. Both are essential to our economic future. In a few weeks, I'll talk about the Americans' Family Plan, but today, I want to talk about the Americans' Jobs Plan. I'll begin with the heart of the plan. It modernizes transportation infrastructure, our roads, our bridges, our airports. I just left your airport. The director of the airport said we're about to renovate the airport. Is that right, Mr. County Executive? We're going to innovate. We're going to employ thousands of people. And she looked at me and said, I can't thank you enough for this plan. It grows the economy in key ways. It puts people to work to repair and upgrade that we badly need. It makes it easier and more efficient to move goods, to get to work, and to make us more competitive around the world. Some of you local officials know when someone wants to come in the area and a company wants to invest, what do they ask? Where's the first rail bed? How can I get to the railroad? What access to the interstate do I have? What's the water like? Tell me about it. It goes on and on. It's about infrastructure. The American Jobs Plan will modernize 20,000 miles of highways, roads, and main streets that are in difficult shape right now. It'll fix the nation's 10 most economically significant bridges in America that require replacement. Remember that bridge that went down? We got 10 most economically significant bridges with more commerce going across it that need to be replaced. We'll also repair 10,000 bridges, desperately needed upgrades to unclog traffic, keep people safe, and connect our cities, towns, and tribes across the country. The American Jobs Plan will build new rail corridors and transit lines, easing congestion, cutting pollution, slashing commute times, and opening up investment in communities that become connected to the cities and cities to the outskirts, where a lot of jobs are these days. It'll reduce the bottlenecks of commerce at our ports and our airports. The American Jobs Plan will lead to a transformational progress in our effort to tackle climate change with American jobs and American ingenuity, protect our community from billions of dollars of damage from historic superstorms, floods, wildfires, droughts, year after year, by making our infrastructure more secure and resilient and seizing incredible opportunities for American workers and American farmers in a clean energy future. Skilled workers, like one we just heard from, building a nationwide network of 500,000 charging stations, creating good-paying jobs by leading the world in the manufacturing and export of clean electric cars and trucks.
Tesla's going to get a boost.
We're going to
So,
provide
I mean,
tax
there are probably some
incentives
smaller ones too, but
and point-of-sale rebates to help all American families afford clean vehicles of the future. The federal government owns an enormous fleet of vehicles, which are going to be transitioned to clean electric vehicles and hydrogen vehicles right here in the United States of America by American workers with American products. When we make all of these investments, we're going to make sure, as the executive order I signed early on, that we buy American. That means investing in American-based companies and American workers. Not a contract will go out that I control that will not go to a company that is an American company with American products all the way down the line and American workers. And we'll buy the goods we need from all of America, communities that have historically been left out of these investments. Black, Latino, Asian American, Native Americans, rural, small businesses, entrepreneurs across the country. Look, today, up to 10 million homes in America and more than 400,000 schools and child care centers have pipes where they get their water from, pipes that are lead-based pipes, including pipes for drinking water. According to scientists, there is simply no safe exposure to lead for a child. Lead can slow development.
you know, I don't think we need a scientist for that.
American Jobs Plan will put plumbers and pipe fitters to work, replacing 100% of the nation's lead pipes and service lines. So every American, every child can turn on a faucet of our fountain and drink clean water. With each $5,000 investment, replacing a line that can mean up to $22,000 in health care costs saved. Chance to protect our children, help them learn and thrive. We can't delay. We can't delay another minute. It's long past due. You know, in America, where the early interest was in internet, this thing called the internet that we invested. We invented the early internet. It was invented here. Millions of Americans, though, lack access to reliable high-speed internet, including more than 35% of rural America. It's a disparity even more pronounced during this pandemic. American Jobs will make sure every single American has access to high-quality, affordable, high-speed internet for businesses, for schools. And when I say affordable, I mean it. Americans pay too much for internet service. We're going to drive down the price for families who have service now and make it easier for families who don't have affordable service to be able to get it now. As we saw in Texas and elsewhere, our electrical power and power grids are vulnerable to storms, catastrophic failures, and security lapses, with tragic results. My American Jobs Plan will put hundreds of thousands of people to work, line workers, electricians, and laborers, laying thousands of miles of transmission line, building a modern, resilient, and fully clean grid, and capping hundreds of thousands of literally orphan oil and gas wells that need to be cleaned up because they're abandoned, paying the same exact rate that a union man or woman would get having dug that well in the first place. We'll build, upgrade, and weatherize affordable, energy-efficient housing, commercial buildings for millions of Americans. Even before the pandemic, millions of working families faced enormous financial and personal strain trying to raise their kids and care for their parents at the same time, the so-called sandwich generation, or family members with disability. You got a child at home, you can't stay home from work to take care of that child unless you lose, the child's at risk or you lose your job. or you have an elderly parent you're taking care of. And seniors and people with disabilities living independently feel that strain as well, but we know if they can remain independently living, they live longer. American Jobs Plan is going to help in big ways. It's going to extend access to quality, affordable home community-based care. Think of expanded vital services like programs for seniors. Or think of home care workers going into homes of seniors and people with disabilities, cooking meals, helping them get around their homes, and helping them be able to live more independently. For too long, caregivers who are disproportionately women and women of color and immigrants, along with the American Families Plan, changes that with better wages, benefits, and opportunities for millions of people who will be able to get to work in an economy that works for them. You know, decades ago, the United States government used to spend 2% of its GDP, its gross domestic product, on research and development. Today, we spend less than 1%. I think it's 0.7%. Here's why that matters. We're one of only a few major economies in the world whose public investment in research and development as a share of GDP has declined constantly over the last 25 years. And we've fallen back. The rest of the world is closing in and closing in fast. We can't allow this to continue. American Jobs Plan is the biggest increase in our federal non-defense research and development spending on record. It's going to boost America's innovative edge in markets where global leadership is up for grabs. Markets like battery technology, biotechnology, computer chips, clean energy, the competition with China in particular. Critics say we shouldn't spend this money. They ask, what do we get out of it? Well, they said the same thing when we first flew into space for the first time. They said the same thing. Well, pushing the frontiers led to big benefits back home. When NASA created Apollo's digital flight control system, unheard of at the time, it led to technologies that help us today to drive our cars and fly our planes. When NASA invented ways to keep food safe for the astronauts, it led to programs that have been used for decades to keep food safe in supermarkets. At least 2,000 products and services have been developed and commercialized as a result of American space exploration. GPS has helped us find each other. Computer chips allow us to see and talk to one another, even separated by mountains and oceans, singing happy birthday and watching the first steps of that new baby grandchild, comforting each other when comfort is needed. Think about what it means to you and your loved ones. We just have to imagine again. I had a long discussion with Xi Jinping, the leader of China, and he called to congratulate me. We spent 2 hours on the phone. And he said, and I was astonished, my national security team and the China experts who were on the line, he said, you've always said, Mr. President, that you can define America in one word, possibilities. That's who we are. In America, anything's possible. Like what we did with vaccines a decade ago that laid the foundation for COVID-19 vaccines we have today. Like we did when the interstate highway system that transformed the way we traveled, lived, worked, and developed. Americans could visit relatives anywhere in the country with just a family station wagon. Business here in Pittsburgh could load up a truck and get a product to Portland or Phoenix. To this day, about a quarter of all the miles Americans drive each year on one of those very original highways. Imagine what we can do, what's within our reach when we modernize those highways. You and your family could travel coast to coast without a single tank of gas on board a high-speed train. We can connect high-speed, affordable, reliable internet wherever you live. Imagine knowing that you are handing your children and grandchildren a country that will lead the world in producing clean energy technology and will need to address one of the biggest threats of our time. That's what we'll do. All together, along with the American Rescue Plan, The proposal I put forward will create millions of jobs, estimated by some Wall Street outfits over 18 million jobs over 4 years. Good paying jobs. It also works to level the playing field, empower workers, and ensure that the new jobs are good jobs that you can raise a family on, and ensure free and fair choice to organize and bargain collectively. That's why my plan asks Congress to pass the Protecting the Right to Organize Act, the PRO Act, and send it to my desk. This plan is important, not only for what and how it builds, but it's also important to where we build. It includes everyone, regardless of your race or your zip code. Too often, economic growth and recovery is concentrated on the coast. Too often, investments have failed to meet the needs of marginalized communities left behind. There is talent innovation everywhere. And this plan connects that talent through cities, small towns, rural communities, through our businesses and our universities, through our entrepreneurs, union workers, all across America. We have to move now. Because I'm convinced that if we act now, in 50 years, people are going to look back and say, this was the moment that America won the future. What I'm proposing is a one-time capital investment of roughly $2 trillion in America's future, spread largely over 8 years. It will generate historic job growth, historic economic growth, help businesses to compete internationally, create more revenue as well. They are among the highest value investments we can make in the nation, investing in our infrastructure. But put another way, failing to make these investments adds to our debt and effectively puts our children at a disadvantage relative to our competitors. That's what crumbling infrastructure does. And our infrastructure is crumbling. We rank 13th in the world. What's more, it heightens our vulnerability to and attracts our adversaries to compete in ways that they haven't up to now. And our adversaries are worried about us building this critical infrastructure. Put simply, these are investments we have to make. We can afford to make them. Or put another, we can't afford not to. So how do we pay for it? I spoke to the majority leader. I guess he's no longer the majority leader. He has been for a long time. I spoke to the Republican leader about the plan. Everybody's for doing something about infrastructure. Why haven't we done it? Well, no one wants to pay for it. Less than 4 years ago, as I said, the Congress passed a tax cut of $2 trillion, increasing the national debt $2 trillion. It didn't meet virtually any of the predictions it would in terms of growing the economy. Overwhelmingly, the benefits of that tax package went to the wealthiest Americans. It even included new investments that would profit by shifting profits and jobs overseas if you're a corporation. It was bad for American competitiveness, deeply unfair to the middle-class families, and wrong for our future. So here's what I do. I start with one rule. No one, we say it again, no one making under $400,000 will see their federal taxes go up, period. This is not about penalizing anyone. I have nothing against millionaires and billionaires. I believe American capitalism. I want everyone to do well. But here's the deal. Right now, a middle-class couple, a firefighter and a teacher, with 2 kids making a combined salary of, say, $110,000, $120,000 a year, pays 22 cents for each additional dollar they earn in federal income tax. But a multinational corporation that builds a factory abroad, brings it home and sells it, they pay nothing at all. We're going to raise the corporate tax. It was 35%, which was too high. We all agreed 5 years ago it should go down to 28%, but they reduced it to 21%. We're going to raise it back to up to 28%. No one should be able to complain about that. It's still lower than what that rate was between World War II and 2017. Just doing that one thing will generate $1 trillion in additional revenue over 15 years. In 2019, an independent analysis found that there are 91, let me say it again, 91 Fortune 500 companies, biggest companies in the world, including Amazon, that use various loopholes so they pay not a single solitary penny in federal income tax. I don't want to punish them. That's just wrong. That's just wrong. Farmer and teacher paying 22%. Amazon and 90 other major corporations paying zero in federal taxes.
I mean, this was very out of context when we talk about large companies not paying taxes. They pay their taxes in many, many other different
Establishing the global minimum
not
tax
paying
for U.S.
corporate
corporations of
income
21%.
So they're still
We're going to level the international playing field.
and they're paying
That alone will raise $1 trillion
sales tax,
over 15
all these
years.
other taxes, and that though they use those taxes as right.
We'll also eliminate deductions by corporations for offshoring
It's slightly
jobs
misleading, but
and shifting assets over.
I'm not saying that they should be allowed to
You
not
do that, you
pay
pay a
tax.
penalty. You don't get a reward.
It is a little bit misleading out of context.
And use the savings from that to give
just kind
companies
of a
tax
soapbox
credits
of mine.
to locate manufacturing here and manufacturing and production here in the United States. And will significantly ramp up the IRS enforcement against corporations who either fail to report their incomes or underreport. It's estimated that could raise hundreds of billions of dollars. All this adds up to more than what I proposed to spend in just 15 years. It's honest, it's fiscally responsible, and by the way, as the experts will tell you, it reduces the debt, the federal debt over the long haul. But let me be clear. These are my ideas on how to pay for this plan. If others have additional ideas, let them come forward. I'm open to other ideas so long as they do not impose any tax increase on people making less than $400,000. Let me close with this. Historically, infrastructure had been a bipartisan undertaking, many times led by Republicans. It was Abraham Lincoln who built the Transcontinental Railroad. Dwight Eisenhower, Republican, the interstate highway system. I could go on. And I don't think you'll find a Republican today in the House or Senate, maybe I'm wrong, gentlemen, who doesn't think we have to improve our infrastructure. They know China and other countries are eating our lunch. So there's no reason why it can't be bipartisan again. The divisions of the moment shouldn't stop us from doing the right thing for the future. I'm going to bring Republicans into the Oval Office, listen to them, what they have to say, and be open to other ideas. We'll have a good faith negotiation with any Republican who wants to help get this done. But we have to get it done. I truly believe we're in a moment where history is going to look back on this time as a fundamental choice having been made between democracies and autocracies. You know, there's a lot of autocrats in the world who think the reason why they're going to win is democracies can't reach consensus any longer. Autocracies do. That's what competition between America and China and the rest of the world is all about. It's a basic question. Can democracies still deliver for their people? Can they get a majority? I believe we can. I believe we must. Delivering for the American people is what the American Rescue Plan was all about. And it's been overwhelmingly popular when I wrote it. Everybody said I had no bipartisan support. We're overwhelming bipartisan support with registered Republican voters. And ask around. If you live in a town with a Republican mayor, a Republican county executive, or a Republican governor, ask them how many would rather get rid of the plan. Ask them if it helped them at all. It's what the American Job Plan is about. The new one I'm proposing. I hope Republicans in Congress will join this effort. I hope and I believe a number of businesses will join this effort. And I hope and believe the American people will join this effort. Democrats, Republicans, Independents, we can do this. We have to do this. We will do this. We just have to remember, this is the United States of America. And I've said it 1,000 times. There's nothing beyond our capacity if we act together. So it's time to move together. Thank you, and I hope I get to come back to see you folks after this plan is passed And the question is, you have to attract even more apprentices, more people, because we're building so much. God bless you all, and may God protect our troops. Thank you.
And welcome to Fast Money. President Biden speaking in Pittsburgh, laying out his massive infrastructure spending plan, also laying out his plan to pay for it, which would include tax increases on the wealthy as well as corporate America. Let's get straight to Elon Moy with all the details. Elon.
Melissa, the president there trying to strike an inspirational tone, calling on the country to consider the possibility of
Yes, I don't doubt or dislike anything he necessarily said. Of course, I'll have some criticisms on some of his political jabs here and there and things, comments about taxes and unions and things like that. And it's not that he's wrong, it's that he's selectively using his words out of context in order to, pander to the people that vote for him. And that part I'm not in love with. However, I'm not going to disagree that stuff he talked about, whether it's roads and bridges and internet and power and things like that, it needs to be fixed. It needs to be. I would much rather we continue to spend money on these kinds of things and continue to spend money on these stimulus programs. I mean, this is $2 trillion. This last stimulus program was 1.9 trillion. And I mean, I'll bet you can ask you got 10 people on the street. You go to 10 people on the street and say, hey, that stimulus you got in March, did you really need it? And really, did you need it? Did you need it in order to pay your bills, pay your rent, get food on the table? And I'll bet you 9 out of those 10 people will say, not really. Did they need the first one? A lot of people, right? The first one back in a lot of people thinking. So many people. Now we're at the point again where unemployment's down at 5 or 6%, and the 5 or 6% are still employed. Most of them are still getting additional unemployment benefits. I don't know that, but employers can't find people to work. I mean, so my frustration here isn't so much this package. My frustration is choosing to do both this and the $1.9 trillion stimulus package within a month of each other. And that's the part that frustrates me. I'll bet you that if it went to vote with general people, they would have voted on the stimulus, even if the 5% didn't need it. I would have voted for the infrastructure. Maybe that's just me. I didn't need $1,400 to go on the table. So maybe that puts me in a place where with a different perspective. I don't know, but I'm not a fan of these two things happening at the same time. That's what frustrates me. And then of course, which takes me the heck out. I mean, absolutely, of course, info. But I absolutely know that there is so much fluff. Holy cow. So much Jesus effing fluff in this package that good luck, man. That's all I gotta say. If there's gonna be $2 trillion, at least half a trillion of that shit is gonna be crap. It's just thrown in there for political pandering. Oh yeah, I mean, look at that. IRFA's up, close at 34.6, and it's at 5.9 now. I don't know. Do I want to throw one share at it and just see what happens? I'm going to put in an order, only for 3 shares, IFRA. Because it's bouncing. I mean, it might be one that I don't know if it'll go down to 35 again, so it's never take. It might be one of those that once the market opens back up tomorrow and gets to digest what he said, it so maybe I'll take advantage of that. And it looks like the markets have generally pumped just slightly after hours, mostly probably due to something in it. So that's good to see. Hopefully that leads to good futures, good opening tomorrow, and then tomorrow for the Q2 week. Yeah, I think we can make it one hell of a really good week if we can finish it positively. So I'm going to sign out, guys. I appreciate everyone who is still here. Looks like there's a couple people still sticking around, probably wanted to watch the speech as well. Feel free to comment, like, subscribe, whatever it is, if you're still here. And I appreciate you guys joining me again today for another 8 hours of power. And we'll be back tomorrow. So I thank you guys. Until then, adios.